Hello, hi everyone. Good morning, good afternoon, and good evening. So, students, they are waiting for BCCA CM Inter marathons. Okay, so this video is meant for giving a clarity about the marathons, CM Inter marathons. So, this time we are going to upload marathons for every subject except OM and SM. Due to the busy schedule of Rajesh sir, we couldn't upload OM SM marathon. Okay, but last marathon you can watch and do watch the MCQs recorded, uploaded for the last attempt. Okay, and there is a surprise for you. So again for this attempt, we are going to give super 50 questions for all the 8 subjects. Sir, that you have given last attempt also, this is not a surprise. Another surprise waiting for you is we are going to provide 200 bullet MCQs, which are most important MCQs. By solving those 200 MCQs, you can score at least 20 marks. At least 20 marks. So this is a surprise for you. And what are you waiting for? I'm going to announce marathon schedule. So business law and ethics. So faculty name Vignan Deepak sir. You know him, right? So already the marathon part 1 was uploaded. So law marathon will be uploaded in 2 parts. Actually this is not a marathon. This is an exam oriented batch being uploaded as a marathon. We are not collecting any charges or a fee from students. Okay, because most of the students will be repeater. They might have already paid fee some other, I mean in some other coaching institute. So that's why. So we are what? Uploading exam oriented classes as a marathon. So law will be uploaded in 2 parts. First part already uploaded and second part will be released on 3rd May. Okay, so financial accounting first part already uploaded, already released in the YouTube. Second part will be released on 1st May and third part will be on 4th May. Okay, so Banu sir, and next direct taxation, the most charming faculty in our BCCA team, Ravi sir. So the first part will be coming on 30th April and the second part will be coming on 6th May. So 2 parts DT. Indirect taxation, okay. So IDT Guru, he is popularly known as Manideep sir. Already part 1 was uploaded. So there is only one part for IDT, indirect taxation, okay. So already the video uploaded. Costing by Shiva sir, Shining Shiva sir. Part 1 will be uploaded on 28th April and the second part will be uploaded on 5th May. Corporate accounts and audit, Verma sir, 2 parts and first part will be uploaded on 4th May, second part will be uploaded on 7th May. Financial management by Ravi Kumar sir, that is me, and first part will be uploaded on 29th April, second part will be uploaded on 2nd May. Management accounting again by Shining Shiva sir. Part 1 will be uploaded on 8th May. So part 2 on 11th May. Actually not uploaded, will be made public because all the lectures were uploaded and scheduled for respective dates. So you need not worry. So there won't be any delay. There won't be any delay. There won't be any delay because already the classes were recorded and uploaded and scheduled for respective days. Okay, so do watch these marathons and do share your feedback. Please mention in comments from where you are watching these marathons, and if you want anything else, if you want any guidance how to read theory, how to approach a practical subject, if you want anything, if you have any problem, please let us know in our comments. And one more thing, so we have created a separate telegram group for each subject. We have a BCCA main telegram group. Other than that main telegram group, we have created a separate telegram group for every subject. Do join in those telegram groups. Telegram group links will be provided in the description. So do join those telegram groups and do ask doubts. Interact with faculty. So faculties will be helping you, okay, to clear CMA Inter in June 2025. Am I clear? Okay. And if you are looking for any classes, then these are the prices. Right now 20% offer is going on. So CMA both groups price 39,999, group 1 21,999, group 2 21,999, and books. Okay, so first student will be watching our book and then they watch our YouTube channel. Okay, so BCCA is famous just because of books. So 5999 both groups, group 1 2999 and group 2 2999. And students who are watching marathon, who have decided to watch marathons, they must have a books of a BCCA, because questions were discussed from BCCA study material. So that's why do purchase the books, and the course links will be provided in the description. Clear? Am I clear? Any other doubt? No. So do let us know. So whatever the doubt you have, if you have any difficulty in CM Enter, for suppose if you are not willing to write examination, if you want to postpone, if you want any counseling, anything, any kind of a help, please do join in our Telegram groups and you can ask to the respective faculty any doubt. Okay, am I clear? And so eagerly waiting to meet you in CMA final. So let us rock together. Thank you so much. Thank you all. So next concept, capital structure. Capital structure. So financial management, two aspects are procurement of fund, effective utilization of fund. We procure fund from two sources, equity and debt. We utilize the fund for two purposes, fixed assets and current assets. Fixed assets and current assets. Investment in current assets, working capital management. Investment in fixed assets, capital budgeting. Capital budgeting. So procurement of fund. So procurement fund side we have three chapters: cost of a capital, leverages, and capital structure. Already we have covered cost of a capital and leverages. So there are three leverages: operating leverage, financial leverage, combined leverage. Combined leverage. Operating leverage measures operating risk, financial leverage measures finance risk, combined leverage measures total risk. Operating leverage is equal to contribution divided by EBIT. Financial leverage is equal to EBIT divided by EBT. Okay. Combined leverage is equal to contribution divided by EBT, earnings before tax. Earnings before tax. So clear? Okay. So next, when there is a preference share capital, financial leverage is equal to EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Combined leverage is equal to contribution divided by EBT minus ఏం మాట పడిపోయింది ఇంత ఖర్చరు PD divided by 1 minus tax rate. 1 minus tax rate. So this is a combined leverage. Combined leverage. Clear? Next, operating leverage arises due to, operating risk arises due to fixed cost. If a fixed cost is equal to 0, operating leverage is equal to 1. Okay, if fixed financial charges are equal to 0, then financial leverage is equal to 1. So fixed financial charges is equal to interest and preference dividend. Interest and preference dividend. If a fixed cost increases, operating risk increases. Nothing but operating leverage increases. If a fixed financial charges increases, financial leverage increases. If both fixed cost and fixed financial charges increases, then combined leverage increases. Okay. So clear? Risk means possibility of occurrence of loss. Risk means possibility of occurrence of loss. So okay. Next, leverage refers to relation between two or more interrelated variables. Operating leverage denotes the relationship between EBIT and sales. EBIT and sales. Financial leverage denotes the relationship between EBIT and EBT, EAT or EPS, earnings per share. Combined leverage denotes the relationship between sales and EPS, sales and earnings per share. Okay. And operating leverage is not a percentage, it is a ratio. It is a ratio. Operating leverage 2. What does that mean? For every 1% change in sales, EBIT changes by 2%. Financial leverage 3. It indicates for every 1% change in EBIT, earnings per share changes by 3%. Combined leverage 5. That means for every 1% change in sales, earnings per share changes by 5%. High leverage indicates high risk. High leverage indicates high risk. So clear? Okay. So done. Next what we have seen, cost of a capital, cost of a debt, cost of preference, cost of equity, KE, weighted average cost of a capital, weighted average cost of a capital. Okay. So KO. So weighted average cost of a capital means minimum return required by the company to meet the expectation of the investors. Minimum return required by the company to meet the expectation of investors. So we should try to keep a cost of a capital minimum. We should try to keep the cost of a capital minimum. In cost of a capital chapter, we have learned how to find out the cost of a capital. How to find. We having to determine the optimum capital structure. Optimum capital structure. In this chapter, here we are going to determine the optimum capital structure. Optimum means best. Optimum means what? Best. Okay. So next chapter, capital structure. Mahatma, capital structure means capital structure means capital mix. Capital mix. Capital structure means what? A capital mix. Capital structure means what? A capital mix. Capital structure means capital mix. So capital structure means capital mix. Capital structure means a capital mix. Capital structure means a capital mix. So capital mix can be what? 100% equity. So this 100% equity is called as unlevered. 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 For example, Sinu, he started a business and 100% capital is from equity. 100% capital is from equity. So then that firm is called as a unlevered firm. Unlevered firm. Clear? Unlevered firm. Okay. Levered firm means the firm which is using debt. Firm which is using debt. So for example, Yogita capital is 80% equity, 20% debt. So this is what? Levered firm. Levered firm. Capital mix 80-20. Yogita capital mix 80-20. Okay, clear? So now Prasu is doing a business. 50% equity, 50% debt. So this is also what? Levered. This is also a levered firm. This is also a levered firm. Okay, capital structure. Okay. So now we are talking about what? Optimal capital structure. Optimal capital structure means where a cost of a capital is minimum. Okay. So capital structure should be minimum. I mean, optimum capital structure. Optimum capital structure. So optimum capital structure means best. So which is the best capital structure? The capital structure where a cost of a capital is minimum and the value of a firm is maximum. Value of a firm is maximum. Okay, cost of a capital is what? Minimum. Cost of a capital is minimum. Okay. So if a cost of a capital is minimum, then the value of firm will get maximized, because what is the value of a firm? value of firm is equal to EBIT divided by KO. KO means overall cost of a capital. So overall cost of a capital. Overall cost of a capital. So if a overall cost of a capital minimized, if a denominator decreases, then the value of firm increases. Value of a firm increases. Clear? So cost of a capital is what? Minimum. Optimum capital structure means where a cost of a capital is minimum and return is maximum. Return is maximum. So nothing but the important word is cost of a capital should be minimum. So the value of firm is equal to EBIT divided by what? KO. KO means overall cost of a capital. Overall cost of a capital. So for example, if you see the question number 1, you know how to find out weighted average cost of a capital, right? By doing a weighted average of a specific cost. Weighted average of specific cost. For example, option 1, cost of a debt 11%, cost of equity 13%, percentage of debt to total value, debt plus equity. In total capital, that is debt plus equity, percentage of debt is 0. That means 100% equity. 100% equity means overall cost of a capital KO is equal to KE. KO of a unlevered firm is equal to KE because no debt. So that's why simply the overall cost of a capital is equal to 11 into 0 plus what? 13 into 1 because proportion of equity is equal to 1. So 11 into 0 plus 13 into 1. So the answer is 13%. So clear? So KO of unlevered firm is equal to what? KO of unlevered firm is equal to KE. So clear? Next one, debt percentage is equal to 0.1. Debt percentage 0.1 means equity 0.9. Equity 0.9. So what is the calculation? Cost of debt 11. 11 into 0.1 plus 13 into 0.9. So 12.8 is the overall cost of a capital. Determine the optimal. Optimal means best capital structure. So best capital structure. So for suppose option 1 and 2. In these two options, which is the best one? Second one is the best one because cost of a capital should be minimum. Expectation should be minimum. Third one, 11.6 into 0.2. If debt proportion is 0.2, then equity proportion is equal to 0.8. 0.8. So the answer is 13.52%. Clear? Next what? So likewise we do for other 4 also. Okay. So one thing we have to observe here. So which is the capital structure, best capital structure? Second one is the best capital structure because the cost of a capital is minimum. So there you will get a value of a firm, maximum value of firm. There the value of a firm will get maximized. Charan. So second one is the best capital structure. Best capital structure. Am I clear? Done. So one thing you have to observe here. As the proportion of debt increases, KD is increasing. Cost of a debt is increasing. Yes or no? 11, 11, 11.6, 12, 13, 15, 18. So rate of interest is getting increased. Cost of a debt is getting increased. Why? Debt proportion increases. Okay. For suppose if I am taking 1 lakh from Pawan, Pawan is taking risk. He is expecting 11. For suppose if I am taking 2 lakhs, the risk taken by Pawan is getting increased. He will be increasing the rate of interest. If I am taking 4 lakhs, risk is increasing. He will expect a more return. If I am taking 10 lakhs, he will be expecting even more. So that's why if a proportion of a debt increases, generally cost of a debt will increase at the same time. So from this side also, equity shareholders point of view, if a debt proportion increases, the risk taken by the equity shareholders will also increase, because ultimately the interest has to be paid by the equity shareholders. Nothing but company has to pay. Ultimately this interest will eat the capital, equity capital. Okay, so that's why the expectation of equity shareholders is also increasing. If you see the KE is also what increasing. In cost of a capital, one question. So fourth source was added. I think fourth or fifth source was added. So we are taking an additional debt. When we are taking an additional debt, the expectation of equity shareholder has got increased. So here also the same thing is happening. So in capital structure theories, there are 4 theories: net income approach, net operating income approach, Modi-Gilani-Miller approach, traditional approach. So this can be told as a example for traditional approach. Traditional approach means with the increase in proportion of a debt, overall cost of a capital decreases up to a certain point. But beyond certain point, the reverse trend emerges. If you see here, with the increase in proportion of debt, the overall cost of a capital is decreasing up to second option. Beyond that, reverse trend emerges. Nothing but with the increase in proportion of debt, cost of a capital is increasing. So again, I will explain this while discussing a capital structure theories. Right now, which is the optimal capital structure? Second one is the optimal capital structure. Second one is what? Optimal capital structure. Okay, so clear? Done. And next, see the second one also. Jet company has a capital structure of 30% debt, 70% equity. 30% debt, 70% equity. The company is considering various investment proposals costing less than rupees 30 lakhs. The company does not want to distribute its present capital structure. The cost of raising the debt and equity are as follows. The company is considering various investment proposals costing less than 30 lakhs. They are not considering one investment proposal. They are considering various investment proposals costing less than 30 lakhs. The company does not want to distribute its present capital does not want to disturb. That means they want to follow 30-70. The cost of raising the debt and equity are as follows. Project cost, if it is above 5 lakhs, cost of debt is 9%. I think that is below 5 lakhs, not above 5 lakhs, below 5 lakhs. If a project cost is below 5 lakhs, cost of a debt is 9%, cost of equity is 13%. Above 5 lakhs and up to 20 lakhs, project cost is increasing. That means risk increases. From the investor's point of view, risk increases. So that's why their expectation is getting increased. Cost of debt 10%, cost of equity 14%. Above 20 lakhs and up to 40 lakhs, 11%, 15%. Above 40 lakhs and up to 1 CR, 12%, 15.55%. Assuming the tax rate is 50%, compute the cost of 2 projects A and B. Whose fund requirement are rupees 8 lakhs. For suppose if fund requirement is 8 lakhs and 22 lakhs respectively, so then find out the cost of 2 projects. If the projects are expected to yield after tax return of 11%, determine under what conditions it would be acceptable. Here the cost of 2 projects means they are asking you to find out the cost of a capital. Okay. So first one, up to 5 lakhs. So what is the cost of a debt? 9%. Tax rate is given high. Okay. So that means 9% is considered as a pre-tax. 9% is considered as pre-tax. Pre-tax means before tax. So that's why 9 into 1 minus 9 into 1 minus 0.5, 4.5. K will remain same, 13%. K will remain same, 13%. So what is the, weights, debt, 30%, equity 70%. So weighted average cost of a capital 10.45. 10.45. Yes or no? Above 5 lakhs and up to 20 lakhs. 5%, 14. 10%. Okay, 5%. So 0.3 into 5 plus 0.7 into 14. Okay. So the other two, the same procedure need not be calculated. Okay. You feel like practicing the other two also, but not required. To understand the concept, first two enough. So 10.45, 11.3. Here the project cost is what? 8 lakhs. 8 lakhs means which is above 5 lakhs up to 20 lakhs. So KO is equal to 11.3. So project is giving a return of 11%, nothing but IRR. So minimum return required by the company to meet the expectation of investors is 11.3. Project is yielding 11%. So are you going to accept the project? No, project is not acceptable. Second case, 22 lakhs means third slab. Third slab. So the overall cost of a capital is 12.15. Project return 11%. Here also the actual return is less than the required return. So that's why both the projects are not acceptable. Both the projects are not acceptable. So clear? Okay. So in capital structure, so first thing, the object of learning this chapter is to determine optimal capital structure. We should select an optimal capital structure best. For example, in second question, they are following capital structure 30, 70. Why they are following 30 and 70? They might be feeling that that was the best one. For every company, the capital structure will not be same. For business to business, the capital structure changes. Okay, clear? We cannot say 100% equity is the best capital structure. We cannot say 50% equity and 50% debt is the capital structure. We cannot say which is the best one. We cannot conclude this is the best capital structure. Best capital structure depends upon a business. Depends upon business. Depends upon business. For example, if Vamshi wanted to do a stock trading, already there is a risk involved. High risk is involved in that stock trading. Then which capital structure will you suggest? 100% equity. If you have a own fund, then do stock trading. Otherwise, keep calm. Yes or no? Why? Already high risk is involved. High uncertainty is involved. So that's why if he is doing a stock trading, then we are going to suggest 100% equity. Because high business risk is involved. High business risk is involved. For suppose if business risk is less, then we might suggest 30% debt, 70% equity. So depending upon a business, the optimal capital structure, okay, depends, okay, keeps on changing. We cannot conclude this is the capital structure. For example, for electricity companies, the companies which are generating electricities, so electricity board suggests 30-70, 30% debt, 70% equity. So that's how the capital structure would be. Okay, clear? The object of this chapter is to determining the optimal capital structure, because okay, optimal means best. The capital structure where the cost of a capital is minimum. Cost of a capital is minimum. If a cost of a capital is minimum, value of a firm will be maximum. The ultimate objective, the primary objective of a financial management is wealth maximization. Wealth maximization. Okay, so that is fine. So first in this chapter we are going to learn favorable financial leverage. Already we have discussed in which chapter? Favorable financial leverage. In leverages chapter I have discussed favorable financial leverage. Okay, favorable financial leverage. Next, financial break even point. Financial break even point. You know the break even point, right? In cost accounting you all learnt break even point. So what is the formula for break even point? So fixed cost divided by PV ratio, I mean amount. If you want to find out units, fixed cost divided by Cosmopolitan. Contribution per unit. Fixed cost divided by contribution per unit. So financial break even point. Second one is what? Financial break even point. We are not going to discuss here costing break even point. Costing break even point is different from financial break even point. Next, EBIT-EPS indifference point. EBIT-EPS indifference point. EBIT-EPS EBIT-EPS indifference point. Indifference means no difference. EBIT-EPS indifference point. Next, fourth, capital structure theories. Capital structure theories. In capital structure theories, net income approach. First approach is what? Net income approach. Second one, net operating income approach. Next, Modi-Gilani Miller approach. Modi-Gilani Miller approach. Next, D, traditional approach. Traditional approach. Modi-Gilani Miller approach, again we discuss in dividend decision also. Dividend decision. So 4 approaches. So this is the content we are going to discuss in this chapter. So first one is favorable financial leverage. Second one, financial break-even point. Third, EBIT-EPS indifference point. Capital structure theories, net income approach, net operating income approach, Modi-Gilani Miller approach, traditional approach. Traditional approach. Okay. So PD, what is the first one? First one, financial break-even point. Already we have discussed in leverages chapter. Once again I am writing favorable financial leverage. Favorable financial leverage. Financial leverage is said to be favorable. Financial leverage is said to be favorable. Sarojini Naidu. Favorable financial leverage. Favorable financial leverage. So financial leverage is said to be favorable if return on investment is greater than rate of interest. Financial leverage is said to be favorable if return on investment is greater than rate of interest. Okay, so already we have seen one question, right? Okay, return on investment is greater than what? Rate of interest. So financial leverage is said to be favorable if return on investment is greater than rate of interest. So equity shareholders will get leverage advantage if a proportion of a debt is increased in capital structure. Nothing but if a debt proportion increases, if a debt proportion in capital structure increases, okay, return on equity increases and earnings per share will also increase. Are you getting my point? When financial leverage is favorable, if you keep on increasing the debt proportion in capital structure, then return on equity increases and earnings per share will also increase. Earnings per share will also increase. So let us take an example. Example 1, particulars. Case 1, case 2, case 3. Particulars case 1, case 2, case 3. Very good, Baladitya. Particulars. Equity. Let us assume equity is equal to 20 lakhs. Equity is equal to what? 20 lakhs. 10% debt is equal to 10% debt. 10% debt is equal to nil. The total capital is equal to 20 lakhs. So let us take this example. Capital mix. Capital mix. Let us assume EBIT is equal to 4 lakhs. EBIT is equal to 4 lakhs. What is the investment? 20 lakhs. EBIT is equal to 4 lakhs. EBIT is equal to 4 lakhs. EBIT is equal to 4 lakhs. Okay. Next. Minus what? EBIT minus what? Interest. EBIT minus what? Interest. So interest is equal to 0 because 10% debt is 0. So this is what? Earnings before tax. Let us assume there are no taxes right now. Then earnings before tax itself is what? Earnings after tax. So this is nothing but earnings available to equity shareholders. 4 lakhs. Yes or no? Now, return on investment. Return on investment is equal to EBIT divided by capital employed. Capital employed means equity plus debt. Equity plus debt. So return on investment is equal to EBIT divided by capital employed. So the return on investment is equal to what? 4 lakhs divided by 20 lakhs. Return is 4 lakhs, investment is 20 lakhs. So return on investment is equal to 0.2, nothing but 20%. 20%. Next, return on equity. Return on equity is equal to earnings available to equity shareholders divided by equity. Here earnings available to equity shareholders also same, 4 lakhs divided by what? 20 lakhs. So the answer is 20%. So what about financial leverage? It is favorable or financial leverage is favorable. Here the financial leverage means you should not apply the formula, that is EBIT divided by EBT. Here the financial leverage is favorable. Why it is favorable? Because return on investment 20% is greater than what? Rate of interest, that is 10%. So the point what I am saying is, when the financial leverage is favorable, if you increase the debt proportion, return on equity increases and EPS also increase. Let us check whether it happens or not. Let us find out earnings per share also. Earnings per share. Earnings per share. Let us assume face value is equal to 10 rupees. Face value is equal to 10 rupees. Then number of shares is equal to 2 lakhs. That means earnings per share is equal to 20 lakhs divided by what? 2 lakhs. Rupees 10 is the earnings per share. 10 rupees is the earnings per share. Clear? Are you able to understand? Done? 4 lakhs, huh? I'm sorry. 4 lakhs divided by 4 lakhs divided by 2 lakhs. 2 rupees is the earnings per share. 2 rupees is the earnings per share. So clear? Done? Now let us increase the debt proportion. Increase the debt proportion. Equity, let us take 15 lakhs and 5 lakhs is the debt. So 20 lakhs is the total investment. When total investment is same, the return will also be same, right? If they are doing same business. So EBIT will be same. What is the EBIT? 4 lakhs. What about interest? 5 lakhs into 10%. 50,000. That means 0.5 lakhs. 3.5 lakhs. What about return on investment? Return on investment will remain same. What about return on equity? 3.5 lakhs divided by equity is equal to 15 lakhs. 3.5 divided by 15. 17.5 చెప్పారు ఎవరో, అంటే ఏం చేసి ఉంటారు? 3.5 డివైడ్ బై 20 చేసి ఉంటారు. దానికన్నా ముందు 90 చేసి ఉంటారు. సో అలా ఎలా చేస్తాం? సో 3.5 divided by, can we do 20 or not? No. I'm asking return on equity. Earnings available to equity shareholders divided by what? Equity. What is the equity investment here? 15 lakhs. Clear? Amma Naidu? Clear? So 23.33. What about earnings per share? 3.5 lakhs divided by, how many shares are there? Let us assume face value is equal to 10. 3.5 divided by 2 lakhs chestara. 3.5 divided by 1.5 lakhs. 2.33. So earnings per share is increasing or not? Yes, earnings per share is increasing. Earnings per share is increasing. Yes or no? So when financial leverage is favorable, if you increase the debt proportion in capital structure, the overall cost of, if you increase the debt proportion, okay, return on equity increases and earnings per share will also increase. Clear? Let us increase the debt proportion further. 10 lakhs and 10 lakhs, 20 lakhs, 4 lakhs, 1 lakh, 3 lakhs. So return on investment 20%, return on equity. Return on equity. What is the return on equity? 3 lakhs divided by 10 lakhs, 30%. So earnings per share, 3 lakhs divided by how many shares? 1 lakh shares. Equity shareholders are getting benefited, yes or no? With the increase in debt proportion, the return to the equity shareholder is getting increased. So when the financial leverage is favorable, if the objective is only to maximize the return on equity or earnings per share, you keep on increasing the debt proportion in capital structure so that what EPS and return on equity to the equity shareholders will increase. If your only objective is profit maximization, if you want to maximize EPS, if you want to maximize return on equity, keep on increasing the debt proportion in capital structure. So this is the example. When financial leverage is favorable, first we should check whether financial leverage is favorable or not. Simple. On every 1 rupee invested, we are getting 20%, but giving only 10% to the debt holders. So that's why. So with increase in debt proportion, what return on equity increases. In leverage chapter, I have told you the another formula also. Return on equity is equal to return on investment 20% plus 20 minus 10 into debt by equity. In first case, debt 25, equity, in second case, debt 5 lakhs. 5 lakhs means 5 lakhs divided by 20 lakhs, 25%. What about equity? 75%. You will get 23.33%. What is the logic behind this? Simple. Equity shareholders on 1 rupee invested, they are getting 20. Plus, in addition to that, they are taking 1 rupee from debt holders. On that 1 rupee also they are earning 20%, but they are paying only 10%. They are paying only 10%. That extra 10 will be added to what? Equity shareholders. But the proportions are not same, right? So that's why into 25, debt divided by equity. Nothing but the formula is return on investment plus return on investment minus rate of interest into D divided by equity. Are you able to understand the logic? That is common sense. On every 1 rupee invested, the business is generating 20% return. So equity shareholders will get what? Extra return, because only 10% is paid to the debenture holders. Clear? In third case, 20% plus 20 minus 10 into 50 divided by 50, because both equity and debt are same. 0.5, 0.5. Or you can take 50 divided by 50. So then answer is 30%. Answer is 30%. So clear? Okay. For suppose if there is a tax, if there is tax, then our answer will change. If there is a tax, then formula will change. Return on equity formula will change. We should multiply with 1 minus tax rate. 1 minus tax rate. So what is the, for example, tax rate? Let us assume 50%. 50%. Then return on equity in first case will be only 10%. Why 10%? 50% is paid as a tax. Yes or no? Okay. Clear? If there is a tax, then multiply with what? Into 1 minus tax. Entire formula is multiplied with what? 1 minus tax rate. Okay. Clear? Done? So this is what favorable financial leverage. So what is the conclusion? If a financial leverage is favorable, increase the proportion of a debt, return on equity increases, and earnings per share will also increase. Then you might think, sir, then we can conclude the capital structure chapter, because optimum capital structure is what? The capital structure which is having a maximum debt. Yes or no? But one point I have repeatedly told, if the objective is only to maximize EPS, then increase the proportion of a debt. But our primary objective is not profit maximization. Our primary objective is wealth maximization. One factor we are ignoring here is, with the increase in proportion of a debt in capital structure, the risk taken by the equity shareholders will increase. If a proportion of debt increases, then what happens? Risk taken by equity shareholders increases. That means KE increases. Cost of equity KE increases. After a certain point of a time, cost of a debt will also increase, and the overall cost of a capital will increase, like in the first question. If overall cost of a capital increases, then the value of firm decreases. Value of a firm decreases, because value of firm is equal to EBIT divided by KO. Am I clear? Done? So that's why we cannot say, we cannot conclude the capital structure which is having a maximum debt is a optimal. Okay? So this can be taken as a base to decide the optimal capital structure. No doubt, if your objective is only to maximize EPS, then select a capital structure which is having a maximum debt. Okay? So this is favorable. Financial leverage. Next, financial break-even point. Like costing break-even point, we have a financial break-even point. Second, financial break-even point. Vamsi, first time smile use any face lo. Financial break-even point. Financial break-even point. Financial break-even point means, break-even means no profit, no loss. Yes or no? No profit, no loss. In costing, break-even point means sales. We calculate break-even sales, not break-even contribution. We calculate what? Break-even sales. Break-even sales is equal to fixed cost divided by PV ratio, or fixed cost divided by contribution per unit. Yes or no? So financial break-even point. Financial break-even point means here not sales, EBIT. Minimum EBIT required to meet fixed financial charges. Minimum EBIT required to meet fixed financial charges. What are the fixed financial charges? Interest and what? PD. PD ante? Preference dividend. PD means what? Preference dividend. Interest and so apply your mind. Financial charges. That means charges paid on procurement of finance, like equity. Financial charges include equity dividend also, but equity dividend is not fixed, it is variable. So fixed financial charges means only interest and preference dividend. So these are the charges paid on procurement of a finance. Okay? So financial break-even point means minimum EBIT required to meet fixed financial charges. Pen plastic kada madi. Ee pen kuda tinnada. Chocolate pens undayi idu konukochu kada. Minimum EBIT required to meet fixed financial charges. Fixed financial charges. Yashwant, నువ్వు కూడా అలర్ చేస్తావా? ఓకే. Okay. Minimum EBIT required to meet what? Fixed financial charges, interest and preference dividend. Okay. So financial break-even point. For example, the capital structure is 100% equity. Then financial break-even point is equal to 0. 0. Why 0? There are no fixed financial charges. Minimum EBIT required is equal to 0. Minimum EBIT, because EBIT is 0 minus interest 0, EBT 0, and minus tax 0, earnings after tax 0, minus preference dividend 0. Okay, and at financial break-even point, EPS is equal to what? At financial break-even point, EPS is equal to what? 0. Clear? Example this color. 100% equity. If the capital structure is 100% equity, financial break-even point is equal to what? 0. Clear? Next, equity and what? Debt. For example, if your capital structure includes equity and debt, then the financial break-even point is equal to interest. Minimum EBIT required to meet the fixed financial charges. For example, if you are paying interest 1 lakh, the minimum EBIT required to be earned is equal to 1 lakh. Because EBIT 1 lakh, interest 1 lakh. EBIT 1 lakh, interest 1 lakh. Okay, so EBT, earnings before tax, 0. Earnings before tax 0. Okay, so financial break-even point is equal to interest. Financial break-even point is equal to what? Interest. Clear? Okay, for example, if interest is equal to 1 lakh, then financial break-even point is equal to 1 lakh. Minimum EBIT required is equal to 1 lakh. First, suppose if your capital structure is equity and preference shares. Preference shares. Next, first suppose if a capital structure next, equity and preference share. First suppose if the capital structure includes both equity and preference shares, then financial break-even point is equal to preference dividend, because if there is a preference share capital, then fixed financial charges is equal to preference dividend. But preference dividend is paid after payment of tax. So that's why financial break-even point is equal to PD divided by 1 minus tax rate. For example, if a preference dividend is equal to 1 lakh and tax rate is equal to 50%, 0.5, then what is the minimum EBIT required? Minimum EBIT required 2 lakhs. Why? EBIT 2 lakhs, minus interest 0, earnings before tax 2 lakhs, tax 1 lakh, earnings after tax 1 lakh, PD 1 lakh, earnings available to equity holders 0. If a financial break-even point, if you write only 1 lakh, if you are writing only 1 lakh, then what happens? So EBIT 1 lakh, minus interest 0, earnings before tax 1 lakh, tax 50,000, tax 50,000, earnings available to equity holders 50,000, sorry, earnings after tax 50,000, preference dividend 1 lakh, we cannot pay. So EPS will be negative. So that's why PD divided by 1 minus tax rate. Very good, Amaganesh. Next. First, suppose if a capital structure is equal to equity, debt, and preference shares, then financial break-even point is equal to, capital structure includes equity, debt and preferences. Then financial break-even point is equal to, ఏమై ఉండొచ్చు హన్సిక? ఏమై ఉండొచ్చు? నాయుడు, ఇంట్రెస్ట్ ప్లస్ preference dividend divided by 1 minus tax rate, because we require amount for meeting both interest and what? Preference dividend. Clear, Pavan? Next. So this is what a financial break even point. Why are we finding out financial break even point? For example, 100% equity, financial break even point is equal to 0. Okay. For example, equity and debt, financial break even point is equal to 1 lakh. Equity and preference, financial break even point is equal, let us assume 2 lakhs. So why it is calculated? For suppose if my expected EBIT is equal to 50,000. 50,000. Expected EBIT is 50,000. Which capital structure I should select? 100% equity, equity and debt, or equity and preference? I should select first capital structure, because if my expected EBIT is 50,000, I cannot meet 1 lakh interest and I cannot meet 2 lakhs. I require 2 lakhs to meet preference dividend commitment, right? So how this financial break even point is used? For example, if my expected EBIT is only 50,000, then I have to select what? 100% equity. If a financial break even point is 2 lakhs, then okay, fine, I can go for second capital structure. Second capital structure. Always the second one is better than what? Third one. Okay, because interest amount 1 lakh, preference dividend is also 1 lakh. Why always second one is the best one? Because on interest you can save tax, but on preference dividend you cannot save tax. Of course the third will be better. If preference dividend is not 1 lakh, if it is 75 or 50,000, then that may be beneficial. That can be beneficial. Clear? Okay, so this is financial break even point. Clear, Manoj? Next, EBIT-EPS indifference point. Third concept, EBIT-EPS indifference point. EBIT-EPS indifference point. EBIT-EPS indifference point. Indifference point. So this indifference point is different from costing indifference point. In costing, how do we get indifference point? Change in fixed cost divided by change in variable cost per unit. Change in fixed cost divided by change in variable cost per unit. Okay. So indifference point. Indifference means no difference. Indifference means no difference. Costing is different. For example, case 1, case 2. Fixed cost 1 lakh. Variable cost per unit 10 rupees. Variable cost per unit 10 rupees. Case 2, fixed cost 2 lakhs. Variable cost per unit 20. So there cannot be an indifference point between case 1 and case 2, because the reason is straight away we select first option, because fixed cost is less, variable cost per unit is also less. But if in second case variable cost is equal to 5, Which option I should select? First one or second one? First one or second one? That depends upon a number of units we are going to produce. We cannot say first one is best one. First one will be best, no doubt. When you are producing less number of units, you select an option which is having a less amount of a fixed cost. When you are producing a huge number of units, then you select an option which is having a less amount of a variable cost per unit. But I want to know which is the point at which both options will be equal. So how can I find it? Change in fixed cost. What is the change in fixed cost? 1 lakh. For example, if you see the second option, when you compare the second option with first one, you are spending extra amount of 1 lakh. For every unit you are able to save 5 rupees. Okay. So to make the second option equal with first option, how many units are required? 20,000 units. If you are producing 20,000 units, then the total cost will be same under option 1 and option 2. So that point is known as what? Indifference point. Clear? So why are we calculating this indifference point? The simple reason, if you are expected to produce only 10,000 units, then first option is the best one. Nothing but you select an option which is having a less amount of a fixed cost. If you are expected to produce more than 20,000, then you select an option which is having a less variable cost per unit. Am I clear? Are you able to understand the purpose of finding out indifference point? So you might get this question in costing also. So this is a costing break-even point. Indifference point. Costing indifference point. Indifference means no difference. So indifference point is 20,000 units. How do we get costing indifference point? Change in fixed cost divided by change in variable cost per unit. Next, financial EBIT, nothing but EBIT-EPS indifference point. EBIT-EPS indifference point. EBIT-EPS indifference point means the level of EBIT at which level of a EBIT. EBIT-EPS indifference point means the level of a EBIT at which earnings per share is same under two given capital structures. We can find out indifference point between 2. We cannot find out between 3. So in economics you might have heard about indifference point. So by eating apple or orange, you will get at one point of time you will get same level of a satisfaction. That means no difference. Okay. So indifference point, it is the level of a EBIT at which EPS is same under two given capital structures. Okay. So how do we find out EBIT-EPS indifference point, Abhi? EBIT minus I1 EBIT minus what? I1. EBIT minus I1. So nothing but you will get what? Earnings before tax under capital structure 1 into 1 minus tax rate. 1 minus tax rate. Then you will get earnings after tax. minus preference dividend 1, nothing but preference dividend under capital structure 1 divided by E1. E1 means number of equity shares under capital structure 1. EBIT minus I1 into 1 minus T minus PD 1 divided by what? Number of equity shares under capital structure 1 is equal to on right hand side EBIT minus I2 into what? 1 minus tax rate minus PD2 divided by what? E2. E2 means number of equity shares under capital structure 2. PD2 means preference shares under capital structure 2. Okay. For suppose I am not writing T1 and T2. Why I am not writing T1 and T2? Because tax rate will be same for both the capital structure. Why I am not writing EBIT1 and EBIT2? Same EBIT. I have to find out EBIT. Here, what I have to find out? I have to find out the EBIT at which earnings per share would be same under given two capital structures. I am equating the EPS under capital structure 1 and on right hand side I am taking EPS under capital structure 2. So here what I have to find out? I have to find out what? EBIT. This I have to find out. Sometimes in question they might give EBIT. Okay. And first part of the question they will ask to find out EBIT-EPS indifference point. The EBIT given in the question is actual EBIT. That is not indifference point. We have to find out the level of EBIT at which EPS would be same. Okay, clear. If you are substituting the EBIT which is given in the question, then you will get EPS under capital structure 1 on left hand side, that is different, you might get some 5. On right hand side you might get some 3. You are finding out actual EPS, that is not correct. Here EBIT-EPS indifference point means the level of a EBIT at which earnings per share would be same under given two capital structures. Clear? So what is this? This is EBIT-EPS indifference point. Is there any question, Baladitya, on EBIT-EPS indifference point? Roll number? So P ratio is given in that question. Question number 8. P ratio means price divided by earnings. P ratio means what? Price divided by earnings. Price means market price per share. Divided by what? Earnings per share. For example, in question number 8, P ratio is 20. 20 means what? If earnings per share is 1 rupee, market price per share is 20. 17 means if earnings per share is 1 rupee, MPS is 17. 16 means if earnings per share is 1 rupee, market price per share is 16. So P ratio is given. Okay. So they are asking what? So ninth question. In ninth question they are asking you to find out EPS, indifference point and financial break even point. Okay. So what is the total fund to be raised? 2 lakhs. Total fund to be raised 2 lakhs. Plan A 100% equity. Plan B 50% equity, 50% debt. Plan C 50% equity, 50% preference. Cost of debt 8%, cost of preference 8%. Okay, interest rate 8%, preference shares also 8%. So obviously debt will be best because we can save tax on interest. Tax rate 35%. Equity shares of the face value of rupees 10 each will be issued at a premium of rupees 10 per share. Equity shares are issued at a premium of rupees 10 per share. What is the face value? 10. Face value 10. Expected EBIT rupees 80,000. Determined for each plan. Earnings per share, indifference point, and what? Financial break even point. Financial break even point. So first EPS. First what? EPS. What is expected EBIT? 80,000. Total there are 3 plans, right? So 3 plans, 80. In all the 3 plans, EBIT will be same because amount of investment is same. What is the amount of investment? 2 lakhs. So return on investment is equal to 80,000 divided by 2 lakhs. 40%. Return on investment is equal to 40%. Clear? Less interest. Less interest. First case, no interest. 100% equity. Second case, 50% equity, 50% debt. So that means debt amount is equal to 1 lakh into 8%. So interest amount is equal to, clear? What about the preferences share, preference dividend? That we are not, that is not interest, right? Preference dividend. So earnings before tax 80, 72, 80,000 minus tax at the rate of 35%. Earnings after tax minus preference dividend 8,000. These are the earnings available to equity shareholders. EAES divided by what? Number of shares. Be careful while finding out number of shares. Face value 10 but issued at a premium of 20. 10 rupees issued at a premium of 10. That means issue price is 20. Issue price is 20. For every share we are going to get 20 rupees. That means how many shares? First case 2 lakhs divided by 20. 10,000 shares. Second case 1 lakh divided by 20. 5,000. Next what? Third case also 1 lakh divided by 20. 5,000. Now earnings per share. Earnings per share. So how do we get earnings per share? EAES divided by number of our shares. EAES 52,000 divided by 10,000. 5.2. 46,800 divided by 5,000. 8.8. 9.36. Okay. So observe the concept here. In second case, earnings per share is maximum because financial leverage is favorable. Financial leverage is favorable. Return on investment is 40%. Rate of interest is 8%. So that's why in second case, earnings per share is maximum. Third case also, EPS is greater than what? First option, because 40% return on investment but rate of a dividend is 8%. When we compare second with third, second is the better one. Why? In second case, on payment of interest we are saving tax. So that's why in second case we are getting a maximum earnings per share. Clear? Done? Next what they are asking you to find out? Indifference point. Be careful, indifference point means we have to find out EBIT at which EPS would be same. Clear? So instead of this calculation, so we can find out indifference point between what? Between what? Two plans, A and B, B and C, A and C. So first let us find out between A and B. Students might take EBIT 80,000, then you will get on left hand side 5.2, right hand side you will get 9.36. Then you realize it is not correct. Okay, so indifference point calculation, we should find out the level of EBIT at which EPS would be same. So EBIT minus Mahatma, EBIT minus interest first case 0 into 1 minus tax rate 0.35 minus preference dividend 0 divided by how many shares, 10,000, is equal to EBIT minus interest 8,000 into 1 minus 0.35 minus what, 0 divided by, so find out EBIT. You will get EBIT చైనా నేను అవి చేయండి. EBIT Yogita, what is the answer? 16,000. What is the meaning of this 16,000? If the EBIT is 16,000, at that level earnings per share would be same under both option 1 and option 2. So okay, how it can be used? If your expected EBIT is less than 16,000, go for 100% equity. If your expected EBIT is greater than 16,000, go for second plan. So our expected EBIT is what, 80,000, which is greater than indifference point. So that's why the second plan is the best plan. Clear? So this is between what, A and B. Next A and C. Next what, A and C. A and C. A and C means calculation. EBIT minus 0 into 1 minus 0.35 minus 0 divided by what, 10,000 is equal to C plan. EBIT in C plan, interest is equal to 0. Interest 0 into 1 minus 0.35 minus preference dividend 8,000 divided by what, 5,000. Then you will get EBIT 32,000. EBIT so what is the answer? EBIT Ganesh. EBIT Charan. $24,650 na. $24,650. That means if your expected EBIT is 24,650, then EPS would be same under first plan and third plan. First plan and third plan. If your expected EBIT is less than 24,650, A is the best plan, and if your expected EBIT is more than 24,650, then C is the best plan. That means the plan with preference share capital. అర్థమైందా? 650 నా, ఓకే 615. So clear? EBIT is equal to 24,000 what, 615, 24,615. Am I clear? Vamshi? A and C. Done? Next, what between plan B and C? B and C. So what is the calculation? B. EBIT minus 8000 into 1 minus 0.35 divided by what? 5000. Sorry, divided by 5000. That is equal to EBIT minus what? 0 into 1 minus 0.35 minus what? 8000 divided by 5000. Clear? So if you try this, you will not be getting the answer. That means there is no indifference point. There is no level at which EPS would be same under both plans B and C. Why? Because in both the cases, interest 8000, preference dividend also 8000. Always plan B will be dominating plan C. Plan B will be dominating plan C because the reason is we can save tax on payment of interest. So that's why plan B will be dominating what? Plan C. So that's why there, there doesn't exist any indifference point between what? Plan B and plan C. Clear? So this is EBIT, EPS indifference point. Clear? Is there any other question? Manuji? There is another part also. What is another part? Financial break-even point. First plan financial break-even point 0. Second plan 8000. Last plan 8000 divided by 1 minus 0.35. 8000 divided by 1 minus 0.35. 12,308. So try 10th question, June 23, 6 marks question. Try 10th question. If you have any doubt, I will explain, otherwise do it. Capital turnover ratio means, always turnover ratio means numerator turnover. So capital turnover ratio means sales divided by capital. Sales divided by capital. So try question number 10. Self-examination. And suggest which plan has a more financial risk. Obviously, the plan which is having a more debt will have a more financial risk. Clear, Vamshi? So, in question number 10, second part, there is a mistake. Plan B, financial break-even point 60,000 plus 15,000 divided by 0.75. Answer is what? 1,20,000. 1,20,000 is the answer, Shivapriya. Okay, clear? So we have completed what? Sorry, 80,000. I'm sorry, 80,000. 60,000 plus 20,000. 80,000 is the answer. So please make a correction, okay, Vamshi? 60,000 plus only 50,000, 15,000 divided by 0.75. You will get 20,000. So 60,000 plus 20,000, 80,000, not 1,20,000. Clear? Done? Next, capital structure theories. So there are 4 theories, capital structure theories: net income approach, net operating income approach, approach, traditional approach. Smiley Vandamma. Okay. First approach. What is the first approach? Net income approach. Net income approach. So the approach is, as per this approach, with the increase in proportion of debt, with the increase in proportion of debt in capital structure, proportion of debt in capital structure, the overall cost of a capital decreases and value of a firm increases, and vice versa. As per this approach, with the increase in capital structure, with the increase in so as per this approach, with the increase in what proportion of a debt in capital structure, the overall cost of a capital decreases and value of a firm increases, and vice versa. So because the reason is debt is cheaper than equity. So in first class we have discussed debt is cheaper than equity. Why debt is cheaper than equity? 3 reasons. Debt is cheaper than equity. Tax savings on interest. Flotation cost in case of debt is less than flotation cost of a equity, and expectation of a debt holders will be less than what expectation of a equity shareholders. Yes or no? So debt is cheaper than equity. పోలింది ఏంటి పేషెంట్లు అయిపోయి అప్పుడే. So clear? Net income approach. So let us take an example. Babu, example. So let us see the example for first approach, net income approach. With the increase in debt proportion, the overall cost of a capital decreases and value of a firm increases. Let us see the example. Source. Equity, debt. Okay, equity and debt. Let us assume equity is equal to proportion 0.8, debt proportion 0.2. Equity proportion 0.8, debt proportion 0.2. So cost of equity will be greater than what cost of a debt. Debt will be cheaper than equity, yes or no? So let us assume the specific cost. Cost of equity 20%, cost of debt 10%. So 0.8 into 20, 16, 0.2 into 10, 2. 18% is the overall cost of a capital. And the value of firm is equal to EBIT divided by KO. Let us assume EBIT is equal to 3 lakhs. So 3 lakhs divided by 18% is the value of a firm. So 3 lakhs divided by 18%. What is the value? 16 lakh. 16 lakh 66,667 rupees is the answer. Am I clear? So with the increase in proportion of a debt, overall cost of a capital decreases. So for example, let us change the proportions. Second case B, let us increase the proportion of what? Debt. So 0.5. We are increasing the proportion of a debt. So earlier the proportion of debt is 0.2, now it is 0.5. So proportion into specific cost, 0.5 into 16, 8, 0.5 into, sorry, not 0.5 into, 0.5 into 20, 10, 0.5 into 10%, 5, overall 15%, and the value is equal to 3 lakhs divided by 15%. This is net income approach. And in capital structure theories, there are few assumptions. We take few assumptions. First assumption, we consider only two sources. We assume there are only two sources, that is equity and debt. I mean, no preference share capital. We assume that there are no corporate taxes. All the firms belongs to the same business risk class. Okay, business risk class. So first approach is what? If with the increase in proportion of a debt, the overall cost of a capital decreases. That is what happened here. 18% is the previous cost of a capital, and 15% is the cost of a capital in second case, and the value of firm is increasing. What is the reason behind this? The reason is debt is cheaper than equity. So that's why with the increase in debt proportion, the overall cost of a capital decreases. Am I clear? Next approach. What is the next approach? Net operating income approach. Net operating income means nothing but what? EBIT. Net income means profit after tax. Net operating income means EBIT. Both are different, okay? Net operating income is nothing but EBIT, earnings before interest and tax. So clear? Now net operating income approach. So this approach is capital structure decision is irrelevant to the value of a firm. What this approach is saying? This approach is saying that the capital structure decision is irrelevant to the firm. Whether you increase the debt proportion or not, value of firm will remain same. Okay, in previous case what we are saying that with the increase in debt proportion, the overall cost of capital decreases and value of firm increases. But now this approach, what is this approach is saying? Capital structure decision is irrelevant to the value of a firm. Nothing but. So capital structure decision is what? Capital structure decision is irrelevant to the value of a firm. That means whether the firm is a levered firm or unlevered, the value will remain same. whether you increase debt proportion or decrease, still value of firm will remain same. Okay. So nothing but sir, in previous question we are saying that with increase in debt proportion overall cost of a capital decreases. Yes or no? So that logic is not completely correct. Okay. Second case, the logic is, let us take an example. What is the net operating income approach? Capital structure decision is irrelevant to the value of a firm. Let us take an example, the same example. Example 2, case A. Case A, already done case A. Case A, overall cost of a capital is equal to 18%, right? And value of a firm is equal to 16,66,667. Next, case B. Case B. Case B. Source, proportion, specific cost, proportion into specific cost. I am continuing the first example, previous example. Source, equity, debt, proportion 0.5, 0.5. What is the cost of debt? 10%. So 10 into 0.55. So as per the net operating income approach, irrespective of a capital structure, the overall cost of a capital remains same and value of a firm will also remain same. That means the overall cost of capital will be same, 18 only. Overall cost of capital will be 18. It will remain same, 18. And the value of firm will also remain same, 16,66,667. So the capital structure decision is not going to affect the value of a firm. So simple. Why? Because the reason is, with the increase in debt proportion, what happens to the finance risk? With the increase in debt proportion, the finance risk increases or decreases? Finance risk increases. If a finance risk taken by the equity shareholders increases, then obviously the expectation of equity shareholders will also increase. This already we have seen in cost of a capital chapter in one question. Yes or no? Nothing but the expectation of equity shareholders increases. Earlier their expectation was 20%. But now, as the proportion of debt has got increased, their expectation will increase to what? Increases to 26% and will offset, and the overall cost of capital will remain same. So what is the logic given by net operating income approach? With the increase in debt proportion, no doubt overall cost of a capital has to decrease because debt is cheaper than equity. But it will get offset. It will get offset because due to increase in the debt proportion, the expectation of equity shareholders, KE, increases. KE increases. If K increases, what happens to overall cost of capital? Overall cost of capital increase. Because of debt, overall cost of capital has to decrease. But due to increase in KE, again the overall cost of capital will increase and both offset and the overall cost of capital will remain same. So this is what net operating income approach. So okay, even though debt is cheaper than equity, with increase in proportion of debt, the KE increases and the overall cost of capital will remain same. Clear example? Is it clear? What is this approach? Net operating income approach. Net operating income approach. Okay. So nothing but as per net operating income approach, value of a levered firm is equal to value of a unlevered firm. Value of a firm which is using debt is equal to value of a 100% equity firm. Value of a 100% equity firm. Clear? This is net operating income approach. Next, approach. For all capital structure theories, we assume there are no taxes. There are no taxes. Approach, Modi-Gilani-Miller approach. approach is same as NOI approach. Modi-Gilani-Miller approach is same as NOI approach. Okay. So the difference is approach has given a justification, behavioral justification. Approach has given a behavioral justification. Net operating income approach, okay, fine, justification is given, but behavioral justification is not given. For example, what I was saying, with the increase in debt proportion, KE increases. Okay, fine. KE might increase to 24, 25, 27, 28. Why exactly 26? KE might increase to what? 24, 25 or 28, 29 or something. Why only 26? How can it be exactly offset? How can it be exactly offset? That behavioral justification was not given by the net operating income approach. Are you getting my point? So it is convincing. To what extent? Due to increase in the debt proportion, as the debt is cheaper, overall cost of capital has to decrease, but it is not decreasing because due to the increase in KE. Okay. So KE is increasing. If KE is increasing, what? Overall cost of capital. So if a KE has to increase to what? Instead of 20, it has to increase to 24, 25, 27, 28. There are many numbers. Why only 26? Why it can be exactly offset? That behavioral justification was not given by NOI approach. అర్థమవుతుందా? అలా ఎలా ఆఫ్సెట్ అవుతుంది? కరెక్టే, డెట్ ప్రపోర్షన్ ఇంక్రీజ్ అయితే కేఈ ఇంక్రీజ్ అవ్వాలి. మరి 26 ఎలా? ఎగ్జాక్ట్గా అలా ఎలా ఆఫ్సెట్ అవుతుంది? దట్ జస్టిఫికేషన్ వాజ్ నాట్ గివెన్ బై NOI approach. So that behavioral justification was given by approach. Approach through an arbitrage process. Through an arbitrage process. Arbitrage. So approach has given a justification, behavioral justification through an arbitrage process. What is this arbitrage? Arbitrage process. Generally, if the asset is overpriced, we sell it, and if it is underpriced, we buy. Overpriced, sell. Underpriced, buy. Overpriced, sell. Underpriced, what? Buy. Am I clear? Okay. For example, yesterday we have seen one example. For example, in your perception, 1 acre land rate in bypass, okay, 4 crores. What is the land cost on bypass? 4 crores, 1 acre land. But whereas the market value of 1 acre is 1 crore. Okay, in the market, land is undervalued or overvalued? Overvalued. Undervalued. Because in our perception, so the land beside, okay, so BCCA is 1 acre 4 CR. This is our perception. But whereas in the market the price is 1 CR. Undervalued or overvalued? Undervalued, underpriced. Are you going to buy or not? డబ్బులు ఉన్నాయి అనుకోండి. Are you going to buy or not? Yes, you are going to buy. So underpriced అన్నప్పుడు ఏం చేస్తాం? Buy. Big billion days. You feel that Okay, so you do shopping, right? You feel that the mobiles are underpriced during big billion days, right? If it is overpriced, for example, in your perception the land rate is 1 acre 4 cr, but in the market the price is 8 cr, overvalued. ఏం చేస్తాం? అమ్మేస్తాం. ఉందా? సో ఒకవేళ ఇన్ కేస్ ల్యాండ్ ఉంటే, ఇన్ కేస్ మన దగ్గర ల్యాండ్ ఉంటే ఏం చేస్తాం? సేల్ చేసుకుంటాం. బికాస్ ఇన్ అవర్ పర్సెప్షన్ ల్యాండ్ వాల్యూ ఇస్ 4 cr, బట్ ఇన్ ద మార్కెట్ ద వాల్యూ ఇస్ 8 cr. సో సెల్. So basic fundamental in final again this concept will get repeated. Whenever you feel the asset is overpriced, sell. If it is underpriced, buy. Always a mother feels a gold is underpriced, so that's why she keeps on buying a gold. Yes or no? Undervalued. ఇప్పుడు తక్కువ ఉంది, ఫ్యూచర్లో ఏంటి పెరిగిపోద్ది హంచిక. సో so buy. Overpriced what? Sell. Overpriced means what? Sell. Clear? Approach. Approach has given a behavioral justification through a arbitrage process. Through an arbitrage process. What is this arbitrage process? As per approach, value of a levered firm is equal to value of a unlevered firm, because capital structure is not going to affect, capital structure decision is not going to affect value of a firm. So levered firm value will be equal to unlevered firm value, and the assumption is both the businesses both the companies are in same business, both the firms are in same business. The only change is capital structure. The amount of investment is also same. Okay, as per approach, value of a levered firm is equal to value of a unlevered firm. That has to be equal. For suppose it is not equal, if it is not equal, then an arbitrator means a person who has a rational knowledge, reasonable knowledge, a person who can take a reasonable judgment. Arbitrator, he will identify the market imperfection. So as per the theory, value of a levered firm must be equal to value of a unlevered firm. For suppose if it is not equal, then arbitrator, okay, an intelligent person like Hanchika, they will identify the market Nautavend Gautami. Okay, so value of a levered firm is equal to value of a unlevered firm. For suppose if, okay, in market levered firm value is not equal to unlevered firm. For example, levered firm value is equal to 3 lakhs and unlevered firm is equal to 2,50,000. Okay, so which firm is overvalued, levered or unlevered? Levered is overvalued. Levered is overvalued. Adotna. So two firms are doing a same business, same amount of capital, will get a same EBIT, same benefit. But for the time being, levered firm value is 3 lakhs, unlevered firm value is 2,50,000. Arbitrator, a person who can take a reasonable judgment. What that person will do? That person will sell the stake in levered firm and will buy the stake in unlevered firm, because levered is overvalued, unlevered is undervalued. Okay, let us assume 10% stake, 10% shareholding is there for Vinod in levered firm. So what he is going to do? He will sell stake in levered firm and will buy stake in unlevered firm. He is rational. Okay, he can understand where to buy and where to sell. So he will be selling the stake in levered and he will be buying the stake in unlevered. If he keeps on selling the stake in levered, then levered firm value decreases and he keeps on buying stake in unlevered firm value increases. At one point of time, both will reach to an equilibrium point. Both will become equal. That means for the timing they may not be equal. For the timing they may not be equal. But an arbitrator will do an arbitrage process and will make them equal. So this behavioral justification is given by Modi, Gilani, Miller. Okay. So approach is also same as what NOI approach, net operating income approach. Net operating income approach. Okay. So I think in CMA Inter they are not asking questions from arbitrage process. Okay. So that's why I am not discussing problem relating to arbitrage process. Just I am discussing the concept. So arbitrator will sell in overvalued and buy undervalued. So over a period of time, what happens to the overvalued? Overvalued decreases, undervalued increases. At one point of time, they both become equal. Clear? This is approach. Modi, Gilani, Miller approach. So clear? Next what? Traditional approach. Samira. Traditional approach. Okay. Traditional approach, Charan. So traditional approach already we have discussed in question number 1. Traditional approach, question number 1. So this one is, what is net income approach? With the increase in debt proportion, overall cost of capital decreases and value of firm increases, and vice versa. Yes or no? Now traditional approach. What is the traditional approach? See the question number 1. So what is the traditional approach? With the increase in debt proportion, the overall cost of capital decreases and value of firm increases up to a certain extent. Beyond that, reverse trend emerges. Reverse trend emerges means what? With the increase in proportion of debt, the overall cost of a capital increases. So that is what happened in question number 1. Option 1 and option 2. Okay, up to option 2, overall cost of capital decreased. But beyond that, overall cost of capital has got increased. Okay, so traditional approach. What is the traditional approach? With the increase in debt proportion, the overall cost of capital decreases and value of firm increases up to a certain extent. Thereafter, reverse trend emerges. Reverse trend means, Dilip. Reverse trend means, with the increase in proportion of debt, overall cost of capital increases and value of firm decreases. So this is what traditional approach. Question number 1. Question number 1. So what is the logic behind this? Because cost of debt increases. From one side cost of debt increases, and on the other side cost of equity will also increase. So that's why beyond certain point, the overall cost of capital increases with the increase in proportion of our debt. So this is what traditional approach. Clear, Charan? Clear, Karthik? Advain, question number 1. Question number 1. Cheppama Bangaradalli. Bye చెప్తున్నాడా? Okay. Next, model with taxes. Model with taxes. Introduction లో చెప్పలేదు కదా ఇది. హ్యాపీ ఫీల్ అయ్యారు కదా అయిపోయిందని. model with taxes. model with taxes. ఒకసారి చూడండి. Next one is model with taxes. So this is important one, model with taxes. Previously we have discussed model without taxes. When there are no taxes, value of a levered firm must be equal to what? Value of a unlevered firm as per approach. But now we are discussing model with taxes. Model with taxes. Write down the example. Particulars, case A, case B. Vasan, case A, case B. In particulars, equity, 10 lakhs, 20 lakhs is equity, 20 lakhs, 10 lakhs. 10% is debt nil and 10 lakhs. 20 lakhs, 20 lakhs. Okay, 20 lakhs and 20 lakhs. Next, EBIT. Earnings before tax will be same or not? Yes. EBIT must be same. Why the EBIT must be same? Because amount of investment is same. They are doing same business. So that's why the return on investment will also be same. 4 lakhs and 4 lakhs. EBIT. Minus what? Interest. First case 0. Second case 1 lakh. Earnings before tax. Now to rayali. 4 lakhs, 3 lakhs. So let us assume there are no taxes as of now. First example, there are no taxes. So then this EBT is earnings after tax. 4 lakhs and 3 lakhs. Clear? ఏం రాశాడు? ఏమైంది? డాక్టర్ రైటింగ్. EBT, EAT, 4 lakhs and 3 lakhs. So this EAT is nothing but what? Earnings available to equity shareholders. Clear? Clear? So what about earnings available to investors? Earnings available to investors means investors includes equity and debt. Investors includes equity and debt. Sirisha. So is equal to 4 lakhs. Earnings available to investors. Earnings available to investors. Investors includes equity and debt. So 3 lakhs plus 1 lakh. 4 lakhs. That means in both the cases, investors will get same benefit. In both the cases, investors will get same benefit. So that's why when there are no taxes, value of unlevered is equal to value of a levered firm. Value of unlevered is equal to value of a levered firm when there are no taxes. But when there are taxes, same example, when there are taxes, EBIT 4 lakhs, 4 lakhs minus interest 0, 1 lakh. Earnings before tax 4 lakhs, 3 lakhs. Let us assume the tax rate is equal to 30%. Tax at the rate of 30%. 1.2 lakhs, 0.9 lakhs. Earnings after tax or earnings available to equity shareholders 2.8 lakhs, 2.1 lakhs. 2.1 lakhs is the earnings available to equity shareholders. Now tell me, earnings available to investors. Investors includes what? Equity and debt. So tell me the earnings available to investors. First case 2.8. First case only 2.8. Second case, Naidu. 2.1 plus 2.1 plus 1 lakh. 3.1 lakhs. When there are no taxes, earnings available to investors is same in both the cases. But when there are taxes, earnings available to investors in case of a levered firm is greater than unlevered firm. Yes or no? Yes or no? Okay. Why? What is the reason, Charan? What is the reason? What is the reason? Because in second case, we are saving a tax. We are saving a tax on payment of a interest. On payment of interest, tax is saved. If you see the difference amount is 30,000. Difference amount is 30,000. And what is the logic behind this 30,000? How do we got in levered firm extra earnings? Levered firm extra earnings is equal to levered firm extra earnings is equal to levered firm extra earnings is equal to మీరు డల్గా ఉంటే మార్నింగ్ 6 o'clock క్లాస్ ఉంటుంది, మళ్ళీ నవ్వుతూ ఉంటే 9:30 స్టార్ట్ చేయొచ్చు. చరణ్ నవ్వట్లా. Charan, he is not smiling, so that's why class will be at 6 o'clock. Levered from extra earnings. Levered from extra earnings 30,000. Levered from extra earnings 30,000. Sorry, Naidu, on behalf of these indecent fellows. So levered from extra earnings. Levered from extra earnings 30,000. మంచిగా ఏడుస్తుంది 4K క్లాస్ అయితే. లీవర్డ్ ఫ్రమ్ ఎక్స్ట్రా ఎర్నింగ్స్ 30,000. సో 30,000. సో how do we get this 30,000? Because we are saving tax on interest. What is that interest? 1 lakh. Tax rate is 30%. Nothing but levered firm will get an extra earnings when there are taxes. When there are taxes, levered firm will get extra earnings. What are these extra earnings? Interest into tax rate. Interest into tax rate. Okay. As we have already discussed, if a benefit increases, wealth value increases. Levered firm investors are getting extra earnings, so that's why the levered firm value will be greater than what? Unlevered firm value. That means value of a levered firm is equal to value of a unlevered firm plus value of a levered firm is equal to value of a unlevered firm plus. Why value of unlevered firm plus? Because in levered firm we are getting extra earnings because of tax savings on interest. Clear? So that's why value of a levered firm is equal to value of a unlevered firm plus debt into tax rate. Some students might get a doubt, sir, extra earnings is equal to interest into tax rate, extra earnings, but you are taking an extra value of debt into tax rate. Okay, why I am taking this debt into tax rate? Because levered firm is getting extra earnings of a interest in tax rate. Every year it will get extra earnings of a interest in to tax rate. How many years it is going to get? Indefinite period. Indefinite period. We have discussed 5 examples in time value of a money. 4th example, when you are getting a benefit for indefinite period, how to find out the value? Value is equal to benefit divided by required return. Benefit divided by required return. So This interest into tax rate is not a value, wealth. That is an extra earnings, profit. I have to capitalize. I have to find out the value. How can I find out the value? Value is equal to benefit. What is the benefit? Interest into tax rate divided by required return. What is the required return for debt? Interest rate is the required return. Interest divided by interest rate is nothing but what? Debt. Interest divided by interest rate is nothing but what? Debt. So that's why the value of a levered firm is equal to value of a unlevered firm plus debt into tax rate. So when there are taxes, levered firm value will be greater than unlevered firm value by debt into tax rate. Clear? So this is what model with taxes. Model with taxes. So clear? Okay. So we have discussed all the concepts in capital structure. Okay, chapter. So problems, you have to solve the problems. Problem solve cheyandi. Okay. ఒకసారి రేపు చెప్పవన్. నెక్స్ట్ టాపిక్ డివిడెండ్ డెసిషన్స్. Financial management includes investment decision, financing decision and dividend decision. Financing decision means from where to procure money. Investment decision means where to invest money. Dividend decision means whether to declare a dividend or not. So whether to declare a dividend or not. Okay. So there are 4 approaches in our syllabus. 4 approaches. So first one, Walter's model. Walter's model is a relevance approach. So first point, dividend means nothing but what? Distribution of profits. Profit distributed among the shareholders is called as what? Dividend. Dividend can be a final dividend or interim dividend. Interim dividend means dividend paid in between two annual general meetings. So dividend is paid if it is recommended by the board of directors and then approved by the shareholders in a general meeting. Okay. Approved by the shareholders in a general meeting. Am I clear? Next, approved by the shareholders in a general meeting. So now the point is, board of directors to recommend payment of a dividend, first they use these models, relevance approaches and irrelevance approaches. So in relevance approach, the first approach is Walter model. So that is simple. Walter model. Walter model, it is a relevance approach. That means dividend decision is going to affect the market price of a equity share. Okay. So this is a relevance approach. That means dividend decision is relevant to the market price of a equity share. So relevance approach. So this is a simple approach. If R is greater than KE, KE means cost of equity, R means a return on a equity. If R is greater than KE, then optimum payout ratio is equal to 0. Optimum payout ratio 0. If R is greater than KE, if return on equity is greater than KE, optimum payout ratio is equal to 0. If R is less than KE, if R is less than KE, optimum payout ratio is equal to 100%. Optimum payout ratio is equal to 100%. Next, if R is equal to K, if R equal to K, if R is equal to K, optimum payout ratio is equal to indifferent. Indifferent means whether you pay dividend or not, that doesn't make any difference. Whether you pay dividend or not, that doesn't make any difference when R is equal to K. This is a simple common sense method. K means a required rate of a return of a equity shareholders. Required rate of a return of a equity shareholders. For suppose equity shareholders are expecting 20%. Equity shareholders are expecting 20%. Okay. So equity shareholders are expecting 20%, and by investing, instead of distributing the dividend, if a company retains the earnings and if it reinvests, it can earn 20%. What is the required return I told? For suppose if required return of a equity shareholders is, let us assume 15. Required rate of a return of a equity shareholders is 15%, but whereas company can earn 20% on a reinvestment. For example, company is having 100 crores profit. Okay. Company is having two options. One thing, pay off the dividend, pay entire amount as a dividend, or retain 100 crores and reinvest in a business. Yes or no? If a company can reinvest, it can earn 20%. If a company reinvest this 100 crores, it can earn 20%. What is the expectation of equity shareholders? 15%. Expectation of equity shareholders is 15%. Now, it is better to pay zero dividend. Why it is better to pay zero dividend? Simple logic. They are expecting 15%, but the company is able to generate 20% return. Company will be able to meet their expectation. Company will be able to meet their expectation. When company meets their expectation, the value increases. The value increases. So that's why when R is greater than KE, optimum payout ratio is equal to 0. Do not pay any dividend because company is able to generate more than what they are expecting. For suppose if R is less than KE, okay, R is less than KE, for example, R 10%, but whereas KE 15%. Equity shareholders are expecting 15%, but the company could earn only 10%. So now tell me, what is the optimum payout ratio? Optimum payout ratio is equal to 100%. Optimum payout ratio is equal to 100%. So clear? Next, R equal to K. They are expecting 15 and company could earn 15. Then optimum payout ratio indifferent. You pay 100%, you pay 0, you pay 50%. So still the market price will remain same. So Walter logic is simple. If you can meet their expectation, then retain 100%. If you cannot meet their expectation, pay off. Okay. So optimum payout ratio will be either 0 or 100%. Okay. And Walter has given a formula for price of a share. Formula for price of a share. And this formula is similar to fourth example. We have discussed in time value for money. Fourth example. Fourth example. So what is the fourth example? Benefit for indefinite period. Benefit for indefinite period. So benefit for indefinite period. So price P is equal to, P means price of a equity share. P means price of a equity share. So price of equity share is equal to, already we have learned one formula. Price is equal to D1 by KE minus G. D1 by KE minus G. That formula is similar to fifth example. Cash flow for indefinite period with growth rate. Okay. So now Walter has given a formula for price of a share, price of a equity share. P is equal to, on equity share, what benefit the equity shareholder is going to get? The equity shareholder is going to get dividend. Equity shareholder is going to get dividend. So D plus D plus. Okay. So he is going to get dividend. For how many years? Indefinite period. Investor is going to get dividend for indefinite period. So that's why D plus R by K into E minus D divided by K. So if you observe the formula, P is equal to D divided by K, yes or no? First part D divided by K. D divided by K means nothing but you are going to receive a dividend for indefinite period. If you are going to receive a benefit for indefinite period, then what is the value? Simple. Dividend benefit divided by required return. So that is what we are writing here. D divided by K plus what? We are taking a second component. What is that second component? E minus D. What is that E? E means earnings per share. E means earnings per share. So earnings per share minus dividend per share. Earnings per share minus dividend per share. Then you will get retained earnings per share. Yes or no? Earnings available to equity shareholders minus equity dividend. Retained earnings. Okay. So EPS minus earnings per share minus dividend per share. The remaining amount is what? Retained earnings. For example, earnings per share 10. Dividend per share 5 rupees. 5 rupees is a retained earnings. Okay. What is the purpose of retaining that 5 rupees? Reinvestment. So that 5 also belongs to the equity shareholders. But company is not paying as on today. Company is reinvesting that 5 rupees. That means investor is going to get R on that 5. Company is reinvesting that 5 rupees. So the investor is going to get a return on that 5 rupees. So that's why we are taking R into E minus D. He will get return on retained earnings. And again in that return, some portion will be retained and that will be reinvested in next year. And again he will get return and again some portion of that extra return will be retained and again reinvested. So that is a continuous process. Every year certain sum of earnings will be retained and reinvested. Okay. So that's why investor is getting a benefit of dividend and also is getting an extra benefit of return on a retained earnings. Return on a retained earnings. We should bring that return on a retained earnings to the present value. So that's why what we are dividing with K. Why 2 times? Because there will be an exponential. Exponential means, for example, first year 5 rupees retained. On 5 rupees, so company will get a return next year. Yes or no? Again in that return, some portion will be retained and okay, again we will get return. Are you getting my point? For example, first year 5 rupees retained. Let us assume 20% is the return. You will get 1 rupee. Again in that 1 rupee, 50%, 0.5 will be retained, and again in that 0.5, 20% return. Are you getting my point? So you will get 0.1. Again in that 0.1, 20% will be retained and reinvested. Again in that 50% will be retained and reinvested, and again company will get 20% return. So that is a continuous process. So that's why we are dividing R into E minus D 2 times. Divide by KE and divide by KE. So this is a formula given by Walter model. So Walter model is simple. If R is greater than KE, you pay off 0 dividend. Then your price per share will be maximum. Price per share will be maximum. So let us take one example. Earnings per share is equal to 10. Earnings per share is equal to 10. R is equal to 20%. R is equal to 20%. K is equal to 10%. K is equal to 10%. KE is equal to what? 10%. Now tell me, R is greater than KE, right? R is greater than KE means dividend payout 0. What is the best payout ratio? 0. First suppose, what is the best payout ratio? Dividend payout ratio must be equal to 0. Then price equal to, you are not paying any dividend. So that means 0 plus return 0.2, KE 0.1 into earnings 10 minus dividend 0 divided by 0.1. So the answer is 200 rupees. 200 is the answer, price of a share. So this is the maximum price per share. This is the best one. When R is greater than KE, pay no dividend. Then your price will be maximum. For suppose if you are paying 50%, if dividend payout ratio is equal to 5, dividend payout ratio 5 means, what is dividend payout ratio actually? 50% means what does it mean? If earnings are 100, 50% is paid as a dividend. So 1 minus dividend payout ratio is retention ratio. So payout ratio 50% means retention ratio 50%. Retention ratio 50%. So P is equal to 5, yes or no? 50% is paid as a dividend. So 5 plus 0.2 divided by 0.1, 10 minus 5 divided by 0.1. So price is equal to what? 150. So tell me which is the best one, 200 or 150? Objective is to maximize the wealth, value of a share. So 200 is the best one. First suppose if you are paying out 100%. First suppose if dividend payout ratio is equal to 100%. Then P is equal to what? 10 divided by 0.1. Because second part will become what? 0. Earnings 10 rupees, dividend 10 rupees. So E minus D is 0. So 100 rupees. So which is the best one? First category, yes or no? So that means when R is greater than KE, optimum payout ratio 0. If you are paying 0 dividend, then price will be maximum. But however, if R is less than K, R is less than K, so 100% payout ratio. For example, if R is less than K, for example, let us assume R is equal to 8%. R is equal to what? 8%. If R is equal to 8%, then 0 plus 0.08 divided by 0.1 into 10 minus 0 divided by 0.1. So the answer will be 80. Okay. Next, second case. Second case. What is the second case? 5 plus 0.08 divided by 0.1 into 10 minus 5 divided by what? 0.1. Answer 90 rupees. Next what? Ten divided by what? 0.1. 100 rupees. 100 rupees. So which is the best one? Last one, right? So if R is less than K, then optimum payout ratio is equal to 100%. So simple. For suppose if R is equal to K, if R is equal to K, if R is equal to K, then what? No difference. Let us assume R is equal to 10%. R is equal to 10%. Then first case. What is the first case? 0 plus 0.1 divided by 0.1 into 10 minus 0 divided by what? 0.1. 100 rupees. Second case. 5 plus 0.1 divided by 0.1 into 10 minus 5 divided by 0.1. You will get 100. 100 rupees, not percentage, Sirisha. Last one, again same, 10 divided by what? 0.1. 100. Indifferent. Indifferent means what? No difference. Whether you pay dividend or not, that doesn't make any difference if R is equal to KE. So this is what? Walters model. Walters model. Clear? Walters model. So simple model. Next, Gordon's model. Next what? Gordon's model. Gordon's model. So this already we have discussed Gordon's model. Gordon's model. P naught is equal to D1 divided by KE minus G. D1 divided by KE minus G. Nothing but we can write it as D naught into 1 plus G. 1 plus G divided by what? KE minus G. KE minus G. Here G means what? Growth rate. How do we get growth rate? Growth rate is equal to B into R. B means a retention ratio. R means return on equity. Growth depends upon two components. Already we have discussed, right? Bharat, drinker, retention ratio 0, growth 0. Growth 0. Yes or no? Okay, I think second case, which is the second example, retention ratio 100%, but return on equity 0. Then also growth 0. Third category, గుర్తున్న ఎగ్జాంపుల్ చెప్పానా? థర్డ్ ఎగ్జాంపుల్ ఎవరు? బాలాదిత్యనా? Abhi 100% retaining. Next what, he is giving that money to what? Wife, and she is reinvesting. So there will be a growth. So growth depends upon what? Two components, retention ratio and return on equity. Simple common sense adi. Growth. Okay, Rakesh grandfather retain చేశారు, రిటైన్ చేయలేదా? గ్రాండ్ ఫాదర్ రిటైన్ చేస్తుంటే గ్రోత్ ఉండేది కదా, రిటైన్ చేయలేదు. అర్థం 100కో 50కో ఎకరం అమ్మేసి ఉంటారు, అవునా? సో బైపాస్ రోడ్లు అది కూడా. సో గ్రోత్ డిపెండ్స్ అపాన్ వాట్? టూ ఫ్యాక్టర్స్. One is retention ratio, second one is what? Return on equity. So clear? So G is equal to B into R. So investors will expect a high. If a retention ratio increases, investors expectation what? Increase. Okay. So and further we can write this formula as E1 into 1 minus B divided by KE minus BR. KE minus BR. E1 into 1 minus B. B is nothing but what? Retention ratio. 1 minus retention ratio is dividend payout ratio. E1 means earnings per share. So earnings per share into dividend payout ratio is equal to nothing but dividend. Earnings per share into dividend payout ratio is nothing but what? Earnings per share into dividend payout ratio is nothing but dividend. Nothing but what? Dividend. Okay. So clear? So E1 into 1 minus B. What is that E1 into 1 minus B? B is retention ratio. 1 minus retention ratio is equal to dividend payout ratio. Earnings per share into dividend payout ratio, dividend, divided by what? KE minus BR. KE minus what? BR. Okay, KE means cost of equity, B means retention ratio, R means return on equity. Am I clear? So this is the formula. Okay, so here also the same. This is also a relevance approach. If R is greater than KE, what? If R is return on equity is greater than KE, 100% retain. If R is less than KE, okay, 100% payout. And if R is equal to KE, indifferent. If R is equal to KE, indifferent. So clear? So this is what Gordon model. Next, MM model. Next what? MM model. MM model is a irrelevance approach. Irrelevance. In capital structure also he is saying the same thing. Capital structure decision is irrelevant to the value of a firm. Whether it is levered or unlevered, value will remain same when there are no corporate taxes. Here also he is saying the same. I mean, whether you pay dividend or not, that is not going to affect the price of a share. That is not going to affect wealth of a equity shareholder. What is this MM approach? MM approach is what? Irrelevant approach. MM approach is irrelevant approach. Okay. Irrelevant approach means whether you pay dividend, whether you pay dividend or not, it is not going to affect, it is not going to affect, it is not going to affect price, sorry, wealth of, it is not going to affect wealth of a shareholder. Whether you pay dividend or not, it is not going to affect the wealth of a shareholder. For example, company is paying a dividend. Wealth of a shareholder is 1000, example. Company is not paying dividend, then also the wealth of a shareholder will be 1000 only. So wealth of a shareholders will remain same. That means the dividend decision is irrelevant to the what? Irrelevant to, I mean, it is not going to affect the price of a equity share. Price of a equity share. I mean, wealth of equity share. Wealth of a equity shareholder. Wealth of a equity shareholder. So let us see the questions. Question number 1 is simple. X Limited earn rupees 6 per share having capitalization rate. Capitalization rate means nothing but KE, 10%, and has a return on investment at the rate of 20%. Return on investment at 20%. Return on investment, here return on investment is considered as return on equity. So both are same. Capitalization rate means what? Cost of equity, KE. According to Walter's model, what should be the price per share at 30% dividend payout ratio? They are asking you to find out the price of a share at 30% payout ratio. Simple question. What is earnings per share? 6. Dividend payout 30%. 30% means 6 into 30%, 1.8 plus R 0.2 divided by K 0.1 into what? 6 minus 1.8. Yes or no? R divided by K into E minus D divided by K. Yes or no? So what is the answer? 1 or 2? 1 or 2 is the answer. Clear? 1 or 2 is the answer. 1 or 2 is the answer. Am I clear? First suppose 1 or 2 is the answer. Am I correct? Next, is this the optimum payout ratio? No, this is not the optimum payout ratio. In case of Walter's model, optimum payout ratio will be either 0 or 100%. If R is greater than K, optimum payout ratio 0. That means 0 plus 0.2 divided by 0.1 into 6 minus 0 divided by 0.1. This is the best payout. This is the price at best payout ratio. What is the price? 120. So optimum payout ratio is 0. So illustration number 2 also the same. Illustration number 2 same. So go through the answer. If you have any doubt, I will explain. So let me explain illustration 2 also. From the following data, calculate the value of an equity share of each of the following 3 companies according to Walter's model when the payout ratio is nil, 25%, 50%, 75%, 100%. There are 5 cases, and in 5 scenarios we should find out the value of an equity share, not the payout ratio, value of an equity share. For 3 companies, in 5 scenarios, we should find out the price of a share. So total 15. Total what? 15 times we should find out. So first, what is the first payout ratio? Nil. First payout ratio, nil. First payout ratio, nil. Okay. So when you are paying nil, then, so what is the price per share? 0 plus dividend. 0 plus R by K. What is R? First company 15%. So 0.15 divided by 0.1. So there the answer is clumsy, but the calculation is what? P is equal to 0 plus R 0.15 divided by 0.1 into earnings per share 10 minus 0 divided by what? 0.1. You will get 150 is the price per share. Is first scenario. Likewise, we should find out for another 4 scenarios and also for other 2 companies. What are the other scenarios? Payout ratio 25, 50, 75, 100. Nothing but you are going to take a dividend 10 into 25. Second case 2.5. Third case 5 rupees dividend. Fourth case 7.5 rupees dividend. And last case 10 rupees dividend. Clear? Done? Okay, this question is not for practice because you know how to find out. Next, illustration number 3. From the following data, calculate the value of a equity share of each of the following 3 companies according to Gordon's model. Gordon's model means D1 divided by KE minus G. When dividend payout ratio is 25%, 50%, 100%. IRR is given 12%. Cost of a capital. IRR means return on investment. 12%. Cost of a capital KE 10%. Earnings per share 12. So what conclusion you are going to draw? So first case, what is the retention ratio? 25%. Growth depends upon 2 factors, retention ratio and return on a investment. First case, what is the growth rate? Growth rate. Payout ratio is 25%. Payout ratio 25% means retention ratio. Retention ratio 75%. So 75% into 0.12. 9% is what? Growth. 9% is growth. 9% is growth. Am I clear? Growth rate is what? 9%. Growth depends upon 2 factors, retention ratio and return on equity. In second case, what is the payout ratio? 70? 50%. So 50% means retention ratio 50. So 0.5 into return on equity 12%. Growth rate. Growth rate what? 6%. Okay. Next what? Last case. Retention ratio. Payout ratio 100%. That means retention ratio 0. Growth rate will be 0. Okay, clear? Done? So here there is a calculation. Divided by is missing. Price is equal to. What is earnings per share? 12. So 12 into 1 minus what? Retention ratio. 12 into 1 minus retention ratio. 1 minus retention ratio is equal to what? Payout ratio. So 12 into payout ratio 25%. So dividend will be 2, So 3, 3 rupees divided by KE. What is KE here? 0.1 minus growth rate 0.09. Huh? 300. 12 rupees earnings per share, right? What is the payout ratio? 25%. That means dividend is equal to what? 3 rupees. Dividend is equal to 3 rupees. Dividend is equal to 3 rupees. Okay. 3 rupees dividend. Dividend is equal to what? 3 rupees. Am I clear? So 3 rupees divided by what? KE minus growth rate. What is the growth rate? 9%. KE 10%. So that's why 3 divided by 0.1 minus 0.09. 300. Next case, price is equal to 150. And next case 120. If you observe this, the price is decreasing. The price is decreasing. Why the price is decreasing? Because R is greater than K. When R is greater than K, it is better to retain. It is better to retain. Because if you retain more amount, the growth rate will increase. If retention ratio increases, growth rate increases. Yes or no? Growth depends upon two factors: retention ratio and return on equity. Here R is greater than K, R is higher and retention ratio is also high. Then growth rate will increase. Growth rate will increase. See the price formula: D1 divided by KE minus G. Growth rate is coming in the denominator. So KE minus G. KE minus G. When growth rate increases, the overall KE minus G will decrease, which is in the denominator. Yes or no? The value will increase. So that is what happening. But whereas in second case, second company, I think for second company R is less than KE. When R is less than KE, when return on equity is less, growth rate will be less. Growth rate will decrease. So that's why if you see the market price per share, it is increasing or decreasing? It is increasing. As the payout ratio increases, market price is increasing. Clear? When last case, when R is equal to KE, market price is remaining same. In all the cases, 120. Because indifferent, whether you pay dividend or not, that doesn't make any difference. So this is Gordon model. Clear? So this is Gordon model. Next, Modi-Gilani Miller. Let us see the Modi-Gilani Miller model. Modi-Gilani Miller. So Modi-Gilani Miller says whether you pay dividend or not, that is not going to affect price, wealth of a shareholder. Wealth of a shareholder. Wealth of a shareholder is not going to change. Whether you pay dividend or not, the wealth of a equity shareholder will remain same. So let us see the question. B Limited belongs to risk class for which an appropriate capitalization rate is. What is appropriate capitalization rate? 10%. It currently has outstanding 2000 equity shares of rupees 100 each. How many shares are outstanding? 2000 shares. Price per share 100. The firm is contemplating the declaration of a dividend of rupees 8 per share at the end of the current financial year. At the end of a current financial year, they wanted to pay dividend 8 rupees per share. It expects to have a net earnings of rupees 20,000 and has a proposal for making new investment of rupees 24,000. It expects to have a net earnings of rupees 20,000 and has a proposal for making a new investment of rupees 24,000. Show that under the Modi-Gilani-Miller assumption, the payment of a dividend does not affect the value of a firm. So overall value of firm is not going to change. Overall value of firm, nothing but indirectly wealth of a shareholder is not going to change, will remain same. So that we have to prove. Okay. So write down the solution. Write down the information given. First question number. Question number 4. So what is the first information given? Capitalization rate, nothing but cost of a KE. Cost of a KE is equal to 10%. Cost of a equity KE is equal to 10%. Next, number of shares at the beginning. Number of shares at the beginning. Number of shares at the beginning, this is denoted with N. Number of shares at the beginning is equal to 2000. Next, price at the beginning. Price at the beginning, P naught. What is P naught here? 100 rupees. P naught is equal to 100 rupees. Price at the beginning, 100 rupees. Next, dividend per share. Dividend per share, okay, 8 rupees. D1. Company is considering a payment of a dividend of rupees 8. So what is the other information? Earnings. Earnings E is equal to earnings E is equal to 20,000 rupees. Earnings E is equal to 20,000 rupees. Clear? Next one. Investment. Investment I is equal to 24,000. Investment I is equal to what? 24,000 rupees. So this is the information given in the question. So Modi-Gilani-Miller approach. Dividend decision is irrelevant to the value of a firm. The value of firm is not going to get affected. Value of firm will remain same. And wealth of equity shareholders will also remain same. Okay. So first category. We should take two scenarios. If dividend is bucket, if dividend is paid, first scenario, if dividend is paid, so let us pay the dividend. So we have discussed the value of asset. How do we get the value of any asset? Whether it is equity share, preference share, plant and machinery, building, whatever it is, how do we get the value? We should bring the future benefit to the present value. So on the basis of that logic, we can write P naught is equal to P1 plus D1 divided by 1 plus KE. This is similar to P is equal to A divided by 1 plus I power N. P1 means price at the end of a first year. D1 means dividend at the end of a first year. Divide by what? 1 plus K. P1 price at the end of first year. D1 dividend at the end of first year. Divide by 1 plus K. So are you able to understand? Nothing but what? You know the principal formula. I mean, P is equal to A divided by 1 plus I power N. If N is equal to 1, we write only 1 plus I. So that is what we are writing here. Instead of interest rate, we are taking cost of equity, KE. So P naught is equal to P1 plus D1 divided by 1 plus KE. Okay. So P naught already given in the question, right? What is the P naught? 100 is equal to P1. We have to find out P1. We have to find out P1 plus D1. 8 rupees is paid as a dividend. Divided by what? 1 plus 0.1. P1 is equal to 102 rupees. P1 is equal to 102 rupees. Clear? That means if a dividend is paid, price at the end of a first year would be 102 rupees. Price at the end of a first year would be 102 rupees. Are you able to understand? Clear? Okay, clear? Next, second part. Amount to be raised by issue of new shares, or else you can write number of new shares to be issued. First part not yet completed. Number of new shares to be issued. Number of new shares to be issued. What is the investment size? Investment is equal to 24,000. Yes or no? Investment 24,000. Clear? So we are paying a dividend. How much dividend is being paid? 8 rupees. So minus retained earnings. Minus retained earnings. We are not going to issue new shares for entire amount of 24,000, because first we use retained earnings. The balance amount will be raised by issue of new shares. So how much retained earnings are available? What are the earnings? 20,000 is the current earnings. What is the amount of dividend paid? 2,000 shares into 8 rupees. Nothing but 16,000 rupees is paid as a dividend. Current earnings are 20,000. So that means 4,000 retained earnings. 4,000 retained earnings. That means 20,000 will be the amount to be raised by the issue of new shares. Okay. Nothing but this new shares is denoted as delta N. Delta N means a change in number of shares. Change in number of shares. Number of shares at the beginning, N is equal to 2000. Delta N means new shares. Change in new shares. Change in shares. So delta N, new shares. Delta N means what? New shares. How many shares are we going to issue? 20,000 divided by 102. because current price is 100. But by the time you issue the new shares, the price will be 102. 180? Okay, okay. So just take this amount, 2000 divided by what? Sorry, 20,000 divided by what? 102. So this is what? Delta N. Delta N. Clear? Delta N. Next, let us find out the value of a firm. Value of a firm is equal to, by the end of first year, value of firm will be N, number of shares at the beginning, plus by the end of first year, the number of shares will increase by delta N. Yes or no? This is the total number of shares, N plus delta N into P1. Into P1. You will get overall market value of our shares minus investment, because from this amount investment is made, plus earnings were used, minus investment plus earnings divided by what? 1 plus K. Because entire numerator is at the end of the first year. Entire numerator is at the end of the first year. So that is equal to, what is N? 2000 plus 20,000 divided by 102 into what? 102 minus investment 24,000 plus what? Earnings 20,000 divided by 1 plus 0.1. Understand the logic. By the end of a first year, number of shares will not remain same. As of now, there are 2000 shares. The new shares being added are 20,000 divided by 102. So total number of shares into price at the end of a first year 102 minus outflow investment plus earnings. So that is the value at the end of a first year. We should bring it to the present value. So that's why 1 plus K, 1 plus 0.1. So what is the answer? 1 lakh? 2 lakhs. 102 and 102 will get cancelled, right? 2000 into 102 plus 20,000 minus 24,000 plus 20,000 divided by 1 plus 0.1. Clear? Done. So this is when dividend is paid. This is the value of a firm when dividend is paid. Second case. What is the second case? Dividend is not paid. First, suppose if dividend is not paid, then P naught is equal to, what is the P naught right now? 100 is equal to P1. We have to find out, plus dividend 0. Dividend is not paid, 0 divided by what? 1 plus 0.1. So P1 is equal to 110 rupees. Wealth of a shareholder is not going to change. First, suppose if dividend is paid, shareholder will receive 8 rupees dividend and price of a share will be 102. Overall 8 plus 102, 110. His wealth is 110. If a dividend is not paid, then price of a share is equal to 110. So now also wealth will be same. Shareholder wealth is not going to change. Clear? So nothing but a company shareholder. Ultimately company belongs to shareholders only, right? ఇది ఎలా ఉంది ఇప్పుడు? ఫర్ ఎగ్జాంపుల్, ఫ్రమ్ మై పాకెట్ ఐఎమ్ గివింగ్ 8 rupees టు ద షేర్ హోల్డర్స్. ఓకే, when I am giving 8 rupees to the shareholders, price will decrease to 102. The overall wealth is 110. If I am not paying dividend, then the price will be 110. So wealth will be same. Ultimate company evardi? Shareholders దే కదా. మరి షేర్ హోల్డర్స్దే అన్నప్పుడు ఈ పాకెట్ ఎవరిది? షేర్ హోల్డర్స్దే, అవునా కదా? రీటైన్ చేసుకున్నా కానీ ఆ అర్నింగ్స్ ఎవరివి? షేర్ హోల్డర్స్. సో మోదీ గిలానీ మిల్లర్ అప్రోచ్ ఏంటంటే సింపుల్. సో రెండు పాకెట్స్ కూడా ఎవరివి? బిలాంగ్స్ టు ద ఈక్విటీ షేర్ హోల్డర్స్. సో వెల్త్ విల్ రిమైన్ సేమ్ వెదర్ యూ పే డివిడెండ్ ఆర్ నాట్. సో దట్ ఈస్ ద లాజిక్. సో 110 ఈస్ ద P1. నెక్స్ట్ వాట్? నెంబర్ ఆఫ్ న్యూ షేర్స్ టు బి ఇష్యూడ్. The number of new shares to be issued. What are the number of new shares to be issued? Number of new shares to be issued. First, you should take investment. What is the investment? 24,000. Minus what? Retained earnings. Retained earnings will not be 4,000. Retained earnings will be 20,000 because we are not paying any dividend. So 4,000 is the amount to be raised by issue of a new shares. Yes or no? New shares delta n is equal to, new shares delta n is equal to 4,000 divided by what? 110. 4,000 divided by 110. Okay, that is not relevant because to get exact answer, let it be 4,000 divided by 110. Next, what? Value of a firm. Value of a firm is equal to what? Value of firm is equal to, how many shares are there at the beginning? 2,000 plus new shares. 4,000 divided by 110 into what? 110 minus what? Investment 24,000 plus earnings 20,000, all divided by 1 plus 0.1. Again you will get the same amount, that is 2 lakhs. So irrespective of a dividend payment, the value of a firm will remain same. So dividend decision is simple chapter. So conceptually you have to learn these 3 questions, that's it. Walters, Gordon, Modi Gilani, Miller. So they will not be complicating. Clear? A value of firm is equal to 2 lakhs. Done? So next concept, working capital management. Working capital management. Okay. You will get 2 7 marks questions. 2 7 marks. So 14 marks question. Total 14 marks. Okay. And in last 3 attempts, so first question, working capital estimate. Working capital estimate. And second question, 2 times costing question, that is calculation of economic order quantity, reorder point, etc. 2 times. Okay. And one question is cash management. Cash management. So that is also similar to EOQ, economic order quantity. Economic order quantity. So working capital management. Procurement. So first financial management, two aspects are procurement of fund, effective utilization of fund. We procure fund from two sources, equity and debt. We utilize the fund for two purposes, fixed assets and current assets. Investment in fixed assets is considered as what? Capital budgeting. Investment in current assets, working capital management. Okay. So working capital. So first basic fundamental financial management rule is short-term need must be met from short-term source, long-term need must be met from long-term source, and medium-term need must be met from medium-term source. Okay, am I clear? So this is a basic fundamental financial management rule. Okay. The next. Working capital can be categorized as two types: permanent working capital, temporary working capital. Based on time. Working capital can be categorized into permanent working capital and temporary working capital. Working capital means what? Current assets minus current liabilities. So current assets, example, raw material inventory, work in progress inventory, finished goods inventory, cash, debtors. These are the examples for what? Current assets. Cash is a current asset. Debtors is also a current asset because it will be realized within less than 1 year. So debtors is a current asset. Raw material inventory is a current asset because raw material inventory will be converted into finished good and will be sold and realized within a year. If it is realized within a year, then it is categorized as current asset. So raw material inventory is a current asset, work in progress is a current asset, finished goods inventory is a current asset, and debtors, cash and bank balance, these are the examples for what? Current assets. So what about current liabilities? Trade creditors, example for current liabilities. Trade creditors is a current liability. Direct wages is a current liability. Wages payable, not direct wages, wages payable. For example, on March 31st, wages will be paid or not. For example, for the month of March, wages might be paid in the month of April. For example, March month wages will be paid on April 15th. That means nothing but wages are being delayed by how many months? 15 days. So 15 days. Wages are being delayed by 15 days. Okay. So wages payable, overheads payable, trade creditors. Nothing but we are purchasing raw material from the supplier, but we are not paying immediately. We are taking a 2 months credit period. So that is a current liability. So here working capital means working capital. Nothing but net working capital. Net working capital is equal to current assets minus current liabilities. Current assets minus what? Current liabilities. Okay. So current assets minus current liabilities is the working capital. So if they simply mention the working capital, that means what? Current assets minus current liabilities. That should be considered as a net working capital. So gross working capital means total current assets. Gross working capital means total current assets. Okay. Am I clear? Next, working capital on the basis of value and on the basis of time. Okay. So why we are learning this chapter? So first point, to estimate the investment in working capital. The main purpose is estimation of investment in working capital. how much amount to be invested in working capital. So 100 crores or 50 crores, we should determine the amount of a working capital. Why we should determine the amount of a working capital? For example, so we have seen a cost of a capital chapter. Let us assume cost of a capital is 20%. We are procuring funds at a cost and the cost of a capital is 20%. For suppose if you are making an unnecessary investment, unnecessary investment means what? Unnecessary investment. For example, working capital requirement is 50 CR, but whereas the investment made is 100 CR. So unnecessarily we have invested extra 50 CR. So this is called as overcapitalization. Okay. And next, for suppose if you are investing only 25 CR, actual requirement is 50 CR, but if you are investing only 25 CR, this is what? Undercapitalization. For suppose if you are investing a huge amount, I mean more than what is necessary, then the cost will increase. Finance cost will increase. Because that extra amount has to be procured from equity shares or preference shares or debentures. We have to pay some amount, yes or no? So finance cost will increase. For suppose if you are making a less investment in working capital, that will affect your reputation. For suppose if you are making only cash sales, you are not selling, okay, you are not doing any credit sale. So what happens then? You might lose some customers who are looking for credit. Sales might decrease, and if sales decreases, profit decreases. Yes or no? Profit decreases. Nothing but if you are making a less investment, okay, than what is necessary, then it might decrease the profitability due to loss of sales. And if you are making a less investment in working capital, you may not be able to meet the short-term commitment. For example, you are not maintaining a cash. I have already told you cash is maintained for 3 purposes: transactional need, safety need, safety and speculation. For example, Manisha birthday, okay, everybody is asking for party, but she doesn't have a money. If she is not giving a party, then what? Her reputation will get damaged or not? Yes. Likewise, okay, if a company is not maintaining a sufficient cash and if it is not paying her salaries on time, that will affect the reputation. If it is not paying to the suppliers on time, it will affect the reputation. Okay. And lesser the amount, higher the loss of reputation. For example, so Radhakrishna Industries, it failed to pay 1 crore to supplier. So that will affect the reputation. Sanjay Industries failed to pay 6,000 rupees salary to the sweeper. It will affect reputation or not? Yes. In which case, okay, huge loss is involved. In which case? Radhakrishna or Sanjay? Sanjay. Because what is the thinking? Radhakrishna Industries failed to pay 1 CR to supplier. That's okay, 1 CR is okay. Might fail, yes or no? Here, Sanjay has failed to pay 6,000 to sweeper. It will affect a lot. Kaneesam 6,000 kuda pay cheyalekapayada. This is our thinking. So lesser the amount, lesser the commitment. So higher the reputation loss. So that's why we have to estimate the working capital. There should not be overcapitalization, there should not be undercapitalization. Overcapitalization increases the finance cost. Undercapitalization may decrease the profit, okay, due to loss of a sales or due to loss of a reputation. Okay, clear? So that's why in this chapter the objective is to estimate the working capital, how much amount we should invest in working capital. So working capital based on the value and based on a time. Based on a value and based on a time. So working capital based on a time. Based on time. Working capital based on time. Permanent working capital, temporary working capital. So that segregation is very important. Permanent working capital, temporary working capital. Okay. Now, right now in the market you will be finding a firecrackers shop or not? Right now. Yes, firecrackers. You can get firecrackers or not as of now? You can get firecrackers. For example, Bangarthalli firecrackers. Okay. Firecrackers. She is maintaining a shop. Firecrackers shop. Mahesh, last. So, fire. ఒకసారి నుంచమ్మా బంగారు తల్లి నుంచో ఆ తల్లేనమ్మా బంగారు తల్లి కూర్చోమ్మా. సో point is here, so firecrackers, she is maintaining a shop. Okay, now whether she will maintain some amount of a stock or not, crackers stock, yes, that is investment in working capital. Yes or no? Every business will maintain some amount of a stock. DMart will have a stock, that is investment in working capital. Okay, even if DMart is selling the goods, so the goods will keep on. I mean, if one chocolate is sold, another chocolate will come into that place. Yes or no? So that is called as what? Investment in stock. Now she has to maintain firecrackers. So first point, right now, okay, people will buy crackers. Right now, for example, we are in the month of what? April. In the month of April, people may buy firecrackers in case of death of some person. Yes or no? Or some might get a, I mean, top rank, UPSC or whatever. Okay, a CA or CMA, whatever results. Okay, so I mean, other than Diwali, okay, so crackers might be bought for celebration, success celebration, or on death, or in case of a marriage. In case of a marriage, yes or no? Okay, this is the purpose. For example, okay, Bangarthalli, okay, so customer came and he asked for a crackers. He asked for crackers, and the occasion is what? Death of a person. She is offering what? A flower pot. Okay, sparkles. Okay, Bhu Chakralu, Vishnu Chakralu. She is offering this. Now tell me, so near dead body, okay, flower pot వెలిగిస్తారు ఎవరైనా? She is maintaining flower pot stock, she is maintaining sparkles, she is maintaining what? Okay, Vishnu Chakra etc. పాము బిళ్ళలు. ఓకే, ఇవన్నీ మెయింటైన్ చేస్తుంది. So is it correct or not? No, it is not correct. Why? So even if a person gets a rank, స్పార్కిల్స్ తిప్పుతాడా? రేపు మీరు పాస్ అయి తిప్పుతారా ఇలాగా? లేదు కదా. ఫ్లవర్ పాట్సా? కాదు కదా. ఓకే, సో దట్ మీన్స్ వాట్? Generally that type of a stock will not be maintained throughout the year. That stock will not be maintained throughout the year. Generally 1000 wala is required, because that is used throughout the year. Yes or no? 1000 wala or short something, so those will be maintained. So you can consider these as a permanent working capital, because these are required throughout the year in all on all occasions. This is permanent working capital. So this is maintained throughout the year, throughout the business period. I mean, if business runs for 10 years, So 10 years this stock has to be maintained. Which stock? 1000 wala shorts, etc. But whereas, okay, palm billalu, sparkles, okay, flower pots, these are required only on the occasion of a Diwali. That means, okay, investment is made, okay, 1 week before the Diwali, and that investment will be taken back after the Diwali. Okay, so this is called as temporary working capital. Temporary working capital means over and above the permanent working capital. Temporary working capital means over and above the permanent working capital. Are you getting my point? So these flower pots, this is over and above the permanent working capital. 1000 wala is a permanent working capital. Flower pot is a temporary working capital because that is seasonal. That is seasonal. That is what? Seasonal. Clearer? For example, DMart might sell umbrella during rainy season. So that umbrella is what? Temporary working capital. Raincoats, temporary working capital. So clearer? So here permanent working capital is also called as hardcore working capital, which has to be maintained throughout the business period, and investment must be made from the long-term source. Permanent working capital is it is not a short-term need, it is a long-term need. So that's why permanent working capital must be met from long-term source. Clear? Next what? Temporary working capital. Temporary working capital is a short-term need and it has to be met through short-term source. Temporary working capital is a short-term need and it has to be met through a short-term source. Clear? So working capital is equal to current assets minus what? Current liabilities. Now working capital requirement. How do we estimate the working capital requirement? For example, debtors. Let us start with debtors. So if you are making a cash sale, then there will not be any debtors. Yes or no? So there will not be any debtors if you are making a cash sale. If you are making a credit sale, then in balance sheet you will find debtors. If you are not making a credit sale, then you will not find any debtors in balance sheet, right? So debtors. So for example, 1 day credit is given. 1 day credit is given. For example, sales is equal to 1000 per day. Let us assume sales is equal to 1000 per day. Nothing but 3,65,000 is the annual sales. Number of days 365. Number of days 365. So 365. So I am taking an example. Annual sales 3,65,000. Then if you divide it with the number of days, you will get sales per day. So sales per day is equal to 1000. Sales per day is equal to 1000. Clear? Done. Next point is sales per day 1000. For suppose if a business is offering only 1 day credit, okay, on 31st March, if a balance sheet is prepared, So how much amount you will find under the heading debtors on 31st March? The sales made on 31st March will be received on 1st April. 1st April. So that's why on 31st March in your balance sheet you will find 1000 under the heading debtors. Yes or no? Only 1000 rupees. Only 1000. For suppose if you are if you are preparing a balance sheet on April 1st, on April 1st also you will be having a debtors 1000. Why? March 31st sale will be received on April 1st and April 1st will be received on April 2nd. If you prepare balance sheet on March 2nd, again 1000, March 3rd 1000, March 4th 1000. That means that 1000 will never be received. 1000 will never be received. Why? March 31st 1000 will be received on April 1st, right? But on April 1st we are doing again credit sale for one day. That 1000 will be received on April 2nd and April 2nd one will be received on 3rd. Always that 1000 will be pending only. Always that 1000 will be pending. You will not be receiving it. Are you getting my point? So that 1000 is said to be what? Investment in working capital. Investment in working capital. Are you getting my point? Likewise, for example, let us assume the stock also. There is a dairy milk chocolate. Let us assume that is also 1000 rupees. Generally, we take 1 day time to sell. In store, okay, chocolate will be for how many days? 1 day. In stores, the chocolate will be for 1 day. Nothing but 31st March. If you are bringing a chocolate to the 31st March, that will be sold on April 1st. And if you are bringing a chocolate on April 1st, it will be sold on 2nd. That means on 31st March, in store you will find 1 chocolate. In April 1st, you will find 1 chocolate. That means what is the investment made in stock? 1000 rupees. The investment made in stock is 1000 rupees. So working capital determinants. Working capital determines what factors will determine the working capital. Finished goods storage period will determine the working capital. For example, in my example, we are storing chocolate only for 1 day. So that's why investment is equal to what? 1000. Investment is equal to 1000. And working capital depends upon credit period. For example, in this example, I am giving a credit period of 1 day. Only 1 day, and the investment is what? 1000. Investment is 1000. First, suppose if I am giving a 2 days credit period, 2 days credit period, then what is my investment in debtors? 2000 will be my investment in debtors. Why? For example, on 31st March. So March 31st sale will be received on April 2nd. Not yet received. That will be in debtors, receivable. March 30 sale will be received on April 1st. That means as on 31st March, 2000 is still receivable. Clear? So that's why it is what? 2000 is what? Investment in debtors. Investment in debtors. Are you getting my point? On April 1st also, on April 1st for example, on April 1st debtors will be 2000 again. Why? On April 1st sale will be received on April 3rd. 2 days credit period. 2 days credit period. April 1st sale will be received on April 3rd. And March 31st sale will be received on April 2nd. That means as on April 1st, 2 days sale will be receivable. So that means what is the amount? 2000 is the amount. 2000 is the amount. Am I clear? 2000 is the amount. Clear? Okay. So if a 3 days credit period is given, 3000. 4 days credit period is given, 4000. 5 days credit period, 5000. Nothing but if a credit period increases, debtors increases. Investment in debtors will increase. Likewise, if a finished good storage period increases, then finished goods stock will also increase. So, estimation of a working capital is a first concept. Estimation of a working capital. See the debtors calculation. Simple. Debtors calculation. So debtors, we might take a total sale value or a cost. Generally cost is our investment, because profit is not an investment. So that's why if you see the calculation, budgeted credit sales in units, nothing but throughout the year, budgeted credit sales in units into what? A cost of a sales per unit. Then you will get total cost of a credit sales. Excluding depreciation. Cost per unit excludes depreciation. Why we are excluding depreciation? Because depreciation is nothing but what? Non-cash expense, one thing. And one more point is, already this was considered in capital budgeting. Depreciation is nothing but what? Amortization of a capital asset. Already capital investment is estimated in capital budgeting, already considered. So that's why again, if you take your depreciation, so that will be a duplicate, double effect. So that's why budgeted credit sales into cost of a sales per unit, then you will get overall cost of a credit sales into what? Average collection period into 1 day, 2 days or 3 days. Okay. So generally collection period will be given in months. If it given in months, then multiply with average collection period divided by 12 months. If it is given in days, divide by what? 365. For example, in our example, what? Days are given. So that's why 3,65,000 into what? 2 divided by 365. Same formula, same concept. 365,000 into 2 by 365. Okay. Nothing but 2 days sale will be logged. Okay. But for suppose if 2 months is the credit period, then what is the calculation? 3,65,000 into 3,65,000 into 2 divided by 12. 3,65,000 into 2 divided by 12. So what is the answer? 60,000 is the 60,833 is the answer. So more than a number, here concept is very important. Understand the logic behind this formula. Okay. So but instead of sales amount, we are taking what? Cost of a sales. Budgeted credit sales in units into cost of a sales into average debt collection period divided by 12 months. 12 months. Clear? The same will be applicable for what? Finished goods inventory. Budgeted production in units into manufacturing cost per unit excluding depreciation. Finished goods means that does not include selling and distribution expenses. You have seen a cost sheet in cost accounting, cost sheet. You know the cost sheet format. finished goods does not include what? Selling and distribution expenses. Yes or no? Finished goods includes only the manufacturing cost. So that's why budgeted production in units into manufacturing cost per unit excluding depreciation into finished goods holding period. In our example, I have told you chocolate is being in store for 1 day. Okay. If a chocolate is in store for 30 days, okay, so total 30 chocolates will be in store. At any point of time, you will be finding what? 30 chocolates. So simply finished goods inventory is equal to budgeted production in units into manufacturing cost per unit excluding depreciation into finished goods holding period divided by 12 months. Okay, clear? So finished goods, generally in case of DMart, you will be having only finished goods inventory. You will not be finding any work in progress inventory or a raw material inventory because it is not a manufacturing unit. It is a retail store, retail. Okay, it is purchasing already finished goods and selling to the customer. So if you are estimating an working capital for DMart, so in working capital estimate, you will not be finding any raw material or a work in progress. You know what is raw material, what is working capital, and what is finished good. Okay, so clear? So raw material, working capital, sorry, working progress, and next finished goods. So for example, to manufacture a bench, we require iron, wood, and paint. So wood is a raw material, iron is a raw material. Okay, and next what? Finally, bench is what? Finished good. Yes or no? And the process, for example, if a bench is in the process, then it is called as working progress. If you are going to a car manufacturing company on 31st March, if you go to a car manufacturing company or a tiles manufacturing company or a granites manufacturing company on 31st March, you will find 3 types of stocks. In any manufacturing unit, you will be finding 3 types of stocks. If you are going to a Coca-Cola company, you will be finding 3 types of stock: raw material, work in progress, finished goods. So that means the company is investing in all the 3 stocks. Okay. So work in progress is equal to budgeted production in units into cost per unit of work in progress into what? Average time span of a work in progress inventory. Nothing but processing time. Some goods may take 15 days time to get processed. Some goods may take 1 month time to get processed. Some goods may take 45 days. If a processing time increases, the work in progress increases. If a processing time increases, then work in progress stock will also increase. Next, raw material inventory. Raw material inventory means it includes only raw material cost. It does not include any labor. It does not include any overhead. So that's why raw material inventory is equal to budgeted production in units into raw material cost per unit into average inventory holding period. For example, raw material holding period, storage period is 60 days. Then budgeted production units into raw material cost per unit into 60 divided by 365 days. 60 divided by 365. So the same is applicable for what? Liabilities also. Same is applicable for what? Liabilities. Creditors. Same. Okay. Same for the liability also. Okay. So let us see the question for working capital estimate. So see the second question. Illustration number 2. PQR Limited produces a product with the following revenue cost structure. With the following revenue, cost structure, particulars, cost per unit, particulars and cost per unit. Raw materials, direct labor, overheads, total cost, profit, selling price. Raw material, direct labor, overheads, total cost, profits, selling price. What is the selling price? 290 is the selling price. 290 is the selling price. The following additional information is available. Average raw material in stock, 1 month. 1 month average raw material, nothing but into 1 divided by 12. We do into 1 divided by 12. Clear? Average materials in process, half a month. So processing time is half a month. So 0.5 divided by 12. Raw material 100%, direct labor 50%, overhead 50%. What is the meaning? Work in progress means, so first raw material will be introduced 100%. So visualize the process. For example, if with mango pulp is being extracted. Mango pulp is being extracted. So in the beginning itself, mangoes will be introduced to the process. That means 100% of our raw material will be introduced to the process. The same point you might have got in process costing, cost accounting. But whereas labor, for example, process period is 15 days. Process period is 15 days. So labor cost anedi first day ne incur ayipotama. If we are going to incur labor cost in first day itself, then why the process period will be for 15 days? కాదు కదా, మీకు అర్థమవుతుందా? ప్రాసెస్ పీరియడ్ 15 days ఇక్కడ, హాఫ్ ఎ మంత్. సో లేబర్ కాస్ట్ అండ్ ఓవర్ హెడ్స్. లేబర్ ఏంటమ్మా, ఎక్కడో కూర్చొని పని చేస్తూ ఉంటారు, ఫ్యాన్ వేస్తాం, లైట్ వేస్తాం, అవునా కదా. సో ఓవర్ హెడ్స్ ఇంకర్ అవుతాం. ఈ ఓవర్ హెడ్స్ కానీ లేబర్ కానీ ఆర్ వి గోయింగ్ టు ఇంకర్ ఆన్ డే 1? Generally raw materials are introduced on day 1, 100% raw material. But process అనేది ఏంటి? 15 days process అన్నప్పుడు what are we going to do? 15 days process కదా. 15 days process అంటే ఏమవుతుంది? 15 days process means, for example, labor cost 15 rupees. Labor cost, let us assume 15 rupees, or what is the number given? 80. Okay, 80 rupees. 80 rupees is the labor cost per unit. Process period is how many days? 15 days. So 80 divided by 15. 5.33. So what is this 5.33? Labor cost per day. Labor cost per processing day. So on first day, are we going to incur entire 80 rupees on first day itself? No, because the process period is how many days? 15 days. So that means on first day we spend 5.33, second day 5.33, third day 5.33, fourth day 5.33. First, suppose if you have spent the entire 80 rupees, that means what? Process is completed. Process is completed. Then why it will stay in work in progress? Inka work in progress endukantam anam kada. Ado adna. So work in progress ante enti? Process is not yet completed. Process is not yet completed. So in the question they have clearly mentioned, so process was completed by 50% with respect to labor and with respect to overhead. So then why raw material is 100%? Raw material is generally, if you are extracting a pulp from a mango, all the mangoes will be introduced to the process on the day 1 itself. But labor will be working for next 15 days to make it a finished good. So that's why in process costing also generally you find raw material 100%, labor 70, 50, 30, overheads also 70, 50, 30. Yes or no? So in this example, what they are saying, so labor 50%, overhead 50%. Average finished goods in stock 1 month. Credit allowed by supplier 1 month. Credit allowed to debtors 2 months. Time lag in payment of wages half a month. Overheads 1 month. 1/4 of our sales are on cash basis. 1/4 of our sales are on cash basis. Cash balance is expected to be 1,60,000. So we are expecting the cash balance to be rupees 1,60,000. You are required to prepare a statement showing working capital needed to finance a level of activity of 60,000 units of annual output. The production is carried throughout the year on even basis and wages and overheads accrue. Wages and overheads accrue uniformly means wages and overheads are incurred equally throughout the process period. Like I have told, 5.33 first day, second day 5.33 likewise. Debtors are taken at cost. Debtors are taken at cost. In the above formula also we are taking a cost. There are two approaches, total approaches, cash cost approach. Total approach, cash cost approach. Total approach means we take a sales amount for finding a debtors. To find out the debtors value, so we take a sales amount, that is total approach. Cash cost approach means nothing but the above formula we have seen, budgeted sales units into cost per unit excluding depreciation into what, credit period divided by number of months, 12 months. Are you getting my point? In this question they have clearly mentioned debtors are to be taken at cost. But there are two approaches, remember. One is total approach, second one is cost approach. Total approach means direct sales amount will be taken instead of cost. Sales amount is taken, which is not 100% correct. But in books you will find total approach also. Okay. So let us estimate. What is the first one? First point given. Raw material. First one what? Raw material. How many units? Statement, prepare a statement showing the working capital needed to finance a level of activity of 60,000 units of annual output. How many units we require? 60,000 units. 60,000 units. So this model, even if you understand one question conceptual, that is enough. One question. Okay. So you're getting one question, this model. So 60,000 units. 60,000 units into what is the raw material cost? 115. So 60,000 into 115 into 1 divided by 5,75,000. So this will be the stock of a raw material. In current assets, first stock, stock of a raw material. Second, work in progress. Work in progress includes, raw material stock includes only raw material cost. But work in progress means already some amount of labor worked, some amount of overhead has incurred. So that's why 3 parts. Generally in work in progress you will have 3 parts, because generally raw material will be 100%, labor and overhead will be 50, 60, 70, whatever the percentage they might give in question. But labor and overhead cannot be 100%. If labor and overhead is also 100%, then it is not a work in progress, because process already completed. So that's why raw material. What is this raw material? Raw material included in work in progress. So this is different. 60,000 into 60,000 into 115 into 1 by 12 into half. 60,000 into 115 into 1 by 12 into half. 2,87,000 into 2,87,500. Next, 60,000 into 80 into 1 by 12 into 60,000 into 80 into 1 by 12 into half. Why half? Only one half should be taken. Sorry, two halves. I'm sorry, two halves. Raw material, why it is multiplied with half? Because only half month. Nothing but instead of taking 1 by 12, directly take 0.5 divided by 12. Direct labor, 60,000 into 80 into 0.5 divided by 12 into half. Why? Only 50%. Labor included in work in progress is only 50%. Next. Next, overheads, 60,000 into 37 into 0.5 divided by 12 into half, because overheads also 50%. So this is the overall working progress value. Nothing but investment in working progress is equal to 4,33,750. 4,33,750 is the investment in working capital. I mean work in progress. Work in progress. What is the next one? Finished goods. Finished goods means it includes raw material, direct labor, overheads, total cost. 100% completed. So that's why straight away 60,000 into 232 into what? 1 by 12. This is not 1 by 2, that is 1 by 12. Because average finished goods in stock is equal to 1 month. So 60,000 into 232 into 1 by 12. So answer is 11,60,000. Current assets. We are talking about current assets. Next, debtors. Debtors are taken at cost. Debtors are taken at cost. So that's why 60,000 into 232 into why 3 by 4? Because 1/4 are a cash sales. 1/4 are cash sales. That means only 3/4 credit sales. Okay, if you are making cash sales, there will not be any debtors, right? So that's why 60,000 into 232 into 3 by 4 into 2 by 12. So the answer is 17,40,000. We are expected to maintain a cash of 1,65,000. So this is the total current assets. 1,60,000, yeah? 1,60,000. See the total whether it is correct or not. 40 lakh 68,000, or else change the question. Cash balance expected to be 1,65,000. Clear? Next, come to current liabilities. Creditor comes under what? Current liabilities. Be careful, students might take everything under heading current assets. Credit allowed by suppliers. Suppliers are giving a credit. We are the customers. So this is a current liability, 1 month. So creditors, suppliers will give a credit for raw material or labor and overheads also. Only for raw material. So that's why 60,000 into 115 into 1 by 12. 5,75,000. This is the creditors amount. Next, wages. Wages. Time lag. Time lag means delay. Lag means delay. Delay in payment of wages, half a month. Delay in payment of wages, half a month. So 60,000 into 80 into 1 by 12 into half. Next 60,000 into 37 into 1 by 12. 1 lakh 85,000. So this is the total of what? Current liabilities. Working capital is equal to current assets minus current liabilities. Clear? So this model is a frequently asked question. You will get one question in this model. So similar kind of a questions. 3 is similar. 4 is also same. 5 also you can try. 5 up to 5 same model. Up to 5 same model. Working capital estimates. First question is a different one. Operating cycle period. First question is an operating cycle period. First question. Let us see the first question. Question number 1. Operating cycle period. Operating cycle period means time taken for conversion of a cash again into cash. Time taken for conversion of a cash again into cash. Cheppamma Ganesh. Conversion of a cash. Endama. Conversion of a cash again into what? Cash. So first thing, first we bring cash, right? First we bring cash, and next what? Cash is converted into so with cash is not directly sold, right? Okay, first with the cash we convert this cash into raw material. And next, and this raw material is converted into work in progress. Converted into work in progress. Converted into work in progress. Converted into what? Work in progress. Cash converted into raw material. Raw material is converted into work in progress. And raw material is converted into what? Finished good. Yes or no? And this finished good is converted into debtors. Finished good is converted into debtors. And this debtors is converted into cash. So debtors is converted into cash. Okay. So this is called as what? Operating cycle period. If operating cycle period increases, working capital investment will also increase. For example, manufacturing unit has to invest more amount than retail store. Because retail store, cash to finished goods to cash. No debtors also. DMart will not make any credit sale. Yes or no? So DMart operating cycle is cash to finished goods to cash. So okay. But for manufacturing unit, cash converted into raw material to working progress to finished goods, and finished goods to debtors. Manufacturing unit has to make a credit sale, and debtors to what? Cash. Debtors to cash. Clear? So operating cycle period, if operating cycle period increases, working capital increases. Working capital increases. Clear? So in previous question already we have seen raw material storage period 1 month. So that 1 month is raw material storage period. For example, raw material storage period is equal to 1 month. Raw material storage period is equal to 1 month. Working progress is equal to 1 month. Finished goods storage period is equal to 2 months. Debtors is equal to 3 months. Creditors is equal to 2 months. Then operating cycle period is equal to R plus working progress plus finished goods plus debtors minus creditors. So the answer is 5. So operating cycle period is equal to 5. Operating cycle period is equal to what? 5. 5 months. Operating cycle period 5 months. So operating cycle period is equal to R plus. R means raw material storage period. W means working process period plus finished goods storage period plus debtors collection period minus credit period allowed by supplier. Credit period allowed by supplier is reduced because we are not giving credit, we are taking a credit. So that's why that has to be reduced. So operating cycle period is equal to R plus W plus F plus D minus C. So this is the answer. Okay, done. So now we should know how to find out raw material storage period. Raw material storage period. So that is simple. If you see the question number 1, what is the raw material consumed? 6 lakhs. What is the average stock of raw material? 50,000. In stock there is 50,000. In previous question we have a calculated stock. We have calculated stock. Yes or no? In previous question, what is the calculation in previous question? 60,000 into 115 into 1 by 12. Yes or no? So that is equal to, you got some amount, 5,75,000. Now they are asking you to find out this raw material storage period. Raw material storage period. Raw material storage period. This 60,000 is into 15 is nothing but what? 60,000 into 15 is nothing but what? Raw material consumed. Raw material consumed. This is what? Raw material stock. Raw material stock. If you have to find out this one, the calculation is 5,75,000 divided by 60,000 into 115 divided by 12. Yes or no? Nothing but here 5,75,000 is what? Average stock of raw material divided by raw material consumed per day, or raw material consumed during the year divided by 365. Raw material consumed per day. Nothing but, if you see this question, 6 lakhs is the raw material consumed, right? Raw material consumed 6 lakhs. Number of days in a year 360. Number of days in a year 360. So 6 lakhs divided by 360 is equal to 6 lakhs divided by 360 is equal to 6 lakhs divided by 360. 1000 1667 is the per day consumption. Okay. You have a 50,000 in stock. 50,000 in stock. So how many days it will take to consume this 50,000? 50,000 divided by 1667. 30 days. Nothing but we are maintaining a stock which is required for 30 days. Raw material storage period is equal to 30 days. So what is the formula for raw material storage period? Average stock of raw material divided by average cost of raw material consumption per day. Raw material consumption per day. Average stock of raw material divided by average cost of a raw material consumption per day. So this is the raw material storage period. Next what? Clear? So 30 days is the answer. Next, work in progress inventory holding period. Work in progress inventory holding period. So work in progress inventory holding period. So what is the work in progress inventory? 30,000. One zero is missing. 30,000. Cost of a production for the year 5 lakhs. We should take cost of production per day. So average work in progress divided by what? Average cost of a production per day. So the answer is what? 22 days is the working progress holding period. This is an easy question. If you get an examination, you can easily score 7. Next, finished goods storage period. Average stock of finished goods divided by average cost of goods sold per day. For example, 8 lakhs divided by 3 lakh 60. What is 8 lakhs divided by 3 lakh 60? 2,222. So per day we are selling 2,222. We have a finished goods stock of 40,000. How many days it will take to sell that 40,000? 18 days. Clear? Next, debtors. So one MCQ was also asked for debtors. If you want to find out the debtors, then debtors collection period, credit sales divided by credit sales. Sorry, debtors divided by credit sales per day. If you have to find out the debtors collection period. So what is the formula for debtors collection period? Debtors divided by credit sales per day. For example, in the first example I have taken, debtors is equal to 1000. What is the credit sale per day? 1000. That means debtors collection period is equal to 1. Okay, so debtors collection period is equal to what? Debtors divided by credit sales per day. Again, these ratios will be repeated in ratio analysis chapter. Okay, so debtors collection period is equal to debtors divided by credit sales per day. Okay, if there is bills receivable, we take debtors plus bills receivable. Debtors plus bills receivable. Credit period allowed by creditor. How do we get credit period allowed by creditor? Creditors divided by credit purchases per day. Creditors divided by credit purchases per day. But in this question already debtors collection period given. Credit allowed by creditors is also given. So the net operating cycle is equal to R 30 plus W 20 plus F 18 plus debtors 45 minus what? Credit collection period 30. So 85 days is the operating cycle period. If operating cycle period increases, working capital investment will also increase. Number of operating cycles in a year. Number of operating cycles in a year. Simple. In a day, in a year, there will be 360. 360 days are given. So 360 divided by 360 divided by what? Operating cycle period 4.23 cycles. Total there will be 4.23 cycles. That means cash will be converted into cash. How many times? 4.23 times. 4.23 times. Number of operating cycles in a year. So clear? And they might ask you a working capital investment. If they ask you to find out the working capital investment, then 8 lakhs into 85 divided by 360. If they ask you to find out working capital investment, nothing but in a year we are selling goods worth 8 lakhs, 365 days. But cash is again converted into cash in how many days? 85 days. So 8 lakhs into, okay, 8 lakhs into what? Sorry, 8 lakhs into 85 divided by 365. 1,88,889 is the working capital requirement. Using operating cycle period, if they ask you to find out working capital, you'll find out చేసుకోవాలి. So clear? Am I clear? Done? So up to question number 5, same model up to question number 5. So we have to see the debtors management, cash management and inventory management. Inventory management means nothing but already covered in cost accounting, that is EOQ, economic order quantity. In the past 3 items, 2 questions were asked from inventory management, and those 2 questions are not from FM study material. Those 2 questions are from cost accounting study material. Same questions. Cost accounting study material questions were asked. Okay. Material chapter, 2 questions were asked from cost accounting, and 1 question is cash management. So clear? Go through these questions. So next concept, debtors management. I hope you have tried questions relating to working capital estimates, past exam questions, and question number 4 to 3 to 2 to 5. 2 నేనే చెప్పాను కదా, 3 to 5. So next concept, debtors management. If a debtors collection period increases, then debtors increases. Yes or no? Debtors collection period increases, then debtors increases. Yes or no? So morning we have seen, if you are allowing only 1 day credit period, then debtors is equal to 1000. Morning example. If you are giving 2 days credit, then 2000. 3 days credit, 3000. So if a debtors collection period increases, debtors increases. Okay. Now, whether we should give a credit period to the customer or not, is the question. For example, if you are making a cash sale, then there will not be any debtors. Yes or no? But if you are making a credit sales, that means you have to make investment in debtors. Okay. Now the question is whether a business has to make a credit sales or not. So first point, if a credit sales are made, then plus points, Sales will increase. Sales will increase. Sales will increase. Yes or no? If a business is making a credit sale, so sales will increase. Am I correct? For example, if a BMW company is making a credit sale, they are asking you to purchase a car and they are allowing 10 years credit. 10 years credit. So 10 years credit is the సీను కొంటాడు క్లారు, ప్రస్సు కొంటాడు, నేను అందరం కొంటాం. ఎందుకని? పేమెంట్ ఎప్పుడు? ఆఫ్టర్ 10 years. పేమెంట్ ఈజ్ ఆఫ్టర్ 10 years. సో నథింగ్ బట్ క్రెడిట్ పీరియడ్ 30 days, 60 days, 90 days, 1 year, 10 years. ఓకే, if you are allowing 30 days, there will be sales. But if you are allowing 60 days, sales will increase. If you are allowing 90 days, sales will further increase. Sales will further increase. If you are allowing 10 years credit, sales will increase. Yes or no? If a sales increases, obviously profit will also increase. If sales increases, profit will also increase. Yes or no? This is a benefit. This is a benefit. So what is the negative point if you are making a credit sale? If a credit period increases, if a credit period increases, what is the negative point? Bad debts. Yes or no? Bad debts is the negative point. And what is the next negative point? Opportunity cost. Opportunity cost is nothing but investment in debtors will increase. If you are making a credit sale and if you are increasing the credit period, investment in debtors will increase. If investment in debtors increases, nothing but cost of investment will increase. Nothing but to invest in working capital, we should procure fund from equity shares or a preference shares or a debenture holders. It incurs some cost. It involves some amount of a cost. So cost of a investment is a negative point. Okay. So positive point is increase in sales. Negative point is what? Bad debts. And what is another negative point? Opportunity cost. Now tell me whether a business has to make a credit sale or not. Whether a business has to make a credit sale or not. We cannot say yes directly. డైరెక్ట్గా ఎస్ అంటే డేటాస్ మేనేజ్మెంట్ చాప్టర్ ఎందుకు? అర్థం అవుతుందా? సో వీ హ్యావ్ టు డూ అ కాస్ట్ బెనిఫిట్ అనాలిసిస్. కాస్ట్ బెనిఫిట్ అనాలిసిస్. సో దిస్ ఈస్ ద బెనిఫిట్ అండ్ దిస్ ఈస్ వాట్? కాస్ట్. ఓకే, ఇఫ్ అ బెనిఫిట్ ఈజ్ గ్రేటర్ దాన్ కాస్ట్, దెన్ గివ్ అ క్రెడిట్. ఇఫ్ అ బెనిఫిట్ ఈజ్ లెస్ దాన్ కాస్ట్, దెన్ వాట్? డు నాట్ గో ఫర్ అ క్రెడిట్ సేల్. So we have to do a cost benefit analysis. Cost benefit analysis. But before making a credit sale, credit analysis has to be done. Credit analysis. Whether a credit sale can be made to a particular customer or not. Whether a credit sale can be made to a particular person or not. So that is known as what? Credit analysis. Credit analysis. So debtors management involves determination of a optimum credit period. Determination of a optimum credit period. Optimum means best credit period. So that can be 30 days, 60 days, 90 days. The objective is to select an optimum credit period. So that is a part of a debtors management. We cannot make excessive investment in debtors. We cannot invest less amount in debtors. We have to make an optimum investment in debtors. So that is our objective. Okay. Now, selection of a optimum credit period is a part of a debtors management, and the credit analysis is also part of a debtors management. And next, collection is also a part of a debtors management. Collection. So after making a credit sale, collection has to be made. Collection means what? Follow up. before the due date a reminder call has to be given to the customer, okay, and if a customer is not paying, okay, letters has to be sent, written notices has to be sent, and even if written notice, after sending a written notice, if he is not responding, then you have to take a legal action. So business has to take a legal action against the customer. So then a seriousness will be there among the customers. For suppose if a business is not taking a legal action, then what? For example, if you are not making a payment of a loan, okay, and that loan app or bank is not doing anything, then everybody will take a loan from the bank and everybody will make a default. So that's why business has to take a legal action. So collection is also a part of a debtors management, okay. And next, credit analysis. What is this credit analysis? Whether a credit can be given to a particular person or not. Credit can be given to a particular person or not. For example, bank A, so Sanjay has applied for a loan. So bank will do a credit analysis and then bank will give a loan. What is this credit analysis? For example, bank will go for a home visit. And office visit where he is working, office visit. So bank will inquire whether the details given by the customer are correct or not. For suppose he applied for 20 lakhs loan, okay. So bank has come to his house. There is no refrigerator, there is no AC, and there is no sofa, okay, and only single room, and he is unmarried. So now tell me whether bank will give a loan or not. No, because he cannot repay the loan. Why he cannot repay the loan? First point, first thing, he is staying in single room, he is unmarried. At any time he can move away from that room, okay. So that's why bank will not be giving the loan, okay, because he cannot pay the loan. And I have given a details, there is no AC, refrigerator, there is no sofa or chairs. So that means he cannot repay the loan, okay. Second case, okay, bank has went to a Manoj house. He is a Jamindar, okay. So Malleshwari movie, you know Malleshwari movie, right? So Raj Mahal, he is staying in Raj Mahal. So the bank person has came to a visit. Now whether he can pay the loan or not? Yes, he can pay the loan. So bank executive Pavan has came for inquiry, and after coming out of the Raj Mahal, okay, at Pandabba, he asked about Manoj, Raja Manoj, okay, what is his background? Then that owner has told that, Pandabba owner has told that he already has taken a 6,000 rupees, 6,000 crores loan from SBI, State Bank of India, and he made a default. He has a lot of assets, but he didn't pay the loan. Now the point is whether bank will give a loan or not now. No. Why? He can pay. Because he is having lot of property, he can pay, but he is not willing to pay. Nothing but while doing a credit analysis, we should ask two questions. Can he pay? Will he pay? Sanjay cannot pay. Okay, Bikari. So Manoj will not pay. Okay. So this is called as what? Credit analysis. So we have a questions regarding selection of optimum credit period. Optimum credit period means nothing but best credit period. The credit period where we get a higher net benefit. Okay. We cannot conclude 30 days is the best credit period or 90 days is the best credit period. Correct credit period ఎక్కువ ఇస్తే ఏమవుద్ది, సేల్స్ ఇంక్రీజ్ అవుతాయి. బట్ అలా అని చెప్పి క్రెడిట్ పీరియడ్ 200 days ఇస్తే For example, if we give an offer to a student, pay fee after getting a job, 2000 అడ్మిషన్స్ వస్తాయి, కానీ బ్యాడ్ డెట్స్ ఎక్కువ ఉంటాయి. కానీ బ్యాడ్ డెట్స్ ఎక్కువ ఉంటాయి. సో దట్స్ వై సో ఆప్టిమమ్ క్రెడిట్ పీరియడ్ అంటే ఎంత ఎక్కువ ఉంటుంది ఆప్టిమమ్ క్రెడిట్ పీరియడ్ అయిపోతుంది. అర్థమైందా? సో ఆప్టిమమ్ క్రెడిట్ పీరియడ్ అంటే ఎక్కడైతే నెట్ బెనిఫిట్ ఎక్కువ వస్తుందో అది ఆప్టిమమ్ క్రెడిట్ పీరియడ్ అవుతుంది. అలానే ఇమీడియట్గా జాయినింగ్ అప్పుడే పే చేయమనడం కూడా కరెక్ట్ కాదు. అప్పుడు ఎవరు జాయిన్ అవ్వరు. సో వీ షుడ్ సెలెక్ట్ అన్ ఆప్టిమమ్ క్రెడిట్ పీరియడ్ బెస్ట్ క్రెడిట్ పీరియడ్. ఓకే, క్లియర్ గణేష్? See the question number 7. Question number 7. Basha. Mastana. Okay, Mastana it వచ్చేనన్నా. Okay. Question number 7. Ganesh, question number 7. ఏదో రాసుకుని అది మనోజ్ డీసీపీనా? డెటార్స్ కలెక్షన్ పీరియడ్. ఓకే. ABC Corporation is considering relaxing its present credit policy and is in the process of evaluating two proposed policies. Relaxing its present policy means they wanted to increase the credit period. Currently the firm has annual credit sales of rupees 50 lakhs and accounts receivable turnover ratio of 4 times a year. The current level of a loss due to bad debts is rupees 1,50,000. The firm is required to give a return of 25% on its investment in new accounts receivable. The company's variable costs are 70% of the selling price. Given the following information, which is better option? Present policy option 1, policy option 2. Annual credit sales present 50 lakhs, accounts receivable turnover ratio 4 times, bad debt loss 1,50,000. Option 1, credit sales 60,000, turnover ratio 3 times, bad debt loss 3 lakhs. Policy option 3, 67,50,000, 2.4 times, 4,50,000. Okay, which is the better option? Tell me which is the better option. Present policy option 1, policy option 2. In this question, the special point is accounts receivable turnover ratio. What? Accounts receivable turnover ratio. So higher the accounts receivable turnover ratio. What is accounts receivable turnover ratio? Present policy 4 times. Policy option 1 3 times. Policy option 2 2.4 times. Accounts receivable turnover ratio. Turnover ratio means always turnover will be the numerator. In case of accounts receivable turnover ratio, credit sales will be the turnover. So that means accounts receivable turnover ratio means, what is the formula, Karthik? Accounts receivable turnover ratio. Turnover divided by accounts receivable. Asset turnover ratio, turnover divided by assets. Likewise, accounts receivable turnover ratio means turnover divided by accounts receivable 4 times. Okay. So using the accounts receivable turnover ratio, we can find out what? Credit sales are given. Credit sales 50 lakhs. So we can find out what? We can find out what debtors. Okay. So take heading question number. Manisha, question number. Prasu, question number. Question number 7. ఇంకున్నారే ఎవరికి ప్లస్ అటు ఎవరో చెప్పారు ఆన్సర్ భానువా ఓకే స్టేట్మెంట్ షోయింగ్ debtors policies evaluation. Statement showing debtors policy evaluation. Okay, columns. Particulars, present policy, policy 1, policy 2. Okay. Karthik, particulars. Sales. What is the sales amount? 50 lakhs. 60 lakhs. 60 minus variable cost. Minus variable cost. So sales minus what? Variable cost. 35 lakhs. 42 lakhs. Variable cost, second case, 42 lakhs. 47 lakh. So this is what contribution. 15 lakhs. 18 lakhs. 20. Next, is there any fixed cost given in the question? No fixed cost. But bad debts is given. Minus bad debts. What is the percentage? Amount is given. Be careful, if a percentage is given, that percentage has to be applied on sales. But students might apply that percentage on contribution. So you go to the sales. Minus bad debts. 1 lakh, 50,000, 3 lakhs, 4 lakh, 13 lakh, 50,000, 15 lakhs, 16 lakh, 15. Mastan correct an answer, sir. 13 lakh 50, 15 lakhs, 15 lakh 75. Minus what? Opportunity cost. In debtors management, the important point is opportunity cost. Opportunity cost. First we should know the investment in debtors. Investment in debtors. For that, first we should find out the collection period. Collection period. Collection period. Collection period, DCP Manoj, collection period, first case. Number of days in a year divided by debtors turnover ratio. So debtors turnover ratio, first case, what is the debtors turnover ratio? 3 or 4? 4. Present policy. Present policy 4. Number of days in a year given or not? Not given, right? So number of days in a year 365. Debtors turnover ratio 4. Debtors turnover ratio 4 means nothing but debtors will convert it to cash 4 times. Nothing but debtors collection period is equal to 365 divided by 4. 91.25. Next. Months lo తీసుకోవచ్చు, no issue. 12 divided by 4. 12 divided by 4, if you are taking 12 divided by 4, then 3 months. Next 12 divided by 3, 4 months. Next. Next, investment in debtors. How do we get investment in debtors? Credit sales into 3 by 12. That is the total approach. That is the total approach. Okay. Cost approach means we consider only the variable cost. We consider only variable cost. Only cost will be considered. Here fixed cost is not given. So that's why cost approach means 35 lakhs into 3 by 12. 8,75,000. Next 35 lakhs into 4 by 12. 11 lakh. Sorry, 42. I'm sorry. 42 lakhs. I'm sorry, 42 lakhs into 4 by 12. 10 lakhs. 14 lakh. 14 lakhs. నేను 90 ఆన్సర్ చెప్తే మీరు 150 ఆన్సర్ చెప్పారు, అది 180 ఆన్సర్. సో నెక్స్ట్ థర్డ్ కేస్. చరణ్. థర్డ్ ధర్మరాజు. 19 lakh. So what is the calculation? Variable cost. 47,25,000 into. So if a credit period increases, investment in debtors will increase. The other way of a calculation is simple. Variable cost divided by debtors turnover ratio. What is the variable cost? First case 35 lakhs divided by what? Debtors turnover ratio. Okay, clear? But this is not the cost actually, this is the investment. This 8,75,000 is procured from equity and debt holders. So cost of investment. Cost of investment 8,75,000 into what is the percentage? 25%. So 2 lakh 18,750. Next 3 lakh 50,000. Sirisha, next 4 lakh 10 to 2,000. 22. Okay, 4 lakh 92,188. Okay. Opportunity cost. महात्मा ऑपर्चुनिटी कॉस्ट यहाँ से रिड्यूस करना, कहाँ से? ग्रॉस बेनिफिट से. व्हाट इज द अमाउंट? 2,18,750. Then you will get 11 lakh. This is the net benefit. Present case net benefit is equal to 11,31,250. What about second one? Mahatma, second case 3,50,000. 11 lakh. Next 4 lakh 92,000. 4,92,188. 10 lakh 812. So tell me which is the best credit period? Second one is the best credit period, policy 1. So policy 1 collection period is 4 months, credit period 4 months. Mahi Sanjita, క్లాస్ ఎలా అంటున్నావు తెలుసా నువ్వు? నేను ఇంకా చెప్పలా, అర్థమవుతుందా? చిరంజీవి మూవీ చూసావా? చిరంజీవి వేణుమాధవ్ కామెడీ సీన్ ఉంటుంది, ఈ తాగే వాళ్ళందరినీ చంపేయాలరా అని. గుర్తొచ్చింది ఆ సీన్? గుర్తు రాలేదా? నెక్స్ట్ వన్, illustration number 8. So we have a concept of cash discount. Cash discount means discount will be given if paid before the due date. So if you are allowing a cash discount to the customer, that will increase the sales amount. Sales will increase, and second, bad debts will decrease. Collection period will also decrease because customers will take a discount. Yes or no? Customer will pay before the due date in order to take a discount. So cash discount. So benefits are plus points, cash discount, plus points, sales will increase. Collection period decreases. Okay, and bad debts will also decrease. These are the advantages. So what is the minus point we have to pay? Cash discount is only the minus point. So whether we should give a cash discount or not, yes అయితే క్వశ్చన్ అవసరం లేదు. ఎస్ నో అంటే we have to do a benefit analysis, cost benefit analysis. ప్లస్ టోటల్ చేయాలి, నెగిటివ్ టోటల్ చేయాలి, అండ్ కాస్ట్ బెనిఫిట్ అనాలిసిస్. ఇఫ్ అ బెనిఫిట్ ఈజ్ మోర్ దాన్ కాస్ట్, ఓకే, యాక్సెప్ట్, ఐ మీన్ గివ్ అ డిస్కౌంట్, అదర్వైజ్ నో. సో సీ ద క్వశ్చన్ నెంబర్ 8. Rowdy Manoj. B Limited is presently having a credit sales of 12 lakhs. The existing credit period are 1/10 net 45 days. 1/10 net 45 days. So this is the special point in this question. 1/10 net 45 means 1% discount if paid within 10 days. Normal credit period 45 days. అర్థమవుతుందా వంశీ? ఏంటి దీంట్లో అంత అర్థం ఉందన్నట్టు చూస్తున్నావు? 1/10 net 45 means what? 1% discount if paid within 10 days. Normal credit period 45 days. Average collection period 30 days. The current bad debt loss is equal to 1.5%. In order to accelerate అని తెలుసు కదా, స్పీడ్ పెంచడానికి. In order to accelerate the collection process further as also to increase the sales, the company is contemplating. మహాత్మా ఇటు వచ్చేయండి, మీరు ఇద్దరు ఇటు రండి. కార్తీక్ ఇటురా, ఇటు వచ్చేయండి. So 1 by 10 net. So in order to accelerate the collection process further as also to increase the sales, the company is contemplating liberalization of its existing credit policies to credit terms to 2 by 10 net 45. 2 by 10 net 45 meaning 2% discount if paid in 10 days, normal credit period 45 days. It is expected that the sales are likely to increase by 1/3 of existing sales. Bad debts increase to, generally bad debts has to decrease, but bad debts increase to 2% of sales. Average collection period will decline to 20 days. Earlier the average collection period was 30 days, but now it is declining to 20 days. The contribution to sales ratio of the company is 22%. Opportunity cost of investment in receivables is 15% pre-tax. 50% and 80% of customers in terms of sales revenue are expected to avail cash discount under existing and liberalization scheme respectively. The tax rate is 30%. So simple question, there are two policies, present policy and new policy. Present policy 1 by 10 net 45 days, second policy 2 by 10 net 45 days. Let us solve this question. Question number what? 8. Question number 8. Question number 8. So calculation of a net benefit. Calculation of a net benefit. Particulars. Present policy, new policy. Present policy. Present policy discount. Discount if paid within 10 days. Yes or no? Discount if paid within 10 days. What is the discount? 1%, 2%. Normal credit period. Normal credit period 40. Both the cases 45 days. Average collection period. Average collection period. ACP. Manoj. DCB, ACB. ACB. Average collection period. First case, what is the average collection period? నైట్ ఏంటి నవ్వుతున్నాం ఏసీబీ అంటే అవ్వకూడదండి. ఓకే, యావరేజ్ కలెక్షన్ పీరియడ్ 30 days, 20 days. 30 and 20. Normal credit period is not relevant actually, because normal credit period 45 days. Some people will pay 45 days within 45 days and some people will pay within 10 days. And the overall on an average collection period is 30 days. First case. Second case 20 days. So let us start sales. Let us start income statement, sales. Tell me the sales amount. Sales 12 lakhs minus what? Variable cost given in the question or not? Variable cost. Contribution ratio is given, right? What is the contribution ratio? 16 అని చెప్పాలి కదా మరి. 12 lakhs 16 lakhs because sales will increase by 1 by third. 12 lakhs, 16 lakhs minus variable cost. What is the contribution ratio? 22%. So directly we can take contribution. What is the contribution? Contribution 9 lakh 36,000. Second case 12 lakh 48,000. Next what? Minus fixed cost. Is there any fixed cost? ఏం చెప్తున్నారమ్మా మీరు? కాంట్రిబ్యూషన్ 2 lakh. కార్తిక్ అక్కడ ఉన్న నెంబర్లు చెప్పేస్తున్నారండి. కాంట్రిబ్యూషన్ 12 lakhs into 22%, 2,64,000. నెక్స్ట్ 3,50,000. నెక్స్ట్ what is the next expense, Sirisha? Bad debts. Minus bad debts. First case 1.5%. 12 lakhs into 1.5%. 18,000. Apply 1.5% on sales. Next 2% on 16 lakhs. Next, what is the expense? Next expense? Tax. So this is called as profit before tax. But before profit before tax, we should reduce what? Cash and discount. కార్తిక్ ఏంటి పగబట్టినట్టున్నా? ట్యాక్స్ అంటావు. క్వశ్చన్ నాకు కనిపించదమ్మా. ఐ కెనాట్ సీ ద క్వశ్చన్. మైనస్ వాట్? క్యాష్ డిస్కౌంట్. Cash discount is an expense. Minus cash discount. Cash discount calculation. How many customers are availing cash discount? Present case 50%. So sales 12 lakhs into 50% into 1%. 6,000 is the cash discount. Next, the second case 16 lakhs into 80% into 2%. 25,600. Then you will get profit before tax. What is the profit before tax? 2,40,000. 2,40,000. Correctena numbers? This is profit before tax. Minus what? At the rate of 30%. 72,000. 88,320. So this is profit after tax. 1,60,000. 2,06,000. Profit after tax 2,06,080 minus last point opportunity cost. Opportunity cost. So be careful here. Pre-tax return. What is the pre-tax return required? 15%, but that is pre-tax. Before tax they are expecting 15% return. So see the calculation. Opportunity cost. What is the sales amount? So we should take variable cost, right? Only variable cost. What is the variable cost amount? 9,36,000 into what is the average credit period? 30, 30 days average collection period, ACP, divided by number of days in a year given in the question, 365. Then you will get investment in debtors, into what is the return required? 15 percentage into 70%. 15% into 70%, nothing but 10.5%. Why 15% into 70%? Before tax they want 15, but after tax they require only 10.5. Nothing but 15 into 70%. Clear? 70 alana. Tax rate 30%. Tax rate 30. So nothing but they require only 70. Before tax they wanted 15, but after tax they want only 15 into 70%, 10.5. So amount 8,000. 8078. Next 16 lakhs. Okay, calculation. Okay, calculation. What is the variable cost? Second case, 12,48,000 into 20 divided by 365 into 15% into 70%. 7280 na? 7180 na? Karthik, what is final answer? $1,59,920. 1,98,000. So which is the best one, first one or second one? Second one. It is better to give 2% cash discount. Okay, because net benefit is high. Alternatively, you can reduce the opportunity cost from profit before tax. Here we are reducing opportunity cost after payment of a tax. Instead of that, you can take opportunity cost before payment of a tax. Nothing but you can reduce from profit before tax. In that case, you should not take 70%. You should take only 9,36,000 into 30 divided by 365 into 15%. If you want to reduce opportunity cost from profit before tax, then you should take 15%, because 15% is the before tax return. They are expecting 15% return before the payment of a tax. Clear? Done? అర్థమైంది నేను చెప్పిన పాయింట్, లాస్ట్ పాయింట్. If you are reducing from profit 2,40,000, for suppose if you are reducing from 2,40,000, then you should reduce 9,36,000 into 30 divided by 365 into 15%. Then you will get profit before tax. Then reduce tax at the rate of 30%. Ultimately you will get the same answer, 159,922. So clear? See the sixth question. This is credit should be given to a particular customer or not. A firm is considering pushing up its sales by extending credit facilities to the following categories of customers. First category, customers with a 10% risk of a non-payment. Nothing but 10% will be the bad debts. Second category, customers with a 30% risk of a non-payment. 30% will be the bad debts. The incremental sales expected in case of a category A 40,000, category B 50,000. That means even if you sell 40,000, straight away 10% bad debts. So 4,000 bad debts. The cost of a production and selling cost are 60% of sales, while the collection cost amount to 5% of a sales in case of category A and 10% of a sales in case of category B. You are required to advise the firm about extending credit facilities to each of the above categories of a customer. Let us see the first one, first category. So first category, sales will increase by 40,000. Your selling cost is, production and selling cost is 60%. Then what is the contribution? 40,000 into 40%. 16,000. 16,000 is the contribution, and 16,000 minus what? Collection cost. What is the collection cost? 5% of sales. 4,000 into 5, 40,000 into 5%. 2,000. 14,000 minus bad debts. First case bad debts 40,000 into 10%, 4,000. What is the amount left? 10,000. So 10,000 is the amount left. Okay. Clear? So incremental profit 10,000. So we can extend the credit. What about second case? Incremental sales 50,000. What is the cost of production? 50,000 into 60%, 30,000. Collection cost 10%. So 50,000 into 10%, 5,000. Bad debts 15,000. సరిపోద్ది దానికి అవునా? No profit. No profit. But in this question, one point is missing actually. Required return. Opportunity cost. Opportunity cost is missing. Collection period is also not given in the question. In CA Inter question, they will give collection period and required return. For suppose if collection period and required return is given, then you should reduce what? Opportunity cost also. Clear? So with this we have completed what? Debtors management. So these three questions are enough. Debtors management. Next, inventory management, illustration 10. So 11, these questions you have already done in cost accounting. Same questions, material chapter, same questions. Same questions, okay? So let us see the Baumol model. I mean question number 13. So this is past examination question, illustration number 13. It is similar to EOQ, economic order quantity. Dilip, what is the EOQ formula? Dilip. EOQ is equal to two AO divided by C. EOQ, economic order quantity. It is an ordering quantity at which ordering cost is equal to carrying cost. Ordering cost is equal to carrying cost. Ordering cost A divided by OQ into O. Carrying cost OQ divided by 2 into C. Yes or no? At EOQ, ordering cost will be carrying cost. Next, if ordering quantity increases, carrying cost increases, ordering cost decreases. If ordering quantity increases, number of orders decreases and ordering cost decreases, but carrying cost will increase. I think you know the concept, right? Next, if ordering quantity decreases, carrying cost decreases, ordering cost increases. Am I clear? Done. So we should order higher quantity or what? No, if we order higher quantity, then carrying cost will increase. We should order lesser quantity or what? If we order lesser quantity, ordering cost will increase. We should order EOQ, economic order quantity, so that the overall cost will be minimum, and overall cost will be minimum where ordering cost is equal to carrying cost. Yes or no? So this is EOQ concept, economic order quantity. Similarly, we have a Baumol model. Baumol model. So for maintenance of a optimal cash balance, like EOQ. EOQ is for inventory management. Baumol model is for cash management. Cash is maintained for three purposes: transactional need, safety need, speculation. We should not maintain high amount of cash. That leads to increase in interest cost. If we maintain less amount of a cash, that will affect our liquidity. We may not be able to meet our short-term commitments. That might affect our reputation. Okay. So what is the best balance? Optimum cash balance. Optimum cash balance is determined using a formula. Optimum cash balance is equal to square root of 280 divided by I. 280 divided by I. T means transaction cost, I means interest rate. Okay, no issue. Square root of a 280 divided by what? I. A means annual cash requirement. A means what? Annual cash requirement. T is equal to what? T is equal to transaction cost. I is equal to what? Interest. I is equal to interest. Annual cash requirement, transaction cost, I means what? Interest. For suppose if a cash balance increases, interest cost increases, but transaction cost decreases. So we can call it as transaction size. What is this transaction size actually? If a transaction size increases, interest cost increases and interest cost increases and transaction cost decreases, and vice versa. That means if a transaction size decreases, interest cost decreases and transaction cost increases. What is this transaction cost? Generally, a company, if it is having a cash, it will be making investment in marketable securities. Marketable securities. The name itself indicates marketable. Marketable means what? Can be sold at any time. At any time we can sell the security, marketable security. Marketable security. A security is called as marketable if it is, first point, if it is marketable, it can be sold at any time. For example, unlisted company share is not a marketable security. Why unlisted company's security is not a marketable security? Finding a buyer is difficult. But for listed company, we can find the buyer very easily. Okay. So marketable security means the security which can be converted into cash immediately. So marketable securities are considered as cash equivalent. Cash equivalent. Marketable securities are equal to cash. For example, Reliance share. If you have a Reliance share, that can be easily converted into cash. Okay. But just because it can be converted into cash, that cannot be called as a marketable security. Safety of a principal. Reliance share will keeps on fluctuating. Price might increase or decrease. So that's why generally these equity shares are not considered as a marketable securities, because the share price keeps on fluctuating. No doubt the security must be marketable. Reliance share, TCS share, Wipro share are marketable, but still they are not considered as a cash equivalent. They are not considered as marketable securities. Treasury bills, RBI treasury bill. RBI treasury bill is considered as marketable security. RBI treasury bill, maturity 91 days, 182 days. So those treasury bills are considered as what? Marketable security. Why they are considered as marketable security? Because they are marketable, they can be sold at any time. And second, safety. The price will not get fluctuated. Price will not get fluctuated. So that's why those RBI treasury bills or treasury bonds will be considered as a cash equivalent. Cash equivalent. So whenever we have a surplus cash, that surplus cash will be invested in what? Marketable securities. So okay, surplus cash. The entire surplus cash will be invested in marketable securities. Even though we invested this amount in marketable securities, that is what? Equal to cash, because that can be converted anytime into cash. Okay, clear? But what is the advantage here? Instead of keeping cash idle, if you are making investment in marketable securities, you can earn interest. You can earn interest, yes or no? You can earn some interest. Okay. So that's why we make investment in marketable securities. Now the formula is for, here the formula given is for optimum transaction size. Like EOQ is also ordering quantity. At once, what is the quantity to be ordered? Likewise here, optimum transaction size. What is the optimum transaction size? Optimum means best. For suppose 3,60,000 invested in what? Marketable securities, 3,60,000. And annual requirement is 3,60,000. Annual requirement is equal to 3,60,000. In a year you require a cash of 3,60,000. 3,60,000 invested in marketable securities. Now the point is, what you can do is sell all marketable securities on 1st April. Then you will receive 3,60,000. Use this 3,60,000 for next 360 days. Okay, that means only one transaction. Only one transaction. Transaction size is equal to 3,60,000. Transaction size is equal to 3,60,000. Only one transaction, and your transaction cost will be less. Only one transaction, yes or no? But the interest cost will increase. You are losing an interest. You are losing an interest because you are selling all the marketable securities on 1st April. Okay. Alternatively, what you can do is 3,60,000 is the annual requirement. 360 days, that means per day requirement is 1,000. One day you require how much? 1,000. For suppose if you require only 1,000 rupees, if you require only 1,000 rupees per day. Second option is daily sell 1,000 rupees worth of a marketable securities. Daily 1,000. So then what? Total 360 transactions. Total 360 transactions, transaction cost will increase, but interest cost will be decreased. Are you getting my point? For transaction size decreases, number of a transaction increases, number of transactions increases, and transaction cost increases, but interest cost will decrease. Okay. So next, what should be the transaction size actually? 360 or 1000? 316 or 1000 ante for that only we use the formula, that is square root of 280 divided by I. 2 into annual requirement into transaction cost divided by I. For example, in question number 13, 8 lakhs for 1 month. 8 lakhs for 1 month means per annum 8 lakhs into 12. What is the transaction cost? 250. Interest on marketable securities 12%. Calculate the optimum transaction size. Optimum transaction size. What is optimum transaction size? Square root of 2 lakhs into 2 into 250 into 96 lakhs divided by 0.12. 2 lakhs. In question bank, instead of annual requirement, month requirement is taken. 2 into 250 into 8 lakhs divided by what? Interest per month. If you are taking month requirement, in denominator you should take month interest rate. In both the cases you will get same answer. 2 lakhs is the optimum transaction size. Next question, average cash balance. What is average cash balance? On an average we carry 1 lakh cash. You know the logic. Average inventory means OQ divided by 2. Likewise here also average cash balance means 2 lakhs divided by 2. Why? In the beginning 2 lakhs, by the ending 0. So on an average you carry 2 lakhs plus 0 divided by 2. So 1 lakh. Number of transactions per month. Per month how many transactions? 8 lakhs divided by 2 lakhs divided by 8 lakhs divided by 2 lakhs. How many transactions? 4 transactions. Clear? What is the optimum transaction size? Optimum transaction size 2 lakhs. For example, instead of 2 lakhs, you can do a transaction worth 8 lakhs, or you can do a transaction which is worth of 1 lakh. Then let us calculate transaction cost. If you are making a transaction worth 1 lakh, then how many transactions you are going to do? Per month 8. Per year 12 into 8. Yes or no? Nothing but 96 lakhs divided by 1 lakh. 96 into, what is the transaction cost? 250. 24,000. What about interest cost? Interest cost. So what is the average cash balance? 1 lakh divided by 2. Because in the beginning 1 lakh, by the ending 0. So on an average I carry 50,000 cash. 50,000 into 12%. 6,000. So the overall cost is 30,000. The overall cost is 30,000. Next, second case. Second case, 96 lakhs divided by 2 lakhs into 250, 12,000. What about the interest cost? 2 lakhs divided by 2 into 12%, 12 total. If you see the June 24 question, various transaction charges are given, various transaction sizes are given, various transaction sizes are given, and they asked you to find out the cost. So here in first case what, 30,000, second case 24. Let us see the third case. 96 lakhs divided by 8 lakhs into 250. Last case, 8 lakhs divided by 2 into 12%. 51,000. 51,000. Okay, which is the best one? Second one is the best one, right? Cost is less. That's why it is called as the optimum transaction size, or it can be called as optimum cash balance. Clear? Similar to EOQ, economic order quantity. Transaction cost is similar to ordering cost. Interest cost is similar to carrying cost. Clear? So this is what a cash management question. I think cash budget questions are not being asked for you. Cash budget, only EOQ are being asked. Okay, see the 16th question. One MCQ was asked. Commercial paper. Commercial paper is issued at discount, redeemable at face value, similar to zero coupon bond. But whereas commercial paper maturity will be 90 days, 180, 270, it is a money market instrument. Maturity will be less than 1 year. Maturity will be less than 1 year. Commercial paper, it is similar to a promissory note issued by the company. XYZ Limited issued commercial paper as per the following details. Date of issue 17th December. Date of maturity 17th March. Issued at discount, redeemable at face value. Zero coupon bond also same, but zero coupon bond maturity will be what? More than 1 year. So there is another security which is similar to zero coupon bond, that is called deep discount bond. Deep discount. Deep discount means heavy discount. So deep discount bond maturity will be generally 20 years, 25, 30 years. Deep discount. So deep discount bond means, example, issued at 2,500, redeemable at 1 lakh. Issued at 2,500, redeemable at 1 lakh after 30 years. Nothing but if investor is giving 2,500 as on today, he will get 1 lakh after 30 years. So this is called as what? Deep discount bond. Discount is deep. So the discount amount is what? 97,500. But the common point is issued at discount, redeemable at face value. Size of issue 10 crores, number of days 90 days, interest rate 11.25, face value 100. So what is the net amount realized? Simple. Forget about the calculation there. So what is the net amount received by the company on issue of commercial paper? What is the size of issue? 10 crores. So these are issued at discount. These are issued at discount. Size of issue is 10 crores. That doesn't mean we receive 10 crores. These are issued at discount, redeemable at face value. That means after 90 days we repay 10 crores. 10 crores. You know the formula, right? P is equal to A into 1 plus I power n. Nothing but to bring the future value to the present value, we do a discounting. So what is the amount? 10 CR divided by 1 plus 0.1125 into 90 divided by 360. We should not divide 10 crores with 1.1125 because maturity is only within 90 days. So that's why we should take 90 days interest rate. 90 days interest rate. So 1 plus 0.1125. Nothing but first in calculator you should take 0.1125. 0.1125 into 90 divided by 360. 0.0 0.028125. So now in calculator take 10 CR. 10 CR divided by 1.02. 10 CR divided by 1.02 8125. 9 point. So that is what? 9.73 crores. 9.73 crores. In MCQ they have given net realized amount. Net realized amount is given and issue size is also given. They asked you to find out the rate of interest. Rate of interest. Rate of interest find out cheyamante then 10 crores minus 9.73 divided by what? 9.73. 10 crores minus 9.73. 10 crores minus 9.73 is the benefit to the investor. 10 crores minus 9.73 is the benefit to the investor divided by 9.73 is the investment. Then you will get 11.25 something. I mean 0.112 something. 0.02 something into 360 divided by what? 90. Because that 0 point something is for 90 days. 0.11 that's what 0.1125 something interest rate వస్తుంది అప్పుడు. క్లియరా కార్తిక్? Interest rate calculation 10 CR minus 9.73. What is this 10 CR minus 9.73? Discount. This discount is benefit to the investor because investor will be purchasing a commercial paper at 9.73 and after 90 days he will receive 10 crores. The difference is benefit, Dilip, divided by what is the investment? 9.73. That is the return on investment to the investor. Return on investment to the investor means company is paying interest. Company is paying interest. You will get 0.28, 0.0227 something. That is for 90 days. That has to be converted into how many days? 360 days. So that's why divide by 90 into 360. 0.11 into what? 100. Convert the number into percentage. 11.09. Because we are not taking the full amount. We are taking just 9.73. If you are taking exact number, then the answer will be different. So clear? First commercial paper అర్థమైందా? కమర్షియల్ పేపర్ అంటే ఏంటి? issued at discount, redeemable at face value. issue size is 10 crores. Company will be issuing commercial paper. After 90 days, company will pay 10 crores to the investor. Now, company will receive only 9.73, only 9.73 from the investor. The difference amount is, from the company point of view, the difference amount is said to be discount or interest So difference amount is called as discount. The discount is interest to the company and return to the investor, benefit to the investor. అర్థమవుతుందా? జీరో కూపన్ బాండ్ కూడా అంతే. జీరో కూపన్ బాండ్ ఈజ్ ఇష్యూడ్ ఎట్ డిస్కౌంట్, రిడీమబుల్ ఎట్ ఫేస్ వాల్యూ. Similar to zero coupon bond, this concept. But this is a money market instrument. Money market instrument means maturity less than 1 year. Short term. This is short term. Commercial papers are issued if you require money for short term purpose. So clear? Karthik? Next topic, cash flow statement. Cash flow statement. In last 3 items, one time a question has been asked from cash flow statement, and one time question was asked from fund flow statement. Okay. So ratio analysis is most important topic. Ratio analysis. So ratio analysis, in the last 3 attempts, total 7 questions were asked. Total 7 questions. Okay. So first let us complete cash flow statement and then fund flow statement. Later on ratio analysis. Cash flow statement. So cash book. In cash book we record about all cash transactions. Yes or no? Financial statements includes balance sheet, P&L account, and cash flow statement and notes to accounts. Notes to accounts. So what is the purpose of preparing a P&L account? To know the performance during the year. To know the performance during the year. Whether we got a profit or a loss during the year. And next what? Balance sheet. What is the purpose of preparing a balance sheet? The purpose of preparing a balance sheet is to know the financial position as on a particular date. As on particular date. For example, as on 31st March, what is the financial position? How many assets are there and how many liabilities are there? Okay. So assets minus outside liabilities. Whether net worth. Net worth is also called as equity or proprietary fund. Proprietary fund. Net worth is also called as equity. Net worth is equal to total assets minus outside liabilities. So we prepare a balance sheet to know the financial position as on a particular date. Okay. So what is the purpose of preparing a cash flow statement? The purpose of cash flow statement is to know the ability of generating a cash. To know the ability of a business to generate a cash. Sir, by seeing a cash book also we can, if you see the balance sheet, for example, in balance sheet you will find opening cash and closing cash. The difference between the cash is what? Increase or decrease in cash during the year. Yes or no? You can see the opening cash balance and closing cash balance. The difference between the opening cash balance and closing cash balance is nothing but what? Increase or decrease in cash. Increase or decrease in cash. Okay. By seeing the balance sheet, we can ascertain only the increase or decrease in cash. But we don't know the reasons for increase or decrease in cash. What is the reason? Why the cash has got decreased or why the cost has got increased? We don't know the reasons. For that reasons we cannot go through the cash book, because cash book will contain lots of transactions. Okay. For example, if you see the DMart cash book, you will find millions of transactions. If you see the PhonePe Cash book, you will see the millions of transactions. Zomato, Swiggy, you will find millions of transactions. Yes or no? So what is the reason? Okay. So we don't know the reason. By seeing the balance sheet, we can ascertain the increase or decrease in cash, but we cannot find the reason. Likewise, if you see the cash book, you will find millions of transactions. A chief financial officer, a top level management cannot go through the cash book. Okay. They want a summarized report. They want a summarized report, and they should know the reasons behind the increase or decrease in cash. So that's why we're preparing a cash flow statement. Cash flow statement reveals the causes, reasons of a change in cash position of a business concern between two dates of a balance sheet. The purpose of preparing a cash flow statement is to reveal the causes, reasons for change in cash position of a business concern between two dates of a balance sheet. Nothing but it is a summarized report. Okay. So according to Ind AS 7, an enterprise should prepare a cash flow statement and should present it for each period with financial statements prepared. Here cash means what? Meaning of a cash. Cash means cash on hand. Cash includes what? Cash on hand and demand deposits with bank. Demand deposits means what? Whenever you demand for money, bank will give back that money. Demand deposit. Fixed deposit means what? We cannot demand at any point of time. For example, you have made a fixed deposit for 5 years. Okay, after 5 years only you can ask back the money. Okay, so demand deposit means what? Demand means asking. If you are asking the money, bank is giving back the money. So that is called as what? Demand deposit. So cash includes cash on hand and simple bank balance. Bank balance. Cash equivalents. These includes purely short-term, high liquid investments which are readily convertible into cash. Marketable securities. Marketable securities are cash equivalents. And here cash flow means, in this chapter, cash flow means what? This includes cash inflows and cash outflows of a cash and cash equivalents. Classification of a cash flows. According to Ind AS 7, cash flows are classified into 3 activities: operating activity, investing activity, financing activity. So this is simple common sense point. There are 3 activities: operating activity, financing activity, investment activities. Investment activities. Okay. So we divide the cash flows into 3 categories: operating, financing, investing. Why? Because for suppose if any person is having a cash, there might be 3 reasons. There might be 3 reasons. There might be what? 3 reasons. Okay. So for example, Manoj Kamam Kanna, he is having a cash. He is holding lot of cash. He is holding lot of cash. For example, he is having 10 lakhs cash. So what might be the reason for 10 lakhs? First reason. So that might be a hard work. That might be what? Hard work. Okay. That might be a hard work. Yes or no? He is selling pani puri. Okay. Nearby Nala. Okay. Nala ante telusu kada? Murikkalva. So that akkada sale chestane business baga jarugutadi pani puri. So the point is, he is selling Manoj, he is selling a pani puri nearby Nala, and he generated a cash flow of rupees 10 lakhs. Now his in-laws will like him or not? His in-laws, in the sense mother-in-law or father-in-law, like Manoj or not? Why? Why they like Manoj? Because he is generating 10 lakhs cash from a business. From a business. Good person, responsible person. He is generating what? Cash out of a business. Okay, out of a business. Okay. So obviously what? This is a positive sign. This is a positive sign because cash is generated from a business. Cash is generated from business. Okay. So for example, Ganesh. Okay. Ganesh is holding 10 lakh rupees cash. Ganesh is holding 10 lakh rupees cash. Okay. First thing, before marriage, he demanded one bike from in-laws. He demanded one bike from in-laws, and he asked for investment to start a bakery. 10 lakh rupees investment to start a bakery. Okay. And he asked 10 lakhs for marriage expenses. 10 lakhs for marriage expenses and 10 lakhs for gold. 10 lakhs for gold. Now, the reason is, okay, he didn't started any bakery. He didn't started any bakery. He placed the gold given by in-laws. He placed the gold placed the gold. Nothing but he sold the gold. He sold the gold. Gold has been sold. Now tell me, so whether in-laws will have a positive, opinion on Ganesh or not? No, because cash is not generated from business. Cash is not generated from business. అమ్మేస్తున్నాడు మొత్తం. అర్థమవుతుందా? గోల్డ్ ఏంటమ్మా అమ్మేశాడు. సో దట్స్ వై హీ ఈస్ హ్యావింగ్ అ క్యాష్. నథింగ్ బట్ if some person is holding a cash, that doesn't mean he is doing a hard work. So one thing, he might be doing a hard work. Okay, first reason, he might be doing a hard work. Second reason, what? He might be selling properties inherited from grandfather or fathers. He might be selling the properties, yes or no? If he is selling the property, that is investing activity. That is investing activity. But not cash inflow, cash outflow. Cash outflow. Cash outflow. He is not investing actually. He is selling the properties and generating a cash. Cash inflow. Cash inflow. He is selling the property. He is selling the property. So cash is generated from what? Investing activity. He is not purchasing the property. He is selling the property and generating a cash. Is it a positive sign? No. Likewise, business may have a cash. Business may have a good cash position. That doesn't mean what? Cash is generated from business. So the company might be what? Selling the assets. A company might be selling car, company might be selling AC, company might be selling bus, whatever. So that is what? A cash from investing activity. Cash from investing activity. Okay. Likewise, our ACP Manoj is having a cash 10 lakhs. Always he is holding a cash. So what might be the reason? Manoj, first DCP Manoj is generating cash from business. So that is a positive sign. Yes or no? Ganesh is generating cash by selling property. That is a positive sign or negative sign? Negative sign. Yes or no? The third one, okay, Kanna kada, ACP Manoj. So ACP Manoj, he is having a cash 10 lakhs, but he has taken a loan from all the loan apps. He has taken a loan from all the loan apps and he has taken a Mudra loan also. Okay. Now, he is also generating a cash, but financing activity. Financing activity. He doesn't have any property to sell. Okay. He doesn't have any property to sell. He is taking a loan. He is taking a loan. That means generally cash can be generated by three ways. Common sense. One, we can earn by doing a job or something. So that gives a positive sign. Second way of generating cash is what? Selling properties. Selling property. And third one is what? Taking loans. Taking loans. Generally, from operating activities, there should be a cash inflow. From operating activity means principal business. Cash generated from principal business. Cash generated from a principal business. For example, for our college fee is a cash flow from operating activity. Cash flow from operating activity. College fee, hostel fee is a cash flow from operating activity. Okay. For example, we are selling a scrap and we received a 5,000, or we are selling a bus, okay, and receiving an amount. That is what cash flow from investing activity. If we are taking a loan from a bank, that is cash flow from financing activity. Cash flow from financing activity. Generally, there should be a cash flow from operating activity. That is a good sign. Okay. Investors, okay, will have a positive opinion on a company if there is a cash flow from operating activity. Okay. Next, there should be a cash outflow. There should be a cash outflow in case of investing activity. If there is a cash outflow in investing activity, means what? The company is purchasing a new assets. Company is purchasing a new assets. If there is a cash outflow from investing activity, that indicates what? Company is purchasing new assets. Clearer? If there is a cash outflow from financing activity, that means we are repaying the loans. We are repaying the loans. That is also a good sign. We are not taking further loans. We are what? Repaying the loans. So generally there should be a cash inflow from operating activity. There should be a cash outflow from investing activity. Cash outflow from financing activity. Clear? Done? Yes or no? Simple common sense. If your family is purchasing an asset, so is it a good sign or negative sign? Good sign. Is there a cash inflow or cash outflow? Cash outflow. So cash outflow from investing activity is a good sign. For suppose if a family is repaying the debt, your family has taken a loan, and if they are repaying that loan, is it a positive sign or a negative sign? Positive sign. Cash outflow from financing activity. Simple common sense. If there is a cash inflow from a principal business of your family, for example, your principal business might be a kirana store or a petrol bunk, whatever it might be. If there is a cash inflow from that principal business, then that is what? Positive sign. But if there is a cash outflow, operating activity is cash outflow, that is a negative sign. You're losing cash in your principal business, yes or no? So that cannot be, without preparing a cash flow statement, I will not be knowing how much cash I am generating from a principal business. By seeing a balance sheet, I cannot. By seeing a P&L account, I cannot. By seeing a cash book, I cannot, because in cash book, all the transactions are recorded. Operating, investing, financing, and there will be millions of transactions. Millions. Zomato, Swiggy, millions of transactions. Those millions of transactions are categorized into operating, investing, and financing. Operating, investing, and financing. So that the top level management will use this cash flow statement for decision making. For decision making. Clearer? And what is operating activity and what is financing activity? You have to apply your common sense. We cannot, we need not by heart the points given here. So generally, for example, interest paid. Interest paid. Interest paid comes under what? Financing activity. Because why we are paying interest? Because we have taken a loan. So taking a loan is a financing activity. If you are paying an interest on a loan, that is financing activity. Financing activity. Am I clear? Done? But if it is a bank, if you are preparing a cash flow statement for a bank, then what? Interest paid is an operating activity. Okay. Next, interest received. Interest received is an investing activity. You might have bought debentures in other company. Okay. So interest received is what? Investment activity. For suppose if it is a bank, interest received, operating activity, because principal business of a bank is accepting deposits and giving loans. So interest received is a Operating activity. Operating activity. For NBFC also, non-banking finance company. Non-banking finance company means Bajaj Finance, okay, Muthoot Finance, Manappuram, all these are what? Non-banking finance companies. So these non-banking finance companies also what? So if they are receiving interest, that is operating activity. So clear? So that means you have to apply your common sense. So purchase of a land, purchase of a land. So purchase of land what? Investing activity. But suppose if it is a real estate, operating activity. Purchase of a bus, investing activity. For suppose if a company is an automobile dealer, purchase of bus, operating activity. Selling a bus, operating activity. So you have to apply your common sense. First you have to see the business, what type of a business the company is doing. Okay. So cash flow from operating activities are the principal revenue producing activities. Principal revenue producing activities. Okay. So these are the key indicator to the extent to which the operations of enterprise have generated sufficient cash flows. So examples, important operating activities, sale of a goods and rendering of a service. A practicing cost accountant receiving a fee for filing an ITR, income tax return, or for filing a GST return, or for doing a tax audit. Right now, a cost accountant cannot sign tax audit report, but still they can do a work and get signed by a practicing chartered accountant. Okay. So if they are filing MCA filings, Ministry of Corporate Affairs, company related filings. So if they are receiving any fees, that fees comes under what? Operating activity. Cash receipt from royalty. Cash receipt from royalty, fees, commission and other revenue. What is this royalty? Royalty. Royalty is paid for using a franchise or a copyright. Franchise or a copyright. Franchise or a copyright. For example, Mahatma, he is starting a KFC on a bypass road. I'm sorry, Mahatma, you don't like non-veg. So he is what? He is what? Wanted to start a KFC. Okay, he wanted to start a KFC. So he took a franchise from KFC. Franchise. Okay. So he is called as a franchisee. Franchisee. So he has to make some lump sum amount, lump sum payment, and he has to pay a royalty. For example, on every sale amount, he has to pay 1% royalty. 1% royalty. This 1% royalty is an income to KFC. And that royalty is cash generated from what? Operating activity. Cash generated from operating activity. Am I clear? Okay. Likewise, Pavan has written a book. Okay. How to be a good son. How to be a good son. He has written a book and copyright is reserved. Copyright is reserved. Copyright is reserved. Now, Vasant Publications wanted to publish this book. So, now Vasant Publications has to pay royalty to Pavan on every book sold. On every book sold, royalty has to be paid by Vasant Publications to Pavan. For Pavan, it is what? Operating activity. Income from, cash flow from operating activity. So clear? Next, cash payment to supplier for goods and services. It is an outflow. It is an outflow. Cash payment to and on behalf of employees. That is also what? Cash flow from operating activity. Next, cash receipt and cash payments of an insurance enterprise for premiums and claims. If it is an insurance company, then premium received, payment of a claims comes under what? Operating activity. Cash payments or refunds of income tax. Cash payment. If you are paying tax, that is an operating activity. If you are getting a refund, that is an operating activity unless otherwise specifically they have mentioned. Okay. Generally tax is paid on PGBP. If they are not mentioning anything, we assume that the tax is paid on PGBP. Okay. But for suppose they have told you that tax is paid on, okay, capital gain. An asset has been sold, okay, you got a capital gain and tax is paid. Then that comes under what? Investment activity. Investment activity. If they have specifically given, then that is categorized as investing or financing. Otherwise, it is what? Operating activity. Okay. So, sale of a plant. Sale of a plant. G point is not necessary for you. Sale of an item of a plant may give rise to gain or a loss. Okay. Which is included in the determination of net profit or loss. That is non-operating activity. Gain or loss on a sale of a plant and machinery is not what? Operating activity. Next, investing activity. Investing activity means cash generated by acquisition or disposal of a long-term assets and other investments not included in the cash equivalents. Short-term investments or marketable securities are included in cash equivalents. Okay. So, a separate disclosure. I mean, these cash flows from investing activities are disclosed under heading investment activities, investing activities. Examples: cash payment to what? Acquire fixed assets, including intangible. Example: trademark. Trademark is an intangible asset. Trademark includes logo or a brand name. So, bingo is a trademark. Company is an ITC. Dark fantasy is a trademark. Company is an ITC. Sunfeast is a brand name, trademark. ITC is the company. Vivel is a brand name. Company is an ITC. Company is a ITC. Classmate is a trademark, but company ITC. So trademark is an intangible asset. So Kingfisher is a trademark. Company is not a Kingfisher. So Kingfisher originally belongs to a Indian company, but recently 3-4 years back it has been acquired by Daigo UK company. So Kingfisher is a brand name, trademark. Okay. So Swift is a trademark. Swift and that logo, Mahindra logo, all these are what? Trademarks. Nike, Adidas, all these are trademarks. So cash payment to acquire a fixed assets is a investing activity. Cash receipt from disposal of fixed assets, investing activity. But second one is inflow. First one is outflow. Cash payment to acquire shares, warrants, debt instruments comes under investing activity. If you are purchasing a share or a debenture or a warrant in other companies, that is what? Investing activity. Cash receipt from disposal of a shares. If you are selling shares, warrants or debt instruments, that is also investing activity. Cash advance or loans made to the third party. If you are giving any loans to the third party, so that is also investing activity. If you are giving any advances to the third party, that is an investing activity. But if it is a banking company, that is an operating activity. Cash receipt from repayment of advances. The other party is repaying the loan or a advance. That is what? A cash receipt from investing activity. G point is not required and H is also not required for you. Next, concept 3. Financing activity. That is not investing activity. That is what? Financing activity. Financing activity means what? Procurement of funds by way of equity or a debt. So this also requires a separate disclosure. Cash proceeds from issuing a shares or other similar instruments. For example, if you are issuing shares, okay, shares, right shares, bonus shares, okay, sweat equity shares, whatever. So that is what cash flow from what? Financing activity. Next, cash proceeds from issuing debentures, notes, bonds, and other long or short term borrowings. Other short term or long term borrowings, what? Financing activity. Next, what? Repayment. Repayment. Debentures repayment, buyback of a shares, buyback of shares, redemption of preference shares, redemption of bonds, repayment of loans. It is a cash outflow. Comes under finance activity. Okay. So clear? So there are other points also, but they are not asking that depth here. So there are two methods here: direct method, indirect method. The question asked in the examination was direct method. So the transactions were given and they asked you to what? Segregate. Direct method means nothing but what? Cash flows will be given. So we have to identify which cash flow comes under investing or financing or operating. We have to categorize. That is a simple method. So what is that? Direct method. Second one is what? Indirect method. Second one is what? Indirect method. So little complicated, but you have to understand indirect method also to understand fund flow statement. To understand fund flow statement, first you have to understand indirect method. Indirect method. So what is the first method? Direct method. So direct method is simple. So mostly they might ask you direct method only in examination because the weightage of each question is 7 marks. Okay. So for 7 marks they may not ask indirect method. The less the chances they might ask for 7 marks indirect method. So but you have to learn indirect method also in order to understand fund flow statement. So see the 7th question, direct method. So how do we identify, which method to be followed, direct or indirect? If a receipt from customers and payment to suppliers are given, then direct method. For suppose if in the question sales are not given, purchases are not given, okay, net profit is given, then you should proceed from indirect method. Indirect method. See the illustration number 7. So this question, similar question was asked in examination. Vedika Limited gives you the following information for the year ended 31st March 2018. Sales for the year totaled 96 lakhs. The company sells goods for cash only. That means entire 96 lakhs is an operating activity. Inflow or outflow? It is an inflow. Cost of a goods sold was 60% of sales. 60% of sales. Closing inventory was higher than opening inventory by rupees 20 lakhs. Sorry, 20,000. By using this information, we can find out purchases. Cost of a good sold is equal to opening stock plus purchases minus closing stock. Okay. We assume it is a retail business. We assume it is a retail business. When the business is retail business, then cost of a good sold is equal to opening stock plus purchases minus closing stock. Next, tax paid amounted to rupees 7 lakhs. Other expenses total rupees 21 lakh 45,000. Outstanding expenses on 31st March 2017 and 31st March 2018 total 82,000 and 91,000 respectively. New machinery and furniture costing rupees 10 lakh 50,000 in all were purchased. One equipment was sold for rupees 20,000. A right issue was made of 50,000 shares of rupees 10 each at a premium of rupees 3 per share. Right issue means the shares issued to the existing shareholders. The entire money was received with application. The entire money was received with application only. Dividends totaling rupees 4 lakhs were distributed among the shareholders. Cash in hand and bank at 31st March 2017 and 31st March 2018 total. Opening cash and closing cash are given. You are required to prepare a cash flow statement as per not CAS, that is Accounting Standard 3 for the year ended 31st March 2018 using direct method. By using what? Direct method. Simple direct method. Okay. So when opening cash and closing cash are given, you will get to know whether you are doing right or wrong. But generally sometimes they may not give what? Closing cash. Closing cash. So cash flow from operating activity. First, cash receipt from customers. What is the cash receipt from customers? Cash receipt from customers. 96 lakhs. It comes under what? Operating activity. Next one. Cost of a good sold. 60% of our sales. Closing inventory was higher than opening inventory by rupees 20,000. Cost of a goods sold 60%. First let us find out cost of a goods sold. 96 lakhs into 60%. 57 lakh 60,000. 57 lakh 60,000. Okay. So what is this cost of a goods sold? Closing inventory was higher than opening inventory by rupees 20,000. By rupees 20,000. So be careful. So what is the formula for cost of a goods sold? Cost of a goods sold is equal to, you can take two formulas here, opening stock plus, straight away take opening stock plus purchase minus closing stock. So what is the cost of a goods sold amount? So first of all write here what is the given? Closing inventory is higher than what? Opening inventory. Nothing but closing stock minus opening stock is equal to 10,000, right? So let us write purchases is equal to cost of a goods sold plus closing stock minus opening stock. Yes or no? What is the cost of a goods sold amount? Plus closing stock minus opening stock. Closing stock is higher than the opening stock by 20,000. Nothing but closing stock minus opening stock is equal to 20,000. So that is equal to 57 lakh 80,000. So this is one way of a calculation. So you will get purchases. You will get purchases. Done. Okay. Next point. Other expenses totaled 21 lakh 45,000. Other expenses 21 lakh 45,000. Okay. Outstanding expenses beginning 82,000, closing 91,000. Okay. So other expenses total, what is the total amount? 21 lakh 45,000. That is accrued. That is what? Accrued. But we should find out what expenses paid. Expenses paid is equal to what? Expenses paid is equal to 21 lakh 45,000 is accrued. Accrued. To find out the cash paid. Add what? Opening outstanding. Add opening outstanding because we pay previous year outstanding first. Yes or no? Add 80 minus what? 91,000. 21 lakh 36,000 is the amount paid, expenses paid. So in total, the amount paid is equal to 57 lakh 80 plus purchase 57 lakh 80 plus expenses 21 lakh 79 lakh 16,000. So here amount, total amount is taken, cash paid to supplier and employees. If you see the calculation, cost of a good sold, they are adding expenses incurred, outstanding expenses at the end, sorry, at the beginning, add, minus what? Outstanding expenses at the end. Next, excess of closing inventory over opening inventory, 20,000. They are reducing, adding up, adding. So we have also added, yes or no? 57 lakh 60,000 plus 20,000. So clear? Tax paid is also what? Operating activity. Tax paid is also what? Operating activity. But this 16.84 lakhs is said to be cash inflow from cash flow from operations before tax. Cash inflow from operations before tax minus what? Tax. Then you will get net cash flow from operating activity. Net cash flow from operating activity. Clear? Next, what is the next one given? New machinery and furniture costing rupees 10 lakh 50 was purchased. Is it an inflow or outflow? Outflow. Outflow will be kept in brackets. Next one equipment was sold for rupees 20,000. That is inflow, investing activity. So the net cash from investing activity is equal to 10.3 lakhs. Inflow na outflow na? Outflow. What about the next one? Rights issue. 50,000 shares issued at 13 rupees. So 50,000 into 13. 6,50,000. Inflow or outflow? Inflow. Dividend distributed 4 lakhs. Outflow. Dividend distributed outflow 4 lakhs. Our company is distributing dividend to the shareholders. That is outflow. Clear? So 2.5 is what? Net cash from financing activity. This 2.4 is the cash generated during the year. Cash and cash equivalents generated during the year. From from operating activity 9.84 lakhs cash generated. Investing 10.30 outflow. That means we have purchased assets. Next what? Financing activity. Inflow 2.5. That means we have taken a new debt, procured fund. And the overall cash and cash equivalents generated during the year. 2.04. Add opening. What is opening cash? 2.1. So closing cash is equal to 4.14. Financing తీసుకుంది. So here cash flow from financing activity is not taken in the bold. Dividend paid comes under what? Financing activity. Issue of a shares comes under what? Financing activity. If our company is purchasing shares in other company, that comes under investing activity. Dividend is received. For example, if dividend is received, that comes under investing activity. But if our company is issuing shares or debentures, comes under what? financing activity. Dividend paid, interest paid will come under financing activity. But if our company is purchasing shares or debentures in other company, that is investing activity. And if you are receiving any interest or dividend, investing activity. Clear? Done? So this is a direct method. This is what? A direct method, simple method. So this was asked in the examination. So okay, operating, financing and investing. Next, see the previous question, illustration number 6. Illustration number 6. S Limited has furnished the following information for the year ended 31st March 2019. 2019. Net profit 35,500 lakhs. Dividend including interim dividend paid. Provision for income tax. Income tax paid during the year. Loss on sale of asset. Loss on sale of asset. Book value of asset sold. Depreciation charged to P&L. Profit on sale of investment. Value of investment sold. Interest expenses. Interest paid during the year. Increasing working capital excluding cash and bank balance. Obviously, why? At the end, the amount we are finding is nothing but increase or decrease in cash and cash equivalents during the year. So that's why here increase in working capital excluding cash and bank balance. For suppose if cash and bank balance is also included, then at the end you will get 0. At the end, for example, in previous question you got at the end 2.04. Instead of 2.04 you will get what? 0. Next, purchase of fixed assets, opening cash bank, cash and bank, closing cash and bank. You are required to prepare cash flow statement in accordance with accounting standard 3 revised. So whether we can do a direct method or not for this question? For this question we cannot do a direct method. We cannot do a direct method because the reason is amount received from the customers, sales is not given. Payment made to the supplier is not given. Payment made to supplier given or not? So not given in the question actually. Okay. Payment made to a supplier, employees, salaries paid is also not provided in the question. So that means this question cannot be done using a direct method. Obviously we should go for indirect method only. What is this indirect method? Okay. So direct method means straight away you are taking what? Receipt from customers, payment to suppliers, salary is paid, etc. Directly we are taking. So here indirect, nothing but an investor who is seeing the cash flow statement will not be finding the receipt from customers. Ultimately he will be finding the cash generated from operations. But by seeing the indirect cash flow statement, indirect method cash flow statement, investor will not be able to find cash received from customers and payment made to suppliers or expenses paid. Cannot. Okay. What is this actually? For example, trading and P&L account. Trading and P&L account. If you can visualize the simple trading and P&L account, on left hand side you will write to opening stock. To opening stock. Yes or no? If you can visualize the trading and P&L account, from the foundation you are preparing trading and P&L account. In trading and P&L account, on left hand side you will find what? To opening stock. Next what? To purchases. To purchase. Next what? To direct expenses. To direct expenses. On right hand side you will find by sales. By closing stock. The difference amount is what? Gross profit. And again by gross profit. Then you will take what? So 2 indirect expenses, if any. Next what? 2 tax, 2 provision for tax, 2 depreciation, 2 depreciation, 2 bad debts, etc. Likewise, there can be 2 interest paid, 2 dividend paid, 2 interest paid, 2 dividend paid. Next what? So by interest received, by dividend received, by profit on sale of investment, to loss on sale of a investment. Yes or no? Yes or no? So there can be an extraordinary items like claim received on plant and machinery. Claim received on plant and machinery. For example, so due to fire, plant and machinery was destroyed. So you will receive a claim. That is an extraordinary activity. That is not an ordinary activity. Extraordinary activity. So if you are receiving an insurance claim, that is an extraordinary activity. First thing, that P&L account, if you can visualize the simple P&L account, so left hand side you will find 2 opening stock, 2 purchases, right hand side by sales, by closing stock, and gross profit. And again this gross profit is brought to P&L account. So thereafter you can visualize the P&L account. In P&L account you will find what? 2 indirect expenses, 2 provision for tax, 2 interest paid, 2 dividend paid. Yes or no? 2 provision for bad debts. Next, 2 loss on sale of asset, 2 loss on sale of asset or loss on sale of investment. On right hand side you will find profit on sale of asset or profit on sale of a investment. Yes or no? So whether we can directly take the net profit in cash flow from operating activity? No, we cannot take directly the net profit under cash flow from operating activity, because that net profit is arrived. That net profit is arrived after taking into consideration profit on sale of asset or loss on sale of asset or provision for tax or depreciation. Yes or no? Okay. So if we cannot directly take net profit, we should do some adjustments. We should do some adjustments. So that net profit figure 35,500 is not the cash flow from operating activity. We should exclude the investing activities, financing activities, and non-cash expenses. If you exclude, it is similar to what PGPP questions. In PGPP, accounting profit is given and they ask you to find what tax profit. Yes or no? Likewise here also, in P&L account, taking directly one account that includes what? Both trading and P&L. So 2 opening stock. Next what? 2 purchases, 2 direct expenses, by sales, by closing stock. So difference is what? So 2 gross profit carried down. Yes or no? This is a what? Trading account. Trading account, simple trading account. There might be other expenses also. I am taking a simple trading account to explain the concept, Bharat. Next, P&L. P&L. By gross profit brought down. Brought, not carried. Brought. Okay. Brought down. Next what? 2 indirect expenses, 2 provision for tax, or otherwise 2, first we take 2 loss on sale of asset or investment, 2 loss on sale of asset or a investment. Now tell me, is this an operating activity? Loss on sale of investment is an operating activity? No, it is not an operating activity. Okay. Next what? To depreciation. Tell me, this is a cash expenditure or a non-cash expenditure? So you are reducing a depreciation. You are debiting a depreciation. Due to that, net profit has got decreased. But depreciation is not a cash outflow. If I ask you to prepare an account for cash flow from operating activities, then you take receipts on the right, for example, okay, and payments on the left. Are you going to take depreciation? Are you going to consider depreciation? No. Why? Because there is no cash outflow. But here in P&L account, depreciation was debited. For suppose if it is a cash flow from operating activity account, then there should not be a depreciation. There should not be what? Loss on sale of asset or a investment. And next to provision for tax. Provision for tax. There should not be provision for tax. Why? We should consider tax paid. We should take tax paid, not the provision. Not the provision. And next to dividend. So dividend is an operating activity or financing activity? Financing activity. To dividend paid is a financing activity. If it is an account for cash flow from operating activity, then I should not be debiting what? Dividend paid. Yes or no? Do not compare with receipts and payment account in NPO. So, okay. And next to interest. To interest. Interest is a financing activity, but already debited in a P&L account. Already debited in P&L account. Next what? By profit on sale of asset. Next by interest received, by dividend received. Then you will get what? Net profit. To net profit carried down. To net profit carried down. So now tell me, for suppose if this account is a cash flow from operating activity, am I going to debit dividend? No, I am not going to debit a dividend. I am not going to take dividend as a cash outflow. Why? It is a financing activity, but already taken. So this net profit figure is arrived after reducing what? Net profit figure is arrived after reducing interest, after reducing dividend, after reducing provision for tax and depreciation, and also loss on sale of asset or a investment. And this net profit is arrived after adding interest received, dividend received, profit on sale of a asset. So all these are not what? All these are not operating. Okay. In this, loss on sale of asset is not operating activity. Depreciation is an operating activity, but non-cash. Depreciation is an operating activity, but non-cash. Provision for tax is an operating activity, but it is a provision, not a tax paid. We should take exact cash outflow. So what about dividend? Dividend is a non-operating activity. Interest is a non-operating activity. Interest received, non-operating activity. Dividend received, non-operating activity. Profit on sale of asset, non-operating activity. So nothing but under indirect method, we do a working back. Nothing but we take net profit. Add depreciation, add dividend. Why the dividend is being added back? Because I have reduced dividend, which is not correct. because dividend should be considered as an outflow under financing activity. So that's why add to the net profit and consider this dividend amount as an outflow under financing activity. What about interest? Add interest, okay, and consider as an outflow under financing activity. What about interest received? Interest received already added. To reverse back, reduce interest received, reduce dividend received, so and consider as an inflow under investing activity. Interest received and dividend received is considered as cash inflow under investing activity. Am I clear? Okay. So you have to understand the logic. For example, net profit 35,500. Net profit what? 35,500. So this net profit, if they are simply giving as a net profit, then this net profit is considered as net profit after tax, but before appropriation. If they are giving net profit 35,000, then this net profit is considered as what? Net profit after tax. If they are simply mentioning net profit in ratio analysis or in FM generally, if they are mentioning net profit, or in CMA final, net profit means what? Net profit after tax. But before appropriation, what is this appropriation? You know, I think you might be aware of P&L appropriation account. For example, income tax is a charge. Income tax is a charge. Interest is a charge to P&L. For example, interest is paid irrespective of your financial position. Whether you are getting a profit or not, that doesn't matter. You have to pay interest. That is a charge. Are you getting my point? Even tax is also a charge. For example, minimum alternate tax. Even in case the company is in losses, it has to pay some amount of a tax. So it is a charge. It is not an appropriation. Appropriation means setting aside profits or distribution of profits. Appropriation means what? Setting aside profits or distribution of a profits. Appropriation means distribution of a profits. Dividend is an appropriation of a profit. But interest is a charge to P&L. Generally in PGPP also, generally the charges are allowed as an expense, but appropriations are not allowed as an expense under Income Tax Act. Appropriation example, equity dividend is an appropriation. Preference dividend is also an appropriation, because even preference dividend is paid if there are profits. If there are no profits, preference dividend will not be paid. Likewise, transfer to general reserve. If you are transferring any amount to general reserve, that is also an appropriation. If you are transferring any amount to general reserve, that is an appropriation. Are you getting my point? Appropriation. Charge means what? Expense. I mean, that has to be paid irrespective of your profit or loss. Whether you get profit or loss, that doesn't matter. You have to pay interest. You have to pay tax. Okay. Sir, when there is no profit, why do we pay tax? There is a concept of minimum alternate tax. Even if there are no what? Profit, they have to pay tax in some cases, situations. You know better. So here, net profit means what? Net profit after tax, but before appropriation. So write down the answer, illustration number 6. Net profit. So first take heading, cash flow statement of S Limited for the year ended 31st March 2019. cash flow statement for the year ended, cash flow statement of S Limited for the year ended 31st March 2019. 2019. In that, take particulars and two amount columns, inner column and outer column. Particulars and two amount columns. Particulars and two amount columns. Then take heading. What is that heading? In particulars, take heading cash flow from operating activities. 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 So net profit after tax but before appropriation. Net profit after tax but before appropriation is given. So what is the net profit after tax but before appropriation? 35,500. 35,500. So first understand what is this. Net profit after tax means after tax reduced. But before appropriation, nothing but before payment of a dividend. Dividend is not at reduced. Dividend is not at reduced from this 35,500. Dividend is not at reduced from this 35,500. Are you getting my point? So now tell me, if a dividend was already reduced, that is not correct. If dividend was already reduced, that is not correct, because dividend paid is a financing activity. So that should not reduced under operating activity, yes or no? So that's why what we do is we add dividend paid and we reduce dividend in financing activity. If dividend was already reduced, that is not correct. But here it is what? Net profit after tax but before appropriation. But before appropriation means what? Depreciation not at reduced. Dividend was not at reduced. Dividend not at reduced means, is it correct or wrong? Correct only. Dividend should not be reduced and it was not reduced. It was not reduced. Correct only. So that's why we should not add back the dividend. We should not add back the dividend because dividend was not at reduced. ఇంకా రెడ్యూస్ చేయలేదు కాబట్టి మనం రివర్స్ చేయాల్సిన అవసరం ఉందా లేదా? రివర్స్ చేయాల్సిన అవసరం లేదు. ఓకే, అర్థమైందా? సో దట్స్ వై వీఆర్ నాట్ యాడింగ్ డివిడెండ్. వాట్ అబౌట్ ద నెక్స్ట్ వన్ బంగారు తల్లి? Add. Next what? Add. What is the next one? Provision for income tax. So add provision for tax. Why the provision for tax is added? Tax is an operating activity. It has to be reduced. Then why you are reversing? Because the reason is we should reduce exactly the tax paid amount. Exact amount has to be reduced, not the provision for tax. And moreover, as per accounting standard, we should disclose the tax separately. We should disclose the tax paid separately. So that's why what we are adding provision for tax. Provision for tax is an operating activity. But why we are adding? Because it needs a separate disclosure as per accounting standard. So that's why. Next what? Add on. Add loss on sale of asset. Why we are adding loss on sale of asset? Because it is an investing activity. So that's why we are adding it back. Adding it back. Next what? Depreciation what? Non-cash expense. It is an operating activity, depreciation, but it is non-cash expense. So that's why add. Next word, profit. Profit on sale of what? Investment. What is the amount? 150. It has to be reduced because profit on sale of investment already added, so that's why you have to reduce. Next, interest expenses due. Interest expense due and paid. So P&L account, which amount might have been debited? Paid or due? P&L account is prepared on accrual basis or cash basis? Accrual basis. Accrual basis means which amount might have been debited to? Which amount might have been debited to P&L account? Interest expense due, not the paid. Interest expense due. So that's why what? Add. Interest expense due. Add interest expense due. Are you getting my point? Paid ఎందుకు డెబిట్ చేస్తాం? క్యాష్ బేసిస్ అయితే పెయిడ్ డెబిట్ చేస్తాం, కానీ ఇక్కడ అక్రూవల్ బేసిస్ కదా. అక్రూవల్ బేసిస్ అంటే మనం అక్రూడ్ డెబిట్ చేస్తాం. ఇక్కడ అక్రూడ్ ఎంత? 15,000. సో డెబిట్ చేసి ఉంటాం, బట్ దట్ ఈస్ నాట్ ఆన్ ఆపరేటింగ్ యాక్టివిటీ. సో దట్స్ వై యాడ్ బ్యాక్. యాడ్ interest due. What is the interest due amount? 15,000 is the interest due amount. 15,000 is the interest due amount. So clear? So total this. $87,910. This is cash flow from operating activity before working capital changes. Cash flow from operating activity before what? Working capital changes. Before working capital changes. Working capital means net current assets. Net current assets. So there was an increase in net current assets by which amount? There was a increase in working capital, 84,100. Increase in working capital, increase in net current assets. That means a cash decrease. Here one more point to be discussed is, if a current asset increases, cash decreases. Nothing but we might have bought an asset. If a current asset decreases, cash increases. If a current liability increases, cash increases. Current liability increases means we bought a loan, so cash increases. Okay, current liability. I'm talking about current liability, not the long term. Next word, current liability decreases, cash decreases. But here in this question, increase in working capital is given straight away. Working capital increased. Working capital means net current assets. Current assets minus current liabilities. So working capital increase. Working capital means net current assets increase. Net current assets increased means cash decreases. Nothing but cash outflow. Cash outflow. So that's why minus what? Minus working capital increase, 84,100. Then you will get cash flow from operating activity before tax. Cash flow from operating activity before tax. So clear? Cash flow from operating activity before tax. So what is the number? 3810. This is cash flow from operating activity before tax. Next, reduce tax paid, exact amount minus tax paid. 6, tax paid is an operating activity, yes or no? 6,300. 2490 is nothing but what? That is written in outer column. 2490 is written in outer column. Cash flow from operating activity. Negative amount. 2490. So there is a cash outflow. Cash outflow from operating activity 2490. Clear? Done. Next what? Investing activity, right? Investing activity. So take investing activity. Investing activity. What is the book value of assets sold? Book value of assets sold 250. Loss on sale of asset 60. That means we might have sold an asset for 190. So under investing activity, take sale of a asset 190. Inflow or outflow? Inflow. Sale on asset 190 inflow. Next, sale of investment. Sale of a investment. Value of investment sold 40,650. What is the profit on sale of investment? 150. That means sale value might be 40,800. 40,650 plus 150. 40,800. So sale value of a investment. Sale value of a investment 40,800. That is also what? Investing activity. Inflow. Is there any other investing activity? Purchase of fixed assets 840. Inflow or outflow? Outflow. Purchase of fixed assets 840 outflow. Clear? 840 outflow. Next, so total, so write it in outer column 40,000. So 40150. So 40150, what is this? Cash flow from investing activity. Inflow or outflow? Inflow. Properties ఏంటి సేల్ చేసాం. సో పాజిటివ్ సైనా నెగిటివ్ సైనా? నెగిటివే, ఉన్నది అమ్మేసాం అంతే. నెక్స్ట్ వాట్? క్యాష్ ఫ్లో ఫ్రమ్ financing activity. Cash flow from financing activity. Cash flow from financing activity. Cash flow from financing activity లో ఫస్ట్ వచ్చేది డివిడెండ్ పెయిడ్. డివిడెండ్ పెయిడ్ 10,000. నెక్స్ట్ వాట్? ఇంట్రెస్ట్ పెయిడ్ 15,780. Is there any other amount? No. ఇక్కడ ఏం చేశారు? అసెట్స్ సేల్ చేసి ఇంట్రెస్ట్ పే చేశారు. అండ్ అలాగే ఏంటి, దే ఆర్ టేకింగ్ అ డివిడెండ్. దే టేకింగ్ అ డివిడెండ్. ఓకే, సరే. వాట్ ఈస్ ద టోటల్ ఫైనాన్సింగ్? 25,000. టోటల్ చేసేయండి. లాస్ట్ కాలంలో 3 అమౌంట్సే ఉంటాయి. 2490 నెగిటివ్, 40150 పాజిటివ్, 25,780 నెగిటివ్. టోటల్ చేయండి. 11,880. వాట్ ఈస్ దిస్ 11,880? నెట్ ఇంక్రీజ్ ఇన్ cash and cash equivalents. Net increase in cash and cash equivalents. Net increase in cash and cash equivalents. Net increase in cash and cash equivalents. Add opening cash. Add opening cash 1032. Then you will get closing cash. What is the closing cash? 12,912. So 12,912 is the answer. So clear? Done. So instead of by hearting, you should understand why we are adding those figures. Dividend is not added because we have started from net profit after tax but before appropriation. If you are starting from net profit after tax and appropriation, then we should add dividend. Okay, depreciation is added because what? It is a non-cash expense. It is a non-cash expense. Clear? Why interest due is added? Because it is not an operating activity. Why loss on sale of fixed asset is added? Not an operating activity. Profit on sale of investment is reduced because it is not an operating activity. So clear? Next, fund flow statement. The only difference between fund flow statement and cash flow statement is, in cash flow statement we are finding out increase or decrease in cash and the reasons for change in cash. The reasons for change in cash. In fund flow statement, fund flow statement is prepared to know the increase or decrease in working capital. Increase or decrease in working capital. Nothing but changes in financial position. Changes in financial position. Instead of cash, we are going to find out the increase or decrease in fund, working capital. And we are going to know the reasons for increase or decrease in fund. How the working capital has got increased or decreased. Okay. So fund flow statement is different from cash flow statement. Fund flow statement is what? The purpose is to know the increase or decrease in working capital and the reasons for increase or decrease in working capital. Fund. Here fund means what? Working capital. Okay. Here fund flow statement, we take sources and application. Sources means inflow, application means what? Outflow. Fund outflow, fund inflow. So fund inflow can be from issue of a share capital. If you are issuing share capital, there will be fund inflow. Fund inflow, nothing but cash increase. Cash is also a current asset. Cash is also a current asset. If cash increases, working capital increases. Fund from business operations. Earlier we used to find out cash flow from operating activity. Here we call it as fund from operations. But fund from operation and cash flow from operating activity before working capital changes, and fund from operation are same. Fund from operation, cash flow from operating activity before working capital changes, both are same. Okay, when there are no taxes. But when there is tax, from cash flow from operating activities before working capital changes, we should reduce tax. So let us see the question, then you will understand. Issue of debentures, inflow. Sale of fixed assets, inflow. Non-trading income, inflow. Decrease in working capital. Okay. So this statement need not be, you need not retain this statement because we are going to solve illustration number 2. Right now, understand one point. The difference between the cash flow statement and fund flow statement is mainly in cash flow statement we are finding out the reasons for increase or decrease in cash. Under fund flow statement we are finding out the reasons for increase or decrease in working capital. So right now keep this point in your mind. So I will explain illustration number 2. So we are going to prepare cash flow statement and fund flow statement for illustration number 2. For one question we are doing both cash flow and fund flow. Then you will get to know the difference. Okay. Let us see the illustration number 2 first. Illustration number 2, fund flow statement, illustration number 2. First we are going to prepare cash flow statement. First we are going to prepare what? Cash flow statement. Cash flow statement. Illustration number 2. From the balance sheet of X Limited, prepare a statement of changes in working capital and fund flow statement. They are asking you to prepare the statement of changes in working capital and fund flow statement, but first we shall proceed with what? Cash flow statement. The balance sheet, liabilities, equity share capital, opening 3 lakhs, closing 4 lakhs. That means what? There might be an issue of a equity share capital. 8% preference share capital, 1 lakh 50 and 1 lakh. There might be a redemption of a preference share capital. Redemption of a preference share capital. P&L account, general reserve account, proposed dividend account, creditors. Next what? Creditors. Bills payable, provision for tax. On asset side, goodwill opening 1 lakh 15, closing 90,000. That means goodwill has been written off. Goodwill has been written off. By which amount? 25,000. Land and buildings, plant and machinery, debtors, stock, bills receivable, cash in hand, cash at bank. Following is the additional information available. Depreciation of rupees 10,000 and 20,000 have been charged on plant and land and building respectively in 2022. Interim dividend 20,000 has been paid in 2022. Income tax of rupees 35,000 has been paid in 2022. Income tax paid 35,000. Okay. So first we should prepare working notes. Before proceeding to cash flow statement, first we should prepare working notes. We should prepare working note for plant. Why? Because in additional information depreciation is given. So we have to find out whether there is a purchase or sale of a plant. And we should prepare land and building account to know whether there is a purchase of land or sale of a land. We should prepare provision for tax account to know how much provision is created during the year. So let us start. First working note. Land and building account. Generally we prepare a working note for the additional information. So first take question number 2. Fund flow statement question number 2. But we are preparing cash flow statement. Land and building account. So land and building account. So what is the opening land? 2 lakhs. So land will have a debit balance or credit? Debit balance. 2 or by? 2. So brought down. Yes or no? 2. Opening balance. To opening balance 2 lakhs. Yes or no? Land. Next. Depreciation. Depreciation means land value will decrease. Yes or no? We should write on the right or left? Right. If you are writing on the left, that means land value is increasing. So what by? Depreciation. Nothing but P and L bracket. By depreciation 20,000. Next, what is the closing amount? It is written on the right. Yes or no? By closing, carried down 1,70,000. See the difference? 10,000. What is the 10,000? What is the difference at 10,000? 10,000 difference is coming on the right or left? Right. Balance inquiry is coming on a right. That means sale. Land value is decreasing. That means sale. By bank. In bracket, sale. What about profit or loss? No other information is given, so that's why we assume there is no profit or a loss. So this is land and building account. 2 lakhs. Next what? Plant account. Plant account. Opening balance. To opening balance 80,000. Next by depreciation 10,000. By closing balance. So this time you're getting balance figure on left. That means you have to increase the planned value, purchase. So to bank 1,30,000. So tell me this 1,30,000 and the above 10,000 comes under investing activity. Investing activity. Yes or no? Next account. Provision for tax. Provision for tax. Provision for tax. Provision for tax. Liability. It will have a credit balance. By balance brought down. By balance brought down 40,000. Vamsi. By balance brought down 40,000. To balance carried down 50,000. Next to what is given actually? Income tax paid. If you are paying income tax, your liability will decrease. So to bank. Yes or no? To bank paid. Bank will go out. So to bank 35,000. So 85,000. What is this 45,000? The extra provision created. Provision created during the year. So by P&L in bracket provision. By P&L in bracket what? Provision. By P&L in brackets what? Provision. Done. Now we can start with cash flow statement. Understand this question conceptually. One question is enough for both fund flow and cash flow. Cash flow statement. Particulars, amount and amount. Particulars, amount and amount. Particulars, amount and amount. In particulars, first cash flow from operating activity. Cash flow from operating activity. When balance sheet is given, we start with the difference between the P&L account. When balance sheet is given, so see the balance sheet. If you see the balance sheet, what is the difference between the opening profit and closing profit? 30, 48. 18,000 is the profit generated during the year. Yes or no? 18,000 is the profit generated during the year. Am I correct? We are taking the difference from the balance sheet. That means that is a profit after tax and appropriation. After payment of tax and after appropriation, if there is any profit, that profit is transferred to the P&L account. So that difference amount is what? Net profit after tax net profit after tax and appropriation. Yes or no? After payment of tax and after appropriation. Appropriation examples: dividend, equity dividend, preference dividend, transfer to general reserve if any. Transfer to reserve is also an appropriation. If there are profits, then only you are going to transfer to reserve. So that's why equity dividend, preference dividend, transfer to general reserve are appropriations. So this difference amount is what? 18,000 is net profit after tax and appropriation. Net profit after tax and appropriation, 18,000. Nothing but difference between what? Opening and closing. Am I clear? So for this, first we should add appropriations. First we should add appropriation. So in appropriation, first add transfer to general reserve. In P&L appropriation account, you might have written to general reserve. To general reserve. See the difference between the general reserve opening and closing balance. 30,000. So 30,000 general reserve balance has been increased by 30,000. That means that 30,000 is transferred from P&L appropriation account. Will there be any cash outflow? No. There will not be any cash outflow. There will not be any cash outflow. So then how can we debit? So to reverse it back, add transfer to reserve. What is the amount? 30,000. That is simply a journal entry. Simply a journal entry. So that's why what we should add back. Next, add preference dividend. Preference dividend. So there are two amounts. Opening 1,50,000, closing 1 lakh. We can take two assumptions. One assumption is there is a 50,000 redemption, right? That 50,000 redemption can be at the beginning or at the end. Generally, we assume redemption is done at the end. If redemption is done at the end, Then 8% preference is dividend is paid on 1,50,000. Nothing but the dividend amount is 1,50,000 into 8%, that is 12,000. Why 12,000? You can take an alternate assumption also. But if here implied assumption we are taking is redemption is done at the end on 31st, closing date. That means you have to pay dividend 8% on entire 1,50,000 opening balance. Next, add equity dividend. Is there any equity dividend? Is there any proposed dividend account? Yes, proposed dividend account is there. Be careful. When proposed dividend is there, be careful. First, is there any interim dividend? Interim dividend 20,000. First, add interim dividend. Interim dividend means dividend paid between two annual general meetings. Add 20,000. Next, add final dividend. Add what? Final dividend. Add also the final dividend. So if you see the proposed dividend account, what is the opening balance? 42,000. And next what? 50,000. So 8,000 what? 8,000 is what? 8,000 is proposed dividend. The opening is what? Proposed dividend opening 42,000, closing is 50,000. The provision has got increased, the liability has got increased. Yes or no? So the provision has got increased. So that means extra hot 8,000 has been created as a provision. Add 8,000. Okay. But that assumption is generally not correct. Generally what happens is, it is not like a provision for tax. So generally, dividend is declared in a AGM, right? Dividend is declared in AGM. What is the opening proposed dividend? 42,000. What is the closing? 50,000. Generally opening is paid during the year. Closing is again provided during the year. We should not take the difference. Generally proposed dividend. You know the dividend chapter also. I think you have a dividend chapter in syllabus. Dividend must be paid within 30 days from the date of a declaration. 30 days from the date of a declaration. That means what? Opening dividend, that is 42,000 opening proposed dividend, that might have been already paid. Because dividend has to be paid within 30 days. If it is not paid within 30 days, after the expiry of 30 days, next within 5 days or something, it has to be transferred to the unpaid dividend account. Unpaid dividend account. Unda meeku dividend chapter law lo. In law you have a dividend chapter. Unda syllabus lo. Dividend must be paid within 30 days from the date of a declaration. If not paid, then transfer to what? Unpaid dividend account. If you are not able to find the details of shareholders, then transfer to unpaid dividend account. Okay. So here the point is, add. We should add final dividend. What is the final dividend amount? We should add 50,000. Why we should add 50,000? Because opening is paid. Let us prepare proposed dividend account also. proposed dividend account. Proposed dividend account. Vinod, by balance. What is the by balance amount? Opening 42,000. Next to closing. So understand my point. Opening has to be paid during the year. Opening has to be paid during the year. Because Companies Act 2013 says dividend must be paid within 30 days. That will not remain pending. So that's why 2. Bank 42,000. So then you will get 92,000. You are getting balance on the right. What is the balance on the right? 50,000. What is this 50,000? 50,000 is the provision created during the year. You write by P&L. That means to P&L account you might have debited 50,000 rupees. 50,000. So that's why what we are adding. Final dividend 50,000. Clear? Net profit after tax and appropriation 18,000. Add transfer to general reserve. Add preference dividend. Add interim dividend. Add final dividend. Then you will get, what is the amount? This is net profit after tax but before appropriation. Net profit after tax but before appropriation. What is the amount? 1,30,000. The purpose of adding transfer to general reserve is there is no cash outflow. The purpose of adding preference dividend is it is not a operating activity. Interim dividend is added because it is not an operating activity. It should come under financing activity. Final dividend is added because it is not an operating activity. So whatever the amount you are debited to P&L account, that has to be reversed back. So that is what we have done. So clear? 1,30,000. Next, add provision for tax. Why the provision for tax is added? Because tax paid must be shown separately. And you should reduce exact tax paid amount, not the provision. So that's why add provision for tax. What is the provision for tax amount? See the working note. See the working note, P&L. 45,000. 45,000 was debited to P&L. So add provision for tax. Then you will get profit before tax 1 lakh. Profit before tax 1,75,000. Tell me, is there any profit on sale of land or something? We have sold land, there is no profit. If there is any profit, reduce. If there is any loss, add. There are no such points, right? But if you see the balance sheet carefully, then you will find goodwill written off. Goodwill written off. If you are writing off the goodwill, is there any cash outflow? If you are writing off the goodwill, there will not be any cash outflow. You cannot consider that difference 25,000 as a sale of a goodwill. That cannot be considered as sale of a goodwill. That 25,000 is what? Goodwill written off. So that's why you might have debited goodwill written off, which is not a cash outflow. So that's why add. Add goodwill written off. What is the goodwill written off amount? Is there any debenture? Balance sheet. See the balance sheet. If there is any debenture, you have to calculate interest and add back the interest. So debentures are given in the question or what? No. Is there any preliminary expenses? Preliminary expenses. See the preliminary expenses. There can be a preliminary expenses written off. Preliminary expenses written off. That has to be added back because there is no cash outflow. Now, tell me the amount. 2 lakhs. This 2 lakhs is cash flow. One thing we forgot, depreciation. Add depreciation. The most important, depreciation. Add depreciation. Depreciation is non-cash expense, right? Add depreciation. What is the depreciation amount? Overall amount, both land and plant, 30,000. So tell me the total. 2,30,000 is the cash flow from operating activity before working capital changes. Cash flow from operating activity before working capital changes. Working capital changes was not yet considered. Working capital means current assets minus current liabilities. Current assets, current liabilities. See the balance sheet. Liability side, first current liability, creditors. Creditors, yes or no? Equity share capital is not a current liability. Preference share capital is not a current liability. P&L account is not a current liability. General reserve, no. Proposed dividend, no. Even proposed dividend is a current liability, but it is not an operating. It is not operating. So that's why we are not taking. Creditors, 55,000, 83,000. Creditors has got increased or decreased? Increased. By what amount? 28,000. Creditors increase means cash. Cash inflow na outflow na? Creditors increase. Cash inflow. For example, your loan amount is increasing. You have a 50,000. So by evening, loan amount increases to 1 lakh. That means what? Cash inflow. So if current liability increases, cash inflow. So be careful. Cash is different from fund. Fund means working capital. If a current liability increases, cash increases. If a current liability decreases, cash decreases. If a current asset increases, cash increases. Sorry, cash decreases. That means because let us assume we bought an asset. We bought an asset. If we are purchasing an asset, cash will decrease, asset will increase. If a current asset decreases, cash increases. That means asset is sold. Okay, Mahatma. Next, fund. Next, we are talking about fund, working capital. If a current liability increases, working capital means net current assets. What happens to the working capital? Decreases. If a current liability increases, working capital decreases because working capital is equal to current asset minus current liability. Next, if current liability decreases, working capital increases. If a current asset increases, working capital increases. If a current asset decreases, working capital decreases because working capital is net current assets. Net current assets. Clear, Mahatma? Am I clear? So see the difference, observe the difference. Now, come to the main point. Creditors increase. Creditors increase means cash inflow. Decrease or increase? Increases. What is the difference amount? Creditors 28,000. What is the next one? Next current liability. Bills payable has got increased or decreased? Decrease. Bills payable decrease means cash decrease, cash outflow. Bills payable decrease. So what is the cash outflow? 4,000. Inflow or outflow? Outflow. Next what? Next, is there any other current liability? No. Next, come to asset side. Debtors. Debtors has got increase. Debtors increase means debtors increase means what? Cash decrease. Cash decreases. What is the amount? What is the next one? Stock. Increase or decrease? Stock. Stock increase means cash decreases. Amount 32,000. Next, bills receivable increase or decrease? Bills receivable increase means 10,000. Cash decrease. Cash in hand we should not take, because we are finding out the increase or decrease in cash. We should not take here. We should take change in working capital except cash and bank. So tell me the total. This is cash flow from operating activity. Cash flow from operating activity before taxes. Cash flow from operating activity before taxes. Tell me the amount. 1,72,000. Minus what? Tax paid. What is the tax paid amount? See the working note. What is the tax paid? 35,000. Bank. See the bank. 35,000. So this will be cash flow from operating activity. Net cash flow from operating activity. 1,37,000. Cash flow from operating activity. So clear? This is what cash flow from operating activity. 1,37,000. Inflow na outflow na? Inflow. Anni జాగ్రత్తగా చెప్పారా? Okay. Next what? Cash flow from investing activity. One question is enough if you are able to understand the concept. Cash flow from investing. Cash flow from investing activity. So tell me the investing activities. See the asset side. Asset side. Sale of a land and building. Amount 10,000. Inflow. Next what? Purchase of plant. Amount 1,30,000. 1,30,000 outflow. On asset side, see anything else is there? No. So amount is 1,20,000 outflow. This is what cash flow from investing activity. Cash flow from investing activity. Next, what cash flow from financing activity. Cash flow from financing activity, see the liability side. Equity share capital, same amount or different? That means there is a buyback, a issue of equity shares. What is the amount? Inflow or outflow? Inflow. Next one, preference shares, issue or redemption? Redemption of preference share. What is the amount? 50,000. Inflow or outflow? Outflow. Next point, interim dividend paid. 20,000 or 22? 20K. Next, final dividend. It is outflow. What about final dividend? Final dividend. Opening dividend will be paid. See the proposed dividend account. Opening dividend 42,000. Next, what? Preference dividend paid. Preference dividend paid. What is the preference dividend amount paid? 12,000. Preference dividend amount paid 12,000. So there can be interest paid, but in this question no debentures are given. So is there any other amount? Balaji, is there any other amount? No. Then okay. Take the total. 1 lakh minus 50 minus 20. $24,000 is what? 24,000 outflow is financing activity. So take the total of operating activity. 1,37,000 minus investing 1,20,000 minus financing 7,000 outflow. Take the opening. Add opening. What is the opening cash? Add opening cash. 15,000 plus 10,000. 25,000. 25,000 add. Closing 18,000. 18,000 is the closing. So decrease in a cash during the year is 7,000. Add opening cash 25,000 and your closing cash is 18,000. Is it matching or not? Matching. So this is the cash flow statement. Now let us come to fund flow statement. For the same question, fund flow statement. Same question, fund flow statement. So there is no accounting standard for fund flow statement. It is not mandatory. So company need not prepare a fund flow statement. Company need not disclose need not prepare a fund flow statement and it show to the shareholders. It is not mandatory. So first step is in fund flow statement, working capital changes statement. What? Working capital changes statement. So take heading working capital. Working capital changes statement. Working capital changes statement. Working capital changes statement. Working capital changes statement. Particulars. Opening, closing. Particulars opening and closing. In particulars, current assets. Particulars, current assets. Tell me the current assets. First one, what is the current asset? Debtors. Debtors opening amount 1,60,000. Closing. Next one. Stock 77,000. 1,09,000. Bills receivable 20,000. Next. Cash has to be taken because working capital includes cash. Here we should take cash. 15,000. 10,000. Direct take 25,000 and 18,000. Next, is there any other current asset? So total current assets. Two lakh 82,000. Next, 3,57,000. Are getting my point? This is what? Current assets. Next, current liabilities. The purpose is to find out the reasons for increase or decrease in working capital. Increase or decrease in working capital. Current liabilities. So what are the current liabilities? Creditors. Tell me the amount. 55,000. 83,000. Bills payable 20,000. Is there any other current liability? No. So tell me the total. 75,000. 99,000. Working capital. What is the opening working capital? Current assets minus current liabilities. So 2 lakh 2,07,000. 2,58,000 is the working capital closing. So increase or decrease the working capital? Increase in working capital 51,000. Increase in working capital 51,000. Now we should know the reasons for increase in working capital. So what are the reasons? For change in cash, we are not preparing any statement in cash flow statement. Why? Because that is a single amount. That is a single amount we are taking. That need not be taken, yes or no? We are adding opening cash, then we are getting closing cash. Separate statement is not required because cash is one only single item. But working capital, what it includes? Current assets, current liabilities. There are total 6 items. So that's why we are preparing a working capital changes statement. So the increase in working capital is what? 51,000. Now let us come to funds flow statement. Funds flow statement A, sources. Fund flow statement A, sources. Sources means fund inflow. Fund inflow. Sources means fund inflow. Application means fund outflow. Application means use. Application means what? Use. Sources. The first source is fund from operation. Fund from operation. Fund from operation, simple. Go to the cash flow statement. Actually, you have to prepare this. What is the cash flow from operating activity before tax? Sorry, before working capital changes. Cash flow from operating activity before working capital changes, 2,30,000. Okay, 2,30,000. Yes or no? Cash flow from operating activity before working capital changes. This is nothing but fund from operations before tax. But from 2,30,000, you should reduce tax. 2,30,000 minus 35,000. 1,95,000 is the fund from operations. So why we are not considering working capital changes? Separate statement is prepared, working capital changes. This is not about increase or decrease in cash. So that's why we should ignore what? Working capital changes. So fund from operation is equal to what? 1,95,000. So okay, you can take 2,30,000 also. 2,30,000 means what? Fund from operations before tax. Clear? Fund from operations 2,30,000, that is before tax. Thereafter, you take all the outflows in. So thereafter, all outflows will be taken in application. Inflows are taken in sources. So if you see the cash flow statement, taxes paid is the outflow, 35,000. So that is taken on application side. Instead of that, you can do, what you can do is directly take fund from operation as 2,30,000 minus 35,000, that is 1,95,000. That's up to you, depends. Okay. So 2,30,000 minus 35, Mahatma. And next, see the next one. Sale of a land and building, 10,000. It is inflow, source. It is what? Source. Purchase of plant, 1,30,000. Application. Financing activity, issue of a equity shares, 1 lakh. Source. Redemption of preference shares, application. Interim dividend, application. Final dividend, application. Preference dividend, application. Sale proceeds, application. Issue of equity shares, source. Clear? 1,30,000 purchase of plant, application. Redemption of preference shares, application. Proposed dividend, application. Interim dividend, application. Preference dividend, application. The total amount of source is 3,40,000 and you are getting a balance figure on the right. Balance figure on the right. Nothing but sources are greater than application. Sources are greater than application means what? There is an increase in working capital. The difference amount is 51,000. 51,000. Sale proceeds of land and building. Sale proceeds of a land and building. Current asset will increase. Current asset, cash will increase. Cash is a current asset. So working capital increase. If a working capital is increasing, you should take under source. If a working capital is decreasing, take under application. If you are paying dividend, your cash will decrease. So your working capital will decrease. So that's why it is taken on application side. Sir, why payment of debtors is not taken anywhere? Simple. If you are paying to the debtors, then no effect. If you are paying to the debtor, then working capital is not going to change. Why? Cash is a current asset. Debtors is also a current asset. If you are paying to a debtors, then cash decreases. At the same time, debtors will also what? Sorry, payment to creditors. I'm sorry, payment to creditors. Payment to creditors. If you are paying money to the creditors, then there is no effect. Why there is no effect? Cash decreases, creditors decreases, asset decreases, liability will also decrease. Current asset decreases and current liability will also decrease. That's why there is no effect on working capital. If you are collecting money from debtors, no effect. Why? Cash increases, debtors decreases, no effect. Nothing but if there is a transaction within the current asset or current liability, then there is no effect. There will not be an increase or decrease in working capital if there is a transaction within the current assets or current liabilities. Likewise, if there is a transaction within the non-current liability and non-current asset, then also there will not be increase or decrease in working capital. For example, if you are purchasing a plant and machinery by issuing equity shares, then working capital is not going to increase or decrease. Why? If you are purchasing plant and machinery by issue of shares, plant and machinery increases, equity shares increases. If you are purchasing plant and machinery by issue of equity shares, then no effect on working capital. So simple logic is working capital will get affected only if there is a transaction between current and non-current. If there is a transaction within the current, no effect. Within the non-current, no effect. So clear? If you observe all these sources, sale proceeds of land and building. Land and building. So cash to land. Cash to land. Cash is current, land is non-current. Issue of equity share. Cash to equity share. Current and non-current. Yes or no? Purchase of plant. Plant to cash. Okay, non-current to current. Ardhavainda meeku? Okay, so the only difference between the cash flow statement and fund flow statement is, in cash flow statement we are finding the reasons for increase or decrease in cash. Fund flow statement we are finding out the reasons for increase or decrease in working capital. So here the reasons for increase in working capital is issue of a equity share capital, fund from operation, sale proceeds of land and building. The most important source is fund from operation. So there is an inflow from operation. There is a fund inflow from operation. So that's why there was an increase in working capital. ఒక క్వశ్చన్ ప్రాక్టీస్ చేయించాలి. ఇది ఒక్క క్వశ్చనే దేనికమ్మా? ఫర్ బోత్ క్యాష్ ఫ్లో స్టేట్మెంట్ అండ్ ఫండ్ ఫ్లో స్టేట్మెంట్. ఇండైరెక్ట్ మెథడ్, క్యాష్ ఫ్లో స్టేట్మెంట్ ఇండైరెక్ట్ మెథడ్ వస్తుంది, అలాగే ఏంటి ఫండ్ ఫ్లో స్టేట్మెంట్ కూడా. సో క్లియరా రాధాకృష్ణ? ఓకే, సో దీస్ 3 questions are enough. So first question direct method, second one indirect method, and now the question what we have discussed is cash flow statement indirect method and fund flow statement. Okay, clear babu? Ganesh వదిలేసినట్టున్నారు. Next topic, financial analysis. Financial analysis. So financial analysis involve comparative statement analysis, common size statement analysis, trend analysis, ratio analysis, cash flow analysis, fund flow analysis. All these forms part of a financial analysis. For example, in balance sheet we are not analyzing anything. In P&L also we are not analyzing financials. But whereas cash flow statement is prepared for the purpose of analysis of a finance. Okay, fund flow statement is also prepared to analyze the finance. Okay, so ratio analysis, trend analysis, common size analysis, comparative statement analysis. So they are asking 1 7 marks question, either comparative statement or a common size. So simple concept, comparative statement or a common size, simple concept, and you will get 7 marks based on a trend. 7 marks. You have to learn 2 problems, one for comparative statement and the second one for common size. Trend ratio, for trend ratio also 1 question is enough. Trend ratio. Okay, so total you will get from this chapter, I mean, we are going to learn comparative statement analysis, common size financial statement, trend analysis and ratio analysis under ratio analysis topic. Under ratio analysis topic you will get 3 7 marks or 2 7 marks. 3 7 marks or 2 7 marks. So 14 or 21. 14 or 21. Okay. Now financial statement. You know that financial statement includes what? Balance sheet, P&L, cash flow statement and notes to account. Notes to account. So that is a numerical report. There is no analysis in financial statements. So financial analysis, it is a proper arrangement of a financial data and methodical classification of the data. Financial analysis means proper arrangement of financial analysis means proper arrangement of financial data. Okay, and classification of a data. So financial analysis includes comparative analysis, common size, trend analysis, ratio analysis, fund flow analysis, cash flow analysis. Okay, so the total weightage of a financial analysis, so you will get 3 7 marks. So 3 7 marks. So generally out of 3 7 marks, 2 7 marks are generally asked from ratio analysis itself. 2 7 marks. 1 7 marks they will be asking from fund flow statement or cash flow statement, and sometimes the other 7 marks also will be asked from ratio analysis. Ratio analysis includes a comparative statement analysis, common size analysis, trend analysis. I mean, for the purpose of learning, but practically all are different. Common size is different from ratio analysis. Okay. So here the benefits of a financial analysis. The financial analysis is useful for internal and external stakeholders. Stakeholders means interested parties. Example, first, this financial analysis is beneficial to the management. Investors obviously they have to take a decision whether to invest or not. Creditors, whether to give a loan or not. For example, interest coverage ratio, debt service coverage ratio, these ratios are used by the creditors before giving a loan. Financial analyst. Some experts will express their opinion. Okay, whether that stock is good to invest or not. For that they use ratios. For example, P ratio, price earning ratio is calculated. Price earning ratio. Price earning ratio means market price per share divided by earnings per share. And next, legislation, governments, labor union, employees. Employees will be expecting some bonus. Further to what they might see the gross profit ratio and net profit ratio. So clear. And limitation is there are no standards. There is no standard for ratios. There is no standard for ratio. We cannot say only this ratio has to be used for analyzing the financial statements. We cannot say, and the ratios do not have any standard, so that's why there will not be any uniformity. For example, return on investment formula is EBIT divided by capital employed. So that is pre-tax. But post-tax, EBIT into 1 minus tax rate divided by investment, capital employed. Which formula has to be applied? So that is subjective. I can use pre-tax and you can use post-tax. As there is no standard, there will not be any uniformity. There will not be any uniformity. Okay. And the comparison is difficult because of difference in situation of two companies. Difference in situation of two companies. So we have to see the situation of two companies. So comparison will be difficult. Comparison will be difficult. And next, historical financial statements are not the indicators of a future. Not the indicators of a futures. For example, Ganesh might be the topper in intermediate. That does not, indicate what he will become a topper in CMA also. For suppose he might be a topper in CMA, but he may not be what? Okay, topper in next job, yes or no? So the point is historical financial statements are not indicators of a future. So these are the limitations. Next, tools of a financial analysis. Financial analysis, comparative statement analysis, common size financial statement, trend analysis, ratio analysis, cash flow analysis, fund flow analysis. Let us see the formulas without wasting time. Ratio analysis formulas. Ratio analysis. So concept 11 is more relevant for examination. So without wasting time, you can come to concept number 11. Ratios. Profitability ratio, activity ratio, solvency ratio, valuation and payout ratio. So generally these profitability ratios are used by the investor. Profitability ratios are used by the investors. Investors use this ratio, profitability ratios. So you might be knowing some of the ratios. Gross profit ratio. Gross profit divided by net sales into 100. Net sales means sales minus sales return. Net profit ratio. Net profit divided by net sales. Operating profit ratio. Operating profit means EBIT. Operating profit ratio, not the operating ratio. Operating ratio is different from operating profit ratio. Operating profit ratio is equal to EBIT divided by net sales into 100. That is not 10, that is 100. Next, expense ratio. That is not expansion ratio. That I think it is expense ratio. Expense ratio. Expense ratio. Expense. For suppose if they are asking you to find out the operating ratio means operating expenses divided by sales. Operating profit is different from operating ratio. Operating ratio means operating expenses divided by sales. How do we get operating expenses? Cost of a goods sold plus other operating expenses. Cost of a goods sold plus other operating expenses. That formula is not given in the book. Operating ratio is equal to operating expenses divided by operating expenses divided by sales. Operating expenses divided by sales. Next, ratios you need not by heart, apply the common sense. Gross profit ratio, gross profit ratio, so gross profit divided by sales, you already know. Net profit ratio, net profit divided by sales. Operating profit ratio, operating profit divided by sales. Generally we show the profit as a percentage of our sales. Likewise, operating ratio, operating expenses divided by sales. Okay. Ratio analysis, why are we calculating ratios? Because users of a financial statement cannot go through the each and every item of a balance sheet. We are presenting in a meaningful manner, we are presenting in a proper manner. Okay. So that they can jump into a conclusion fast. For example, if somebody applies for a loan, we calculate what current ratio. If they are applying for working capital loan, we calculate what current ratio. Current ratio is equal to current asset divided by current liabilities. If a current ratio is equal to 1, what does it mean? Current liability is equal to 1 rupee, current asset is equal to 1 rupee. Okay. And they are applying working capital loan. If this working capital loan is given to those people, then what happens to the current liability? Current liability will increase. Current liability will increase. Of course, the working capital loan must be used only for the purpose of working capital. If they are using it for working capital, that's okay, fine. The current ratio will remain same at 1. Otherwise, what happens? Current ratio will decrease. So now the question arises, how will they pay the loan? Because current assets 1 rupee, current liability is also 1 rupee. It is very difficult. Already they are in difficult situation. Short-term commitment is 1 rupee and short-term availability is also 1 rupee. For example, daily you require 10 rupees and you are earning 10 rupees and you are applying for a loan. How will you pay the interest? Yes or no? So those liquidity ratios are generally used by the bank. Cost of a goods sold ratio, cost of a goods sold divided by sales. Operating expenses ratio, administrative expenses plus selling expenses divided by sales. Next, administrative expenses ratio, administrative expenses divided by sales. Selling expenses ratio, selling expenses divided by sales. So these formulas are not that important actually. Cost of a goods sold, opening stock plus purchase minus closing stock. This is important for ratio analysis. Opening stock plus purchase minus closing stock. Return on assets, return on asset. So here the formula given is EBIT divided by total assets, but generally the formula used is return on assets. In denominator you will get assets. Return on assets, we take profit after tax. Ratio does not have any standard, so that's why EBIT divided by total asset is also correct. EBIT into 1 minus tax rate divided by total assets is also correct. PAT divided by total assets, this is also fine. Next, return on net assets is also same. Return on net assets, profit after tax divided by what? Total net assets. Net assets means total assets minus external liabilities. So the only relevant formula here is return on assets is equal to profit after tax divided by assets. Next, return on a capital employed. Return on a capital employed. Already we have seen this formula in leverages chapter. EBIT divided by capital employed, or EBIT into 1 minus tax rate divided by capital employed. Generally we use EBIT divided by capital employed. Pre-tax will be used. Pre-tax. Return on equity. Return on equity means we should consider only the return to the equity shareholders, that is earnings available to equity shareholders divided by equity. Earnings available to equity shareholders divided by what? Equity. Clear? return on equity is equal to earnings available to equity shareholders divided by equity. So here important point is equity. Equity is also called as net worth. Net worth is also called as proprietary fund. Proprietary fund. This is important actually. Equity. Equity is equal to what? Equity means net worth or proprietary fund. Net worth, owner's worth. Owner's worth. I'm taking a simple balance sheet. Equity share capital, long-term debt, current liabilities, reserves and surplus. On asset side, fixed assets, current assets, fictitious assets. Fictitious assets. Okay. So now tell me, what is the net worth? Net worth is equal to, net worth means owner's worth. Owners means equity shareholders. Equity share capital plus reserves and surplus minus what? Fictitious assets. Minus fictitious assets. Fictitious assets example. Preliminary expenses not written off. Generally in questions fictitious assets will not be given generally. So that's why net worth means equity share capital plus reserves and surplus. Fictitious means unreal. Fictitious means unreal. Ganesh, decent. Fictitious. Okay. Vasant. Okay. Disciplined. Imagine. That is unreal. That is what? Imaginary. Unreal. So fictitious means what? Unreal. Fictitious means unreal. So preliminary expenses not written off. Preliminary expenses not written off. You know the meaning of preliminary expenses, right? Preliminary expenses means expenses incurred before commencement of a business. Okay, before commencement of a business. Those preliminary expenses are written off over a period of time after commencing a business. So preliminary expenses not written off is a fictitious asset because they will have a debit balance. They will have a debit balance. PD, they will have a debit balance. Clear? What is the entry for preliminary expenses paid? Preliminary expenses paid. Preliminary expenses to cash or bank. Yes or no? Preliminary expenses are incurred before starting a business. Business is not yet started. Then how can you debit these expenses to the P&L account? So that's why these preliminary expenses are not debited to the P&L account. These preliminary expenses are carried to the balance sheet. Carried to the balance sheet. So preliminary expenses debit. That means it will have a debit balance. So this will be shown on a asset side or liability side. Asset side of a balance sheet. Asset side of a balance sheet. Preliminary expenses to cash. Expenses debit. Debit balance. So that will be shown under assets. But it is not actually an asset. It is not actually an asset. It is a fictitious asset. So that's why net worth means equity share capital plus reserves and surplus minus fictitious asset. Likewise, discount on issue of debenture. Discount on issue of a debenture. If debenture is issued on a discount, what is the entry? Bank 95, discount 5, to debenture 100. Discount, debit 5 rupees. Discount is having a debit balance carried to the balance sheet, written off over a life of a debenture. Again, it is a fictitious asset. If you are giving a discount to the investor, that is not an asset. That is not an asset. So net worth is equal to equity share capital plus reserves and surplus minus fictitious asset. Otherwise, or second one is frequently used. Fixed assets plus current assets minus current liabilities minus long-term debt. Fixed assets plus current assets minus current liabilities minus long-term debt. Nothing but fixed assets plus working capital minus long-term debt. This is most frequently used formula in ratio analysis chapter. Net worth is equal to fixed assets plus working capital minus long-term debt. Generally in questions, long-term debt will not be given. So we assume that there are no long-term debts generally. We cannot take an assumption there is no equity. Without equity there cannot be company, right? Okay. So fixed assets plus working capital minus what? Long-term debt. Clearer? Next, see the turnover ratios. Turnover ratios are calculated to know how efficiently are we using assets. Are we using assets? Inventory turnover ratio. Turnover will always come in the numerator. Inventory turnover ratio means turnover divided by inventory. Turnover divided by inventory. In case of inventory, turnover means cost of a goods sold. Here inventory means finished goods inventory. Here inventory means finished goods inventory. If a cost of a good sold is not available in the question, then we take sales. So inventory turnover ratio is equal to cost of a good sold divided by average inventory. Average inventory is equal to opening stock plus closing stock divided by 2. We take cost of a good sold. For suppose if there is no scope to find out cost of a good sold, we proceed with sales. Raw material inventory turnover ratio. Raw material inventory turnover ratio. Denominator average raw material inventory. Average raw material inventory. Numerator turnover. In case of raw material inventory, turnover means raw material consumption. This formula you might have came across in materials chapter, cost accounting. Raw material consumption divided by average raw material. Work in progress inventory turnover ratio. Again, turnover divided by work in progress inventory. Average work in progress inventory. But in case of work in progress, what is the turnover? Cost of a production is the turnover. Every time sales will not be a turnover. For example, there is no relation between the sales and raw material. Because raw material first should get converted into work in progress, and work in progress to finished good, and finished goods to sales. So there is somewhat relation between the finished goods stock and sales. So that's why here we can take sales divided by average inventory. But if they are asking you to find out the raw material inventory turnover ratio, the formula is raw material consumption divided by average raw material inventory. If it is work in progress turnover ratio, cost of a production divided by average work in progress inventory. Debtors turnover ratio, again same. Debtors turnover ratio means turnover divided by debtors, accounts receivable. So instead of debtors we should take accounts receivable. Accounts receivable is equal to debtors plus bills receivable. Debtors plus bills receivable. But in case of debtors, only credit sales is a turnover, because there is no relation between the cash sales and debtors. There is no relation between what? Cash sales and debtors. When you are making credit sales, you have a debtors, otherwise no, yes or no? So that's why debtors turnover ratio is equal to turnover divided by debtors. So turnover means credit sales. Credit sales. So higher the turnover ratio, better it is. If turnover ratio is high, that means what? We are efficiently using our resources. We are efficiently using our resources. Okay. Debtors collection period, 12 months divided by DTR. Debtors turnover ratio. For example, if debtors turnover ratio is equal to 12, that means collection period is equal to 1 month. If debtors turnover ratio is equal to 6 months, if debtors turnover ratio is equal to 6 times, then collection period 2 months. So which is the better one? Collection period 1 month or 2 months? 1 month. Nothing but higher the debtors turnover ratio, better it is. If debtor turnover ratio is high, if raw material inventory turnover ratio is high, raw material inventory turnover ratio is high means the raw material stock is fast moving. Raw material stock is fast moving. And next, creditors turnover ratio. Creditors turnover ratio means turnover divided by creditors. But whereas in case of creditors, turnover means purchases, not sales. That too credit purchases. Credit purchases. So that's why creditors turnover ratio is equal to net credit purchases divided by average creditors. So credit payment period is equal to 12 months divided by creditors turnover ratio. Trade payable to trade receivable ratio. Trade payable to trade receivable means trade payable divided by trade receivable. Trade payable divided by trade receivable. Next, fixed asset turnover ratio. Net sales divided by net fixed assets. Fixed asset turnover ratio means sales divided by fixed assets. Net asset turnover ratio. Sales divided by net assets. Total asset turnover ratio. Net sales divided by total assets. Working capital turnover ratio. Sales divided by working capital. Turnover ratio means turnover will be the numerator. But turnover is not the sales every time. If it is creditors, turnover means credit purchase. If it is raw material, turnover means raw material consumption. If it is work in progress, turnover means cost of production. If it is finished goods, turnover means cost of a goods sold. Cost of a goods sold. Am I clear? But majority of the cases, turnover means what? Sales. In majority of the cases, turnover means sales. So total asset turnover ratio 1 and 10. Which is the better one? Second one is the better one. Why? In first case, by investing 1 rupee in total assets, we are generating sales 1 rupee. In second case, by investing 1 rupee, we are generating sales 10 rupees, not 9. 10 times. 10 means 10 times. By investing 1 rupee in total assets, we are able to generate sales of a 10. Clear? Next, debt equity ratio. Debt equity ratio means debt divided by equity. Debt divided by equity. Equity is equal to fixed assets plus working capital minus long-term debt. Proprietary ratio. Proprietary ratio means equity divided by total tangible assets. So capital gearing ratio. Capital gearing ratio means common stock. Common stock means equity. Equity. Just write it down as an equity. Capital gearing ratio is equal to equity divided by fixed cost bearing funds. Fixed cost bearing funds means preference share capital plus long term debt. Preference share capital plus long term debt. Capital gearing ratio. Capital gearing ratio means equity divided by preference share capital plus long term debt. For example, this is 2. What is the meaning of this? So there is one fixed cost bearing fund, 1 rupee fixed cost bearing fund, and there is 2 rupees equity. There is 2 rupees equity. Okay. Higher the capital gearing ratio, higher the proprietary ratio, better the solvency. Better the solvency. That means we are in a good position to repay the debts. For suppose capital gearing ratio is equal to only 0.8. 0.8. What does that mean? There is 1 rupee fixed cost bearing fund, and we have an equity of only 0.8. Next, total liabilities to total assets. Total liabilities to total assets means total liabilities divided by total assets. Total liabilities divided by total assets. Next, current ratio. Current assets divided by current liabilities. This is most frequently used formula. Current assets divided by current liabilities. In every ratio analysis, this formula will be used. Current ratio, current assets divided by current liability. Liquid ratio or quick ratio. Liquid ratio or quick ratio means liquid assets divided by current liabilities. Liquid assets means current assets minus stock. Stock is not a liquid asset. Stock is not a liquid asset because stock first should get converted into debtors and then debtors to cash. So stock is not readily convertible into cash. So that's why it is not called as a quick asset. So that's why liquid assets means what? Current assets minus stock. Okay. Next, there are other ratios as well. Let us start questions. Okay. Then again we start writing the formulas. See the question number 1. Question number 1. Question number 1. For current assets, I might be writing CA, current liabilities CL, bills receivable BR. But you should not write like that, okay, in examination. The following are the ratios relating to the activities of X Limited. Debtors velocity. Velocity means speed. What is the speed? Collection period 3 months. Okay, 3 months. Stock velocity 8 months. Creditors velocity 2 months. Gross profit ratio 25. Gross profit for the current year ended December 31st, 2021 amount to rupees 4 lakhs. Gross profit 4 lakhs. Closing stock of the year is 10,000 above the opening stock. Bills receivable amount to rupees 25,000 and bills payable 10,000. Find out sales, sundry debtors. Sundry debtors is missing actually. Sales, sundry debtors, closing stock, sundry creditors. Simple question. Gross profit ratio is given, right? Question number 1. Question number 1. Gross profit is equal to amount. Gross profit ratio 25%. Gross profit is given and gross profit ratio is given. We can find out sales. Sales is equal to 4 lakhs divided by 25%. Yes or no? 16 lakhs. We can find out cost of a good sold. Cost of a good sold. Cost of a good sold is equal to sales minus gross profit. So 16 minus 4 lakhs. 12 lakhs is what? Cost of a goods sold. So first part of the answer is sales. First sales. Simple. Next B, debtors. Debtors is also simple. Sales is there, yes or no? Sales 16 lakhs into velocity. So 3 by 12. This we have learned in working capital management. 16 lakhs into 3 by 12. 4 lakhs. So there is the other way of a calculation. Other way of a calculation. Okay. So 4 lakhs is not completely debtors. 4 lakhs is accounts receivable actually. Accounts receivable. So debtors is equal to 4 lakhs minus bills receivable given. 4 lakhs minus 20,000. 25,000. 3,75,000 is equal to what? Debtors. So the other way of a calculation is this is one way of a calculation. Straight away we can find out accounts receivable is equal to sales into collection period divided by 12. Okay, clear? The other way of a calculation is what? Find out the debtors turnover ratio. Debtors turnover ratio is equal to 12 divided by delta's collection period. What is the collection period? 3 months. Collection period 3 months means turnover is equal to 4. Debtors turnover ratio 4 is equal to, what is the debtors turnover ratio formula? Credit sales, that is 16 lakhs divided by accounts receivable. Then you will get accounts receivable is equal to 4 lakhs. Clear? Debtors is equal to 4 lakhs minus 25,000, that is 3,75,000. Clear? What is the next one? Next, closing stock. So we have a cost of a goods sold. So we have a cost of a goods sold, right? Cost of a goods sold is there. And next, closing stock of the year is 10,000 above the opening stock. So we can use stock velocity formula. Stock velocity. What is the stock velocity? Stock velocity 8 months. Stock velocity 8 months. Stock velocity 8 months. Okay. So using the stock velocity, we can find out stock turnover ratio. Stock turnover ratio. Stock turnover ratio is equal to 12 divided by stock velocity 1.5. Stock will turn over for how many times? 1.5 times. Because it will take 8 months time to turn one side. So there are 12 months in a year. So how many times? It will turn 1.5 times. Stock turnover. What is the stock turnover ratio formula? Cost of a goods sold. What is the cost of goods sold? 12 lakhs divided by average inventory. So average inventory is equal to 12 lakhs divided by 1.5. 8 lakhs. How do we get average inventory? Opening plus closing divided by 2 is equal to what? 8 lakhs. Okay. So what is the information given in closing stock is higher than? Closing stock is 10,000 above the opening stock. Nothing but I can write it as opening plus 10,000 divided by 2 is equal to what? 8 lakhs. Yes or no? Am I clear? Closing stock can be written as opening plus 10,000. So opening stock is equal to 7 lakh 95,000. That means closing stock is equal to 7,95,000 plus 10,000, that is 8,05,000. 8,05,000 is the closing stock. Done, Sirisha? So clear? Debtors turnover ratio is equal to what? 12 divided by debtors collection period. Stock turnover ratio is equal to 12 divided by stock velocity. Stock velocity. Raw material storage period. Stock velocity and storage period. Stock storage period both are same. Clear? Next what? What is the next one? Next, sundry creditors. Creditors velocity is given, right? Creditors velocity 2 months. So before that we can find out what purchases. We can find out purchase. Yes or no? Let us find out purchase. D part. Cost of a good sold is equal to opening plus purchase minus closing. Cost of a good sold 12 lakhs is equal to 7,95,000 plus purchase minus 8,05,000. Purchase is equal to 12 lakh 10,000. These are the purchases. Creditors turnover ratio is equal to credit to purchases divided by average creditors. Nothing but average accounts payable. Average accounts payable. Average accounts payable. Accounts payable includes creditors and bills payable. Clear? Creditors turnover ratio is equal to credit to purchases divided by average accounts payable. What is the creditors turnover ratio? What is the velocity? Velocity 2 months. That means creditors turnover ratio 6. Total 6 times turnover. So 6 is equal to average accounts payable. So average accounts payable is equal to 12,10,000 divided by 6. 2,01,667. Creditors is equal to 2,01,667 minus what? 10,000. One lakh 91,667. You should know how to use the given information. It is like mathematics. Missing figures. Clearer? See the flow. First one, what is the first part? Sales. That is simple. Gross profit is given, gross profit ratio is given. Sales is equal to gross profit divided by gross profit ratio. Completed. Next what? Debtors. How can we find out debtors? What is the information given? Velocity is given. Collection period. How many months? Straight away we can find out accounts receivable. Sales 16 lakhs into 3 by 12. So 4 lakhs is the accounts receivable. So debtors is equal to 4 lakhs minus 4 lakhs minus bills receivable 25,000. What is the next one? Closing stock. For that we are using stock turnover ratio. Stock velocity is given 8 months. 8 months is the stock velocity. Nothing but stock stay in a store for 8 months. What is the turnover ratio? For one turn it will take 8 months. In a year there are 12 months. So turnover ratio is equal to 12 divided by 8 months, 1.5. So 1.5 is equal to cost of a goods sold 12 lakhs divided by average inventory. So average inventory is equal to 12 lakhs divided by 1.5, 8 lakhs. So average inventory is equal to opening stock plus closing stock divided by 2. So closing stock can be written as opening stock plus 10,000. So opening stock is equal to 7 lakh 95,000. That means closing stock is equal to 8 lakh 5,000. Next, purchases. Why we are finding out purchases? To find out the creditors. Purchase is equal to cost of a goods sold plus closing stock minus opening stock. Yes or no? So that means 12 lakhs plus 10,000. 12 lakh 10,000. So creditors turnover ratio. What is the creditors turnover ratio? Creditors velocity. What is the velocity? Creditors 2 months. That means turnover 6. 12 divided by 2, 6. 6 is equal to credit purchases 12 lakh 10,000 divided by average accounts payable. Average accounts payable is equal to 2 lakh 1,667 minus 10,000. So 1 lakh 91,667. Clear? So here we are taking implied assumptions. All the sales are credit sales. All the purchases are credit purchases. All the purchases are credit purchases. So here stock means finished goods stock. Here stock means what? Finished goods stock. And the cost of a goods sold is equal to opening stock plus purchase minus closing stock. That means we are assuming the business as a retail business. We are purchasing goods and selling. Clear? Done? See the second one. Illustration number 2. This turnover ratios are comes under efficiency ratios. These turnover ratios are calculated to find out how efficiently are we using our resources. How efficiently are we using our resources. Turnover ratios. Okay. Next, illustration number 2. The capital of A Limited is as follows: 10% preference shares, equity shares. Additional information: profit after tax rupees 2,70,000, depreciation 60,000, equity dividend 20%, market price 50. You are required to compute the following. Show necessary workings. A. Dividend yield. We should find out what? Dividend yield. Dividend yield means D1 by P naught. In cost of a capital, we call it as a KE. In cost of a capital, we call it as a KE. Now here we call it as a dividend yield. Yield means return. So investor, he is investing 50 rupees. What is the market price per share? 50. What is the dividend he is getting? 20%. This 20% is always applied on face value. Dividend rate is always applied on face value. So investor is getting 2 rupees dividend on 50. So dividend yield is equal to 4%. %4 is the return earned by the equity shareholder. Clear? Clear? Next, cover for the preference and equity dividend. Cover for the preference and equity dividend. How many preference shares are there? 3 lakhs divided by 10. How many? 30,000. So 30,000 shares, right? So 30,000 shares into 10 rupees into 10%. What is the amount? 30,000. So 30,000 is what? 30,000 is a preference dividend. 30,000 is the preference dividend. And what is the equity dividend? Equity dividend 8 lakhs into 20%. 1,60,000. 1,60,000. Okay. So question number 2. Question number 2. A dividend yield is equal to dividend per share divided by market price per share. What is the dividend? 2 rupees. Market price 50. 4% is the answer. 4% is the answer. Clear? Okay. Next, B. What is the B part? Cover for the preference and equity dividend. Coverage ratio. Preference dividend coverage ratio is equal to preference dividend coverage ratio is equal to coverage. Preference dividend is paid out of a profit after tax. So we have a total 4 coverage ratios: interest coverage ratio, preference dividend coverage ratio, equity dividend coverage ratio, debt service coverage ratio. There are 4 coverage ratios. Interest coverage ratio, debt service coverage ratio, these are used by the lenders. These are used by the lenders. First, interest coverage ratio. Interest coverage ratio is equal to interest is paid from EBIT. Interest is paid from EBIT. So that's why our formula is equal to EBIT divided by interest. EBIT divided by interest. Interest coverage ratio, EBIT divided by interest. For example, you got 10. What is the meaning of that? Your earnings are 10 times of interest. If interest is 1 rupee, your earnings are 10 times more than that interest. So lender will calculate the coverage ratio and will decide whether to give a loan or not. If a coverage ratio is 10, okay, fine. because commitment is only 1 rupee, but earnings are 10 times more than the interest. So that's why we can give a loan. For suppose if a coverage ratio is 1, interest 1 rupee, earnings are also 1 rupee, then loan should not be granted. Loan should not be granted. Okay. So this is interest coverage ratio. If it is a preference dividend coverage ratio, preference dividend coverage ratio means preference dividend should come in the denominator. What about the numerator? Preference dividend is paid out of a profit after tax. So that's why the formula is profit after tax divided by preference dividend. We cannot take EBIT because preference dividend is paid out of a profit after tax. So PAT is equal to, in this question PAT is equal to divided by preference dividend 30,000, 9 times, 9 times. Preference dividend coverage ratio is equal to 9 times. Preference dividend, if it is 1 rupee, 9 times, earnings are 9 times. Next what? Equity dividend coverage ratio. Equity dividend coverage ratio. Guess the formula. Yes, exactly. Equity dividend is paid out of EAES, earnings available to equity shareholders divided by equity dividend. So that means 2,70,000 minus 30,000 preference dividend. Then you will get earnings available to equity shareholders divided by equity dividend. 1,60,000, yeah? 1,60,000. So what is the ratio? 1.52. 1.52 times. Next, earnings per share. Earnings per share is equal to earnings available to equity shareholders 2,40,000 divided by number of shares 80,000. 3 per share. Next, price earning ratio. Price earning ratio means market price per share divided by earnings per share. 16.67 times. Higher the PE ratio, better it is. What is the PE ratio meaning? Market is paying 16.67 times of earnings. Nothing but if earnings per share increases by 1 rupee, market price increases by 16.67. 16.67. Clear? Yojita? Next, see the fourth one. Fourth one. From the P&L, 90 lakhs was transferred to general reserve. Interest cost amounted to 120 lakhs. Taxation 40%. You are required to calculate what? Current ratio. And next, debt equity ratio. Current ratio, current assets divided by current liabilities. So current assets, stock 460 plus 10. Miscellaneous expenditure is a fictitious asset that should not be considered. So 460 plus 460 plus 10, 930. Divided by current liabilities. Short term loan 360 plus creditors 150, other liabilities 30, 540. Current ratio 1.72. Debt equity. Debt equity means debt divided by equity. here debt equity ratio, we should take only long term debt. What is the long term debt here? Long term debt 300 divided by equity. Equity is equal to 250 plus 280 plus 30 minus 20. 540. Clear? 250 plus 280 plus 30 minus 20. 540. So debt equity ratio is equal to 300 divided by 540. So the answer is 0.56. 0.56 is the correct answer, not 0.54. Alternative is given at the end. Alternative answer. Alternative answer is given at the end. Equity means equity share capital plus reserves and surplus minus fictitious assets. So clear? Next, fifth one. Following information has been provided from the books of Lakshmi Private for the year ending on 31st March 2021. 31st March 2021. Net working capital 4,80,000. Net working capital means current assets minus current liabilities. Bank overdraft. Fixed assets to proprietary ratio. Reserves and surplus. Current ratio. Liquid ratio. You are required to prepare summarized balance sheet. Generally these model are being asked in examination. They will ask you to prepare a summarized balance sheet. Ratios are given. Okay. Current ratio is given, yes or no? Question number? Vamshi? Vamshi, question number 5. Current ratio is equal to current asset divided by current liability. 2.5. Current assets is equal to 2.5 current liabilities. 2.5 current liabilities. Yes or no? Am I clear? What about working capital? Current assets minus current liability. That is equal to. This is a common step in every ratio analysis question. Current asset minus current liability 4,80,000. We can write current assets as 2.5 current liabilities minus current liabilities is equal to 4,80,000. 1.5 current liability is equal to 4,80,000. So current liability is equal to 3. So 3,20,000 is the current liability. This is a common step in every ratio analysis question. Common step. Go through this step. Clear? After using current ratio, we should use quick ratio. Quick ratio is equal to current assets minus stock divided by current liabilities. Current assets is equal to 2.5 times of our current liabilities, that is 8 lakhs. So 1.5 is equal to 8 lakhs minus stock divided by 3,20,000. So stock is equal to 3,20,000. Clear? Next ratio that can be used is fixed assets to proprietary ratio. This is also very commonly used step, fixed assets to proprietary. Proprietary fund can be written as fixed assets plus working capital minus long-term debt, but we assume there is no long-term debt because by using one equation we cannot find out two variables. Okay, two variables. So proprietary fund, equity, net worth, all are same. Proprietary fund is equal to fixed assets plus working capital minus long-term debt, but we are taking an implied assumption that there are no long-term debts. Sir, why can't we write other way? What is the other way of writing proprietary fund? Equity share capital plus reserves and surplus minus fictitious assets. In that case, we don't know the equity share capital, we don't know reserves and surplus, we do not know fictitious assets. Okay, we can take one assumption. There are no fictitious assets. Yes or no? But we cannot take an assumption that there is no reserves and surplus, there are no fictitious assets. So that's why we should come from the asset side. Equity is equal to fixed assets plus working capital. What is the ratio? 0.75. 0.75. So fixed assets, we don't know fixed assets, divided by fixed assets plus working capital is equal to 0.75. By solving this, you can find out fixed assets. 14 lakh 40,000. That means net worth or proprietary fund is equal to 14 lakh 40,000 plus 4 lakh 80,000. 19 lakh 20,000. 19 lakh 20,000. 19 lakh 20,000. So here proprietary fund cannot be written as equity share capital, reserves and surplus. Why? Because we don't know fixed assets, we do not know equity share capital. By using one equation, we cannot find out two variables. Clear? Adhodna equity proprietary fund and equity plus reserves and surplus minus fictitious assets and రాయలేము. అలా రాస్తే ఏమవుద్ది? ఫిక్స్డ్ అసెట్స్ తెలీదు, ఈక్విటీ షేర్ క్యాపిటల్ తెలీదు, ఫిక్టీషియస్ అసెట్స్ తెలీదు. సరే ఫిక్టీషియస్ అసెట్స్ అంటే అజంప్షన్ ఏం తీసుకుంటాం? లేవనుకుంటాం. అప్పుడు ఇంకేం ఫైండ్ అవుట్ చేయాలి? రిజర్వ్స్ అండ్ సర్ప్లస్ ఇచ్చాడు క్వశ్చన్లో, కానీ ఇంకేం ఫైండ్ అవుట్ చేయాలి? ఫిక్స్డ్ అసెట్స్ ఫైండ్ అవుట్ చేయాలి, ఈక్విటీ షేర్ క్యాపిటల్ ఫైండ్ అవుట్ చేయాలంటే ఒక ఈక్వేషన్తో టూ వేరియబుల్స్ కష్టం. అందుకని ఏం చేసాం మనం? ప్రొప్రైటరీ ఫండ్ ఇంకొకలా రాసాం. ఎలా అమ్మా? ఫిక్స్డ్ అసెట్స్ ప్లస్ వర్కింగ్ క్యాపిటల్, లాంగ్ టర్మ్ డెట్ లేదు అనుకుందాం. వర్కింగ్ క్యాపిటల్ ఎలాగో తెలుసు కాబట్టి మనం ఫైండ్ అవుట్ చేయాల్సిన ఓన్లీ వన్, ఫిక్స్డ్ అసెట్స్. క్లియరా? నెక్స్ట్, ఈజ్ దెర్ ఎనీ అదర్ రేషియో? ఎనీ అదర్ రేషియో? నో. ఓకే, సో క్లియరా? బ్యాలెన్స్ షీట్. Net worth, overall net worth is 19 lakh 20. Overall net worth 19 lakh 20. That means reserves and surplus 3 lakh 20. Equity 16 lakhs. Net worth is equal to 19 lakh 20 minus reserves and surplus 3 lakh 20. Equity 16 lakhs. Assets, fixed assets 14 lakh 40. What about stock? 3 lakh 20. Overall current assets is equal to 8 lakhs. In 8 lakhs, 3 lakh 20 is stock. That means remaining other current assets 4 lakh 80. 4 lakh 80 is a missing, balancing figure. 4 lakh 80 is a balancing figure because we know the overall current assets 8 lakhs. Overall current assets 8 lakhs minus stock 3 lakh 20. So other current assets 4 lakh 80. So what about current liabilities? Overall current liabilities 4 lakh 80. In that bank overdraft 3 lakh overdraft 80,000. Bank overdraft 80,000. That is not 3 lakh 20. 80,000. Other liability So current liabilities is equal to 3,20,000, right? Current liability 3,20,000. Current liability 3,20,000. 3,20,000 minus overdraft 80,000. Other current liabilities 2,40,000. So balance sheet total is 19,20,000 plus 80,000 plus 2,40,000. Third point, Amma. ఏది ఫిక్స్డ్ అసెట్స్ టు ప్రొప్రైటరీ రేషియోనా? Fixed assets to proprietary ratio. Fixed assets to proprietary ratio means nothing but fixed assets to proprietary ratio, that can be written as fixed assets divided by proprietary fund. Proprietary fund, equity, net worth, all are same. So equity is nothing but, for example, equity share capital plus reserves and surplus minus fictitious assets. For suppose if I am writing like this, then I cannot proceed further because I only know the reserves and surplus amount. By using this equation, I cannot find out equity share capital, fixed assets. I can take assumption that there are no fictitious assets, but I cannot take an assumption there is no equity share capital. So that is not practically correct, yes or no? So that's why instead of writing like this, I am writing what? Fixed assets divided by fixed assets plus working capital. Nothing but total assets minus current liabilities minus long term debt actually, but my assumption is there are no long term debts. There are no long term debts. That is equal to 0.75. So what is the fixed assets? Zero now. We don't know fixed assets. Plus working capital 4.8 lakhs is equal to 0.75. So nothing but fixed assets is equal to 0.75 fixed assets plus 4,80,000 into 0.75. 3,60,000. 0.25 fixed assets is equal to 3,60,000. Fixed assets is equal to 3,60,000 divided by 0.25. 14,40,000 rupees. 14,40,000 rupees is the answer. This is fixed assets. What about net worth? Net worth is equal to fixed assets plus working capital, that is 14,40,000 plus 4,80,000. 19,20,000. Net worth. Net worth. Net worth is equal to nothing but what? Equity share capital plus reserves and surplus, that is equal to 19,20,000. So nothing but equity share capital is equal to 19,20,000 minus reserves and surplus, that is equal to 6 lakhs. Sorry, 16 lakhs. Likewise, we know the current assets, overall current assets. Overall current assets. So other current assets is equal to current assets minus stock. Current assets 8 lakhs minus stock 3,20,000. 4,80,000. Likewise, other current liabilities. We know the total current liabilities. Total current liabilities is equal to 3,25,000, 20,000 minus overdraft 80,000. 2,40,000 other current liabilities. So the simple balance sheet is equity share capital 16 lakhs, reserves and surplus 3,20,000, 19,20,000 is the total equity. Bank overdraft 0.8, other current liabilities 2,40,000, 3,20,000, total 22,40,000. Next here, fixed assets 14,40,000, stock 3,20,000, other current assets 4,80,000, 8 lakhs total. So this is a summarized balance sheet. Am I clear? So commonly used steps are two steps. One is current ratio and working capital. Second one is fixed assets to proprietary ratio. Generally we write proprietary ratio as a fixed assets plus working capital. Okay. 6, 7 and 8 you try on your own. Okay. Next let us see the common size statement. Here the most important point is common size statement interpretation, not just calculation. You have to interpret. See the illustration number 9. From the following income statement, prepare a common size statement. Also interpret the results. Income statement: net sales, cost of a goods sold, gross profit, operating expense, operating profit, interest on long-term debt, profit before tax. We take sales as 100. What is the sales amount in 2021? 10,50,000. Sales 100. Common size statement. So for all the remaining items, the common point is sales. So what is the cost of a goods sold? 5,70,000. So 5,70,000 divided by 10,50,000. Calculate the percentage. So in the year 2021, 54.3% of the amount is spent towards the cost of a goods sold. What is the gross profit percentage? 4,80,000 divided by 10,50,000. 45.7 less operating expenses. 1,50,000 divided by 10,50,000. 14.3. Operating profit. 31.4. Interest on long-term debt. 5.7. Profit before tax. 25.7. Likewise, we are calculating for 2022 as well. 2022 also. Okay. 47.8. So that is written as 48.8. That is not actually 48.8. That is 47.8. Next word 52.2. Okay, calculation is not necessary. I hope you understood the calculation, how to find out. This is commonly asked question, frequently asked question, either common size or comparative. you will get either of the one. Okay. So interpretation is very important. So what about the cost of a goods sold? Cost of a goods sold has got reduced. Cost of a goods sold percentage has got reduced. Due to that, gross profit has got increased. Gross profit ratio has got increased. You can write on your own. Okay, we are taking a sales 100 only. Sales 100. Sales amount has got increased from 10 lakh 50 to 13 lakh 50. That will be compared in comparative statement. This is not a comparative statement. This is common size. Common size. So in both the years we are taking sales as 100. If you see the gross profit ratio, 2021 45.7, 2022 52.2. What happened to the cost of a goods sold ratio? It has got reduced. That's why the gross profit ratio has got increased. Next, what about the operating expenses? Operating expenses increased, but still the operating profit is higher than 2021 because of decrease in cost of a goods sold. Yes or no? Next, due to decrease in interest on long-term debt, due to the decrease in percentage of interest on long-term debt, again the profit before tax has got increased. Clearer? So the profit before tax to net sales has increased from 25.7 to 32.4. It indicates that the profit earning capacity has improved during the study period. The improvement in the profitability is significantly due to reduction in cost of a goods sold. It may occur due to fall down of input market or may occur due to improvement in the efficiency of the company. Due to improvement in the efficiency of the company, the cost of a goods sold percentage has got decreased, or there is a fall down in input market. Fall down of input market means raw material cost has been reduced. Cost of a goods sold percentage has got reduced. There might be two reasons. One is we are using the resources efficiently. What is the other reason? The input cost has been reduced. For example, our food cost in our college might decrease. There might be two reasons. One is efficient usage. So reducing the wastage will reduce the food cost. Yes or no? What might be the second reason? The rice cost, oil cost, okay, all these costs were reduced. Due to that reason also the cost of a goods sold can be reduced. Next, as other operating expenses are higher, so it is clear that the company has been operating with a tight supervision, tight inventory control for reduction of a cost of a goods sold. Operating expenses have got increased. That means we are supervising very tightly. We are doing an inventory control. So that's why the operating expenses has got increased. Next, what? Interest on long-term debt declined to 3.8. Declined to 3.8 from 5.7. It implies that the financial burden on the company has reduced significantly. It indicates that the finance risk has got significantly declined during the study period. Finance risk. So as it is sentences rayakarledu, you can write on your own interpretation. You can write on your own. On your own and ela rayaddu. Gross profit increased 52.2%. Cost of goods sold decreased to 48.8. అలాగే లింకింగ్ చేయాలి కదా. The gross profit has got increased due to decrease in cost of a goods sold. So that might be due to efficient usage of resources or fall in the input market. Clear? This is what common size. Common size statement. Clear? 10th is also similar. You do the 10th one, okay? Next, see the 11th question. The following are the income statements of A Limited for the year ended 31st March 2021, 31st March 2022. Net sales, cost of a goods sold, gross profit, administrative expenses, selling expenses, other selling expenses, total selling expenses, operating expenses, operating profit, other income, other expense, profit before tax, income tax, profit after tax. Prepare a comparative income statement. Comparative means we compare the latest year with last year. Comparative statement. Comparative statement. So first, see the net sales. Net sales last year 1,70,000, this year 1,90,400. What is the increase? 20,400. Percentage 20,400 divided by 1,70,000. 12 percentage. So 12 percentage is the increase in net sales. Next, cost of a goods sold 15,000 divided by 1,05,000. 14.3. Gross profit 5,400 divided by 65,000. 8.3%. Administrative expenses, Vasant, administrative expenses 13.33. Clear? Advertising expenses 33.33%. Other selling expenses 2.45. ఓకే, అర్థమైంది కదా హౌ టు క్యాలిక్యులేట్. ఫస్ట్ ఇంటర్ప్రిటేషన్. నెట్ సేల్స్ హ్యాస్ గాట్ ఇంక్రీజ్డ్ బై 12%, but whereas cost of a good sold has got increased by 14.3. Actually, if a sales are increasing by 12%, then the cost of a good sold must also increase by 12%. But cost of a good sold increased by 14.3%. That means we may not be using our resources efficiently, or there might be increase in input market. So that's why the cost of a good sold increased by 14.3. Okay. Sales increased by 12% means gross profit must also increase by 12. But gross profit increased by only 8.3. Because cost of a good sold increased in a greater proportion. That's why. And administrative expenses increased by 13.3. Advertisement expenses increased by 33.3. Heavy competition might be there. So that's why even though we have increased our advertisement expenses by 33.3%, still we are able to generate our sales. Still we are able to increase our sales by 12%. Our advertisement expenses increased by 33.3, but sales increased by only 12%. Other selling expenses, okay, reasonable. Total selling, okay. Operating expense also fine. Operating profit increased by what? 20.5, because other selling expenses, total selling expenses have not increased proportionately. There is a less increase. Next, other income. There is a significant increase in other income. There is a significant increase in other income, so the company has to focus on other income as well, because other income has got increased by 43.8% and other expenses decreased by 29.4. So clear? So that you can write on your own. So this is what comparative statement. Comparative statement, okay. So clear. 12 you can do on your own. Comparative balance sheet. Next, trend. Calculation of a trend ratio. Trend means 2 or 3 years data will be taken. Same like comparative, but 2 or 3 years. See the cost of a material consumed. $125. What is this 125? In 2020, material consumed is equal to 2,50,000. So 2,50,000 divided by 2 lakhs into 100. 125. Nothing but there was a 25% increase. Next, 2021. 2 lakhs and 2 lakhs means 100. 2022. 1,80,000 divided by 2 lakhs. 90. Next, labor cost. 100. 133.3. 83.3. Are you able to understand? Other expense 2 lakhs divided by 1,50,000. Other expenses 2,50,000. Other expenses 2 lakh. Divided by 2 lakhs divided by 1,50,000. 133.3. 1 lakh divided by 1,50,000. 66.7. Next word 1,50,000 divided by 1,50,000. 100. Clear? So there was a reduction in cost of a sales. In the year 21-22, there was a reduction in cost of a sales. The main reason for reduction in cost of a sales is there was a reduction in cost of a material consumed and labor cost. Yes or no? So we cannot come to the conclusion from the above table because it is fluctuating. It is fluctuating because cost of a material consumed 100, 125, 100 and 90. Labor cost 100, 100, 133 and 83.3. Other expenses again same. So these are figures are fluctuating. Except that there is a fluctuating trend in all the items disclosed in the financial statement during the period under study. So no definite conclusion can be drawn from the above analysis. Here the figures are fluctuating, so that's why we cannot come to the conclusion. So clear? So this is trend ratio. Trend ratio. So there is one more question. Altman, illustration 14. Altman Z-Score. Altman Z-Score. Working capital to total assets 25%, retained earnings to total assets 30%, EBIT to total assets 15%, market value to equity shares, market value of equity shares to book value of a total debt 150%, sales to total assets 2 times. Okay. So this Altman Z-Score is calculated to find whether the company is in a corporate distress or not. Corporate distress or not. For suppose if a Z-Score is less than 2.99, then we say that the company is under a corporate distress. Company financial position is not good. Soon it is going to, okay, liquidation. Soon it is going to shut down. If a Z-Score is less than what? 2.99. So this you have to remember. Z-Score is equal to 1.2 x1. This 1.2, 1.4, 3.3, 0.6 and 1.0. These are the weights given as per Altman's model 1968. There is 1983 model also, further weights will change. Okay, so this is a CMA final SPMBV concept, but in the past they have been asked once. This Altman Z-Score. Altman Z-Score. First thing, if you observe the working capital total assets, that should be high. For working capital to total assets is high, that means the liquidity position is good. Liquidity position, there is a short term availability of a cash. If a working capital to total assets is high, that means company's liquidity position is good. Yes or no? Working capital, current assets can be converted into cash within a year. But total assets are illiquid assets, fixed assets are illiquid assets. So that 25%, I mean working capital to total asset, that ratio should be high. Retained earnings to total assets must also be high. That means if you are retaining money means what? You are reinvesting. You are in surplus. Okay, so that indicates your company position is good. EBIT to total assets, that also should be high. Market value of equity shares to book value of a debt also be high. And next, sales to total assets, turnover ratio must also be high. But different weights are given. For example, for sales to total assets, weight 1 is given. Is multiplied with 1. X4, market value of equity to debt, 0.6 weight is given. EBIT to total assets, return on investment, for that the high weight is given, 3.33. And for retained earnings 1.4, and for working capital to total assets 1.2. So simple calculation is Altman Z-Score 1.2 into 0.25, 1.2 into 0.25, 1.4 into 0.3, 3.3 into 0.15, 0.6 into 150 percentage. Next one into 2. Last one is not a percentage, last one is a ratio. Be careful, last one is a ratio, not a percentage. 4 point. So the Z-score calculated is much higher than 2.99. It can be strongly predicted that the company is not a bankrupt company. company is a non-bankrupt company. Company is not under a corporate distress. So clear, you have to remember those numbers. If this question comes in examination, very easy. Just substitute the values. 7 marks. Be careful here. X1 means, what is X1? Order might change. Order might change. Be careful. X1 means working capital to total assets. X2 means retained earnings to total assets. X3 means EBIT to total assets. X4 market value of equity shares to book value of total debt. And X5 sales to total assets. Sales to total assets. Working capital, retained earnings, EBIT. And next market value of equity, and then sales. X1, X2, X3 denominator total assets, and for X5 denominator total assets. Only for X4 denominator is book value of a total debt. So this is Altman Z-Score 1968. Okay. In question, if they are not mentioning the year, then 1968. Follow the 1968. So clear, this is very important chapter. Go through the solutions. I asked you to practice question number 3 questions. What are the 3 questions? 6, 7, 8. Mainly 6, 7, 8. 9, 11 kuda. 10, 11. 10, 11. So in capital budgeting, so we have completed up to IRR, right? So we haven't discussed ranking conflict. So there are no questions being asked from ranking conflict. So they are not asking questions from modified NPV, modified IRR. Okay. So as we are running out of time, so but they are asking question from EAC, equated annual cost. How do we get equated annual cost? Sum of a discounted cash outflow divided by PVAF, present value annuity factor. We use equated annual cost method when there is a life disparity. When there is a life disparity. For example, one machine life is 5 years and the other machine life is 10 years. Then we use equated annual cost method. 5 years and 10 years. Okay. So equated annual cost is equal to sum of a discounted cash outflow divided by PVAF. For suppose if a cash inflows are given and there is a life disparity 5 and 10, then we should find out equated annual benefit. Equated annual benefit. Equated annual benefit is equal to NPV, net present value, divided by present value annuity factor. I'm telling you the capital bursting formula. Equated annual cost is equal to sum of a discounted cash outflow divided by present value annuity factor. If only costs are given and there are 2 machines, one machine life is 5 years and the second machine life is 10 years, then we should find out equated annual cost, because we cannot compare sum of a discounted cash outflow, because one machine life is 5 years and the second machine life is 10 years. So that's why we find out EAC, equated annual cost. This is similar to time value for money, installment calculation. Installment is equal to loan amount divided by PVAF. So equated annual cost is equal to sum of a discounted cash outflow divided by PVAF. Equated annual benefit. For suppose 2 machines information is given and cash flows are also given, then in that case net present value divided by present value annuity factor. Net present value divided by present value annuity factor. Simple, you know how to find out net present value. How do we find out net present value? Sum of our discounted cash inflow minus sum of our discounted cash outflow. Okay. For example, there is a machine with 5 years life, there is a machine with 10 years life. We have a calculated NPV. So 5 years machine life NPV 10 lakhs and 10 years machine NPV 12 lakhs. Now tell me which machine I should select. Based on NPV I should select second one, because second machine is having a higher NPV. But that is not actually correct, because the life is not the same. The life is not same. First machine life is 5 years, second machine life is 10 years. So that's why in that case I should find out equated annual benefit. How do I get equated annual benefit? NPV, net present value divided by present value annuity factor. And I would select a machine which is having a higher equated annual benefit. Higher equated annual benefit. So clear? Higher equated annual benefit. If only costs are given, then I would select a machine which is having a lower equated annual cost. So they might ask you this question, EAC question, equated annual cost. Equated annual cost, sum of a discounted cash outflow divided by PVAF, present value annuity factor. And in dividend decision there is a Lindner model. Lindner model means the target EPS depends upon a past EPS. Past EPS. I mean how much, dividend, how much dividend we are going to target payout ratio. Target payout ratio. How much dividend we are going to pay for the next year depends upon what? Past payout ratio. The last year payout ratio. They will ask you an MCQ. Lindner's model. They will not ask you any question, but they might ask you MCQ. Okay. Lindner model. Clear? So ratio analysis is most important. Ratio analysis.